Index story, it's below the index story, and that's what we're watching once again. Eurostoxx 50 futures are up by 0.4%. The FTSE up a similar amount. The DAX is up a similar amount. We're about to get a fair amount of PMI data in the next hour. That could be something that moves these markets. You're going to see some single stock stories that I think are worth paying attention to. Keep an eye on Anglo in particular. I think that's going to be interesting. But at the moment, these indexes are not necessarily telling the whole story. It's the churn below the indexes at a sector, at a single stock level, that I think are the really interesting tell on where sentiment lies right now, Tom.
On some of those individual names, you mentioned Anglo then, Guy, coming through with that impairment then, pre-tax impairment of $2.3 billion on the diamonds unit. De Beers, of course. Top line in terms of the profits, staying steady, essentially, underlying earnings of 6.4 billion. But the focus, you would have thought, from many investors will be on that impairment and how they work through the diamond challenge. Of course, they do have that additional exposure to copper. Danone, in terms of the earnings, looking pretty solid. Sales rising. They're getting a boost from high protein and medical nutrition demand, and not seeing a material impact as a result of recalls in the US. Aston Martin, and you're seeing just another profit warning. Again, they are citing the impact of tariffs, Guy.
Bad day for Bond. Okay, let's move on and talk a little bit about what is happening with this market open. We're expecting it to be positive. We're expecting some very interesting single stock stories. But let's take a look at the index level to start with and talk you through what is happening there. We're expecting the FTSE 100 to be up a little bit, but not by much. We're expecting 2–3% maybe from some of these indexes in Europe. That's what we're basically getting out of the FTSE 100 already. Let's see how the miners do this morning. Let's see how the oil stocks in particular do, as well as we watch what is happening in the Gulf and this build-up of US military kit in that space. Stock 600 is up by 0.2%. The DAX clearly has no news this morning. It is up and it's out early. Clearly nothing is happening in Germany. The CAC is up, though, more than most. It's up by 0.5%. The IBEX is up by 0.3%. Clearly a very quiet morning for the German market. You don't normally see the DAX open by this point. Tom, what do you got?
On the sector-by-sector breakdown, Guy, consumer products at the top of the list, gaining a little over 1%. Construction up 0.9%, and chemicals up 0.7%. On the downside, utilities a little softer. That is the biggest loser across your sector so far. Alongside autos and Aston Martin, part of the mix there. Autos down 0.3%. That's the sector-by-sector breakdown. Interesting look at the FTSE 100. We keep an eye, of course, on what's happening in the energy space, given higher oil prices. But energy as a sector is actually down 0.2%. Some of the gainers on the FTSE 100 include some of the financial services firms, like St James's Place, which is up 3.6%. Also the luxury stocks, Burberry getting a bit of a lift, gaining as well. What are you seeing, Guy?
Yeah, LVMH is the biggest points gainer, the upside. That's what we're seeing in space. I wonder whether there's a sort of certain read across. Maybe this is China, I don't know. I'm curious to find out exactly what's going on there. Maybe Air France, Accor telling a positive story about what is happening with the kind of the ultra-luxury story. Maybe that gives us a boost. But it's LVMH, it's Richemont in that space that are doing well. As you say, you are seeing a fairly mixed bag elsewhere. Some of the pharma stocks are coming through. Nestle is down. Which I think is interesting. I think Infineon's XD today, so that's probably just worth noting too. But the churn continues, and I think that really is the narrative that we're watching once again. Single stock volatility remains a big theme. Churn within sectors remains a big theme. Equities at an index level just going sideways. But tech has been a big theme, and this big sellout we've seen, particularly in software stocks over recent days, has been this growing narrative. Maria Feimana, head of equity research at State Street Global Markets, joining us now to discuss. Maria, fantastic as ever to see you. How are you feeling about tech?
Yeah, good morning, Guy. Good morning, everyone. I mean, what we're seeing about in tech is kind of rotation from tech to tech. That's kind of the tagline we're going with. So we see quite a big rotation from software into hardware. So that trade is very prominent. We also see rotation from US tech to Asian tech. So the kind of investors kind of moving money to places like Korea, like Taiwan. So so it's not kind of people getting out of tech. It's just choosing where you see more clear monetization, where you're seeing kind of winners and losers from this kind of AI arms race.
What do you think about what is happening with the Magnificent Seven, though? There is serious concern, serious kind of the narrative. You see Microsoft coming down. That's the kind of the software side of things, but maybe a little bit of AI spend stories as well. Elsewhere, you're getting a divergence between Microsoft and say, Alphabet. What is happening within that key group, which is so determines what happens at an index level, particularly in the States?
So, I think there are a couple of points to make. I mean, the first point to make is that, so Q4 earnings, that's kind of been market seen it as a little bit of a catalyst for sell-off, but as kind of CapEx, huge continuation of expansion in CapEx. But other than that, we saw very significant earnings. And on CapEx, particularly for Magnificent Seven, what we're seeing is that CapEx is enormous, but the cash from kind of operating cash flows are still twice as much. So ability to finance this CapEx is still there. So we're not kind of getting any more negative on that. But it's very clear the rotation within the sector. So I think the kind of good analogy is kind of if you're thinking about waterfall, you don't want to be on top of the waterfall with kind of LLMs of this world. You want to be towards the bottom waterfalls where this CapEx is trickling down and who is kind of benefiting from this huge spending. And that's kind of your hardware side, your semi side, but also, I don't know, materials, industrials. So companies who feed into this CapEx, AI CapEx are benefiting from that. So kind of AI enablers, that's potentially kind of the new trade.
Is it new though, Maria? I mean, how wide is that window? How much further does that trade have to go?
Yeah, no, that's a good point. So that has been happening maybe for the last kind of 3 months, but if we compare investor holdings, say in, I don't know, capital goods or materials, they probably 3 or 4 times lower than what we see in tech sector, so that definitely can continue. Out of emerging markets, so we saw money going out of, like, say, US into Korea. Again, holdings in Korean stocks. I mean, Korean stocks done fantastically well, but the holdings, investor holdings are about 4 times lower than in US. I mean, I'm not suggesting that they're going to go to exactly the same levels, but that kind of gives you the degree of magnitude. So yeah, so those trades are reasonably kind of recent. So we still see continuation of that demand.
We know notoriously it's difficult. I want to shift from the tech story to what's happening geopolitically, and notoriously difficult to price geopolitics. But would you want to be placing any hedges on? Would you want to be looking at other asset classes or other parts of the equity market in light of the tensions around Iran?
Yeah, that's a really interesting point. And I think what we saw for a good part of, like, towards the end of last year and kind of start of this year is that I think those geopolitical stories are really notoriously difficult to price in a sense that normally what we'll do as kind of as analysts is that you look at, okay, so something happening in geopolitics, and then you do your case studies. If this happens, this assets will do well. If that happens, this assets will do well, and then you assign some probabilities, and you kind of build your portfolios this way. I think right now it's almost impossible to assign probabilities to any outcome, given how quickly those narratives change. And I think what investors are doing, or have been doing throughout most of last year, they maintain their core risk bets within tech, emerging markets. That trade continue. But what they did, they bought a lot of kind of precious metals, so that seemed to be kind of the favorite hedge, and kind of within equities it's been kind of mining stocks. So that was kind of, so you had this like really strange situation where the kind of gold as a kind of proxy for risk done really well, like your safe assets, and at the same time risk assets done very well. So investors did not change the core of their allocations, they just hedged it with kind of precious metals and kind of carried on with risk positions.
Maria, what do you make of what is happening at a single stock level and a sort of a sector level and an index level? Indexes are going nowhere, but below the surface, I'm getting a lot of single stock volatility. And I'm wondering what you make of this. Some people saying it's nothing, this is normal churn within a market, but it's very aggressive churn. And I'm wondering whether or not this is a signal that we should take note of and should be concerned about. What do you make of this divergence?
Yeah, I think the first point to make is absolutely we're seeing this churn. We actually have an index that measures this kind of weirdness of the market, so unusualness of the market. We call it correlation surprise, and it's absolutely been kind of quite elevated. Last year came off a little bit towards Christmas and then started to go up again very, very strongly now. So that's definitely there. It's not at the highest level we've seen, so that potentially can continue. I mean, historically, that tends to kind of predict spikes in overall volatility, so that's something to take note of. And I think the way investors take note of is through those hedges in the kind of precious metals. So they do those kind of unusual things that makes the whole system potentially less stable. And we see this kind of very elevated positions, A, in risk trade, but B, in safe trade, but not much in the middle. So that I think the way investors playing it. And I struggle to see that going away, given that geopolitical risks are probably kind of a feature, not a bug these days.
Maria, on the regional question, in terms of regional exposure, we get a lot of guests on who like the European story for all number of reasons. Rates at 2%, fiscal stimulus from Germany, green shoots. You push back on that. I mean, particularly around the small caps. This is not a space you want to have exposure to.
Yeah, I mean, the problem we have with Europe is it's really just green shoots, and as opposed to kind of strong growth. I think, in Europe, last couple of years, we flirted with recession. I mean, this year it's slightly more positive, but I don't know what GDP growth forecast is. I mean, still less than 1%, 0.5, 0.6. If we were talking about these numbers in US, we will be pulling our hairs out and talking about recession. So it's still not the level of earnings growth. And also, the important point about Europe to make is that last year, European stocks performed really, really well on hope of earnings recovery. So multiples re-rated, earnings recovery has not happened, has not materialized, earnings still contracted. So we're still we priced like this kind of earnings already, and they're not happening. So to me, that's not a region to be very excited about.
Maria, I hope you're enjoying the Olympics. Thank you very much indeed for joining us. Maria Weimana, the head of equity research at State Street Global Markets, joining us from Milan. Let's talk about what we're seeing in the core six right now. This is the picture. A game of two halves. Novo, LVMH, and Rheinmetall all trading higher. I think there's a note out this morning on European semis, which is worth paying attention to. I think it's from Bank of America. ASML is soft. Schneider's down. Nestle seeing some softness as well. Let's go from LVMH, which is up quite nicely, to a stock that's really driving this space this morning, which is Moncler. Chloe Melly's got more.
Good morning, Guy. Indeed, Moncler is having a great day today. We're up more than 12%. This is a maker of high-end puffer jackets, and it reported full-year and fourth-quarter revenue that was ahead of estimates. And especially, there was a lot of strength in the Chinese market. And so that has been driving the rest of that luxury sector higher. And as you just mentioned, LVMH also higher on the back of that. Another name that is definitely in the green is Kingspan. This is an Irish construction company and generated record revenue in 2025. And that was thanks to very strong demand in data centers, and that helped to offset some of the weakness in the residential end of the market. This is something that we've seen with other names in that infrastructure construction sector in Europe, like Avanci or Skanska as well, where they had those really strong data center customers that were offsetting some of the weakness elsewhere. And therefore, for Kingspan, we're up almost 9%. SJP, St. James's Place, is also up this morning, about 2%. That is after UBS upgraded the company to a buy rating. So St. James's Place was one of those companies that was really hit by that sell-off in companies that are exposed to AI disruption. But UBS analysts are saying that the valuation is very cheap, and so that makes it very attractive despite those AI risks. And finally, let's end with Danone, which is a little bit weaker. It was a little bit weaker this morning, despite those strong sales, despite the fact that that they are saying that the infant formula recalls will not have a material impact, but management has just said that that impact will be as much as 1% on net sales in the first quarter. And so that might be what the market is reacting to this morning. And we are down a little bit, about 1.2% for Danone.
Chloe Milley, thank you very much indeed on some of the stocks on the move, earnings in focus. And coming up, we'll get another earnings story. Anglo-American taking a big hit on its diamond unit. The stock is currently up just shy of 0.1%. We're going to be speaking to the CEO of that major mining company. That's coming up next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back. We have some breaking data out of France. PMI, manufacturing purchases index, coming in slightly higher than the forecasts, 49.9. The forecasts have been for 49.6. That's for the month of February. That's the composite number. Worth zeroing in on the manufacturing component. That's coming in slightly softer, modestly softer than, well, a fair bit softer than the survey. 49.9. The survey had been for 50.9. Services coming in stronger, though, so 49.6. The services seeing a bit of a lift. There's a bit of divergence between manufacturing and services. Not extreme, but services coming in slightly stronger than the survey, but manufacturing softer, certainly. Yeah. So the composite number coming in, rounding out at 49.9, Guy. The euro is currently at 117, not a huge move.
Okay, so this is the line that we're getting in terms of the press release that we get with the market PMI data. France's private equity, private sector economy continue to lack any impetus for growth. February's flash PMI survey data showed with business activity levels basically unchanged at the beginning of the year. Stagnation was also seen in employment after back-to-back months of expansion either side of the new year. Basically, the French economy is going sideways at this point. There's some upside in the idea that maybe actually we're getting some political stability, but it's not yet maybe being reflected in terms of the economic data that we're getting. We're basically at flat. We're kind of flat 50. Let's call it 50. Basically, the French economy is going nowhere in a hurry.
Yeah,
and
it's hard to see what the next catalyst is for the French economy. You can look at catalysts for the German economy, for example. It's hard to see where it comes from. They have pulled out some of that, or at least washed out some of that political risk, at least for now. To your point, the budget has passed. So maybe things start to turn around. Maybe there's a benefit and some uplift that comes through from the German fiscal spend.
So where do you get the momentum from? What is it that could cause momentum here? You're also potentially facing a stronger euro, which is going to be a factor as well. I know we're off the recent highs. People were talking about 120, but that we're fading off the back of that. So we've got 117 right now. But it's really hard to see where the catalyst comes from in terms of the French economy right now and what happens next. Clearly, we're also coming into a period where we're going to start thinking this year about the 27 elections. And that's going to be a factor that is also going to weigh as well. Who will be Macron's successor, I think, is a question the French economy is increasingly going to have to deal with as we work our way through 2026.
And that's certainly a question that seems to be percolating through the halls of the ECB as well.
As we think about who could... Does Christine Lagarde go early or does she not go early? So that's what we're seeing in terms of the macro data. We'll bring you more PMI data as we work our way through this hour. Let's return now to what we're seeing in terms of the corporate news. Anglo American has taken a $2.3 billion impairment charge on its struggling De Beers diamond unit, which, remember, it's trying to exit at the moment. Across the group, Anglo reported a 2% rise in underlying earnings from continuing operations. Joining us now, Duncan Wambler, the CEO of Anglo American. Duncan, thank you very much indeed for your time this morning. Where should we focus in terms of the business? Should we focus on the kind of the rejigging you're doing in terms of the portfolio? Should we focus on the concerns around what we're seeing in the diamond business, what's happening in coal? What bit part of the business takes the greatest amount of your time right now? And where do you see these results in a year if we do see the ongoing restructuring continuing? Where are we in the journey, I guess, is the question I'm really asking.
Good. Well, it's a great question. Thanks for that. And I guess the answer to it is I'm focused on all of those areas. I mean, we started out with a very significant turnaround in the business, focused on making sure that we operated the assets that we had under our management to the best of our abilities. And I think that that's absolutely starting to show through, particularly in the retained businesses. And at the same time, there were a number of reasons that we needed to reset the portfolio, and that's a process that has really progressed very well with the demerger of our platinum group, which is now Valterra Platinum. And of course, we've got our nickel business that is just waiting for EU approvals before it can close. We're now well progressed again with the sale of the coal business. And then, as you mentioned, diamonds is the business that is taking a little bit longer, as we had expected to do, just given the nature and the shape of the diamond markets today. So that is going on, and that's going very well. At the same time, having now announced the deal with Teck and the merger with Teck in September of last year, having now received the shareholder approvals on both sides for the deal to continue. We've gone a long way down the line of regulatory approvals. We've only got 2 left to go, and all the focus is on how we integrate these businesses when completion does come.
Okay, let's just unpack that a little bit. Let's start with the Teck side of things. What indications do you have from Chinese regulators in particular about how they're going to treat this deal?
So we said at the time of the announcement in September of last year that our expectation was that the time to completion would be somewhere between 12 and 18 months. So that would put us somewhere between September of this year and March of next year. And I believe we are absolutely on track as far as that's concerned. So we have had no indications from China, either positively or negatively. We are in a process with China, and this is moving at the speed and the pace that we expected it to do.
On the diamonds business, on De Beers, Duncan, you talked about the complexity given the market. What is your sense as to where we are in the market journey, where we are in terms of that competitive threat, the softness in the Chinese market? When do the conditions become good to get this across the line?
Yeah, look, a number of things are sort of impacting. I think this time last year I said, well, we were slightly hopeful that we were starting to see some green shoots insofar as we were starting to see a net positive inflow of diamonds back into China. We were seeing very, very robust activity for polished goods in India, and the US was stable to improving. So these are three key big markets for diamonds. But at the same time, of course, we saw massive production increases, particularly coming out of Angola during the course of the year, which put quite a lot of pressure on pricing. And at the same time, the lack of a trade deal between the US and India resulted in a 50% tariff on all Indian goods, and the vast majority of rough diamonds go to India for cutting and polishing. So those were sort of the impacts during the course of the year. But the fundamentals in terms of what changes diamonds, I think, is just the time it takes for hopefully this trade deal to be done. But secondly, the time it takes for consumers to fundamentally realize the difference between lab-grown diamonds and natural diamonds from a value perspective. And certainly we are seeing that today. So the production of lab-grown diamonds, the costs are very, very low, the consequence of which is, you can't defy gravity in terms of an unreasonable margin against the cost of that production forever. And we are certainly starting to see that change shape, but it will have to fully change shape. And then we'll have two markets. We'll have a natural diamonds market, and we'll have a lab-grown diamonds market. And our expectation is that in a few years, that's where we should be.
In a few years, does that inform our view in terms of the time frame then, as to when you can successfully demerge De Beers? That's not a 2026 story? Is that more 2027, 2028? What is your current best?
No, so certainly that does not inform a view of when De Beers could be divested, because of course the process of divestment is pretty broad in terms of the nature and the number of buyers, potential buyers that we've looked at. All of the buyers that we have in the process today are deeply strategic. So these are people that know and understand diamond industries, know and understand the mechanisms of the market, and will see through where we are in the cycle at this particular point in time, given the very high quality nature of this business and its underlying assets.
Duncan, do you think it'll happen this year?
I'm optimistic that it will happen this year, yes.
Okay. What's happening with the coal business? You're restarting a number of mines in the Grosvenor mine. Just walk us through what you think the timeline looks like when it comes to the coal business too. A, in terms of kind of restarts and the progress there, and B, in terms of the kind of positioning this business as well.
So we restarted Moranbah North in November of last year, and in February, just the beginning of this month, we had all the remaining restrictions removed by the authorities. So Moranbah North will now ramp up to its full production capacity, and we are back underground at Grosvenor, with now looking at a possible restart of that mine in 2027 or 2028. As far as the divestment process is concerned, so we restarted the process just after Moranbah North restarted. So this was in December of last year. I'm hoping to get to final bids in Q2 of this year, and still optimistic that we will be able to complete the transaction before the end of this year.
Duncan, great to catch up. Always appreciate your updates. Thank you very much indeed for your time this morning. Duncan Wanblad, the CEO of Anglo American. The stock up by 1.12%, just beginning to climb a little bit more now.
Okay, we're going to get more on the economic data coming out of the Eurozone. French PMIs, bit of mixed in terms of what's happening. Manufacturing a little softer, services picking up a bit. We're going to get the views of Catherine Nace telling us what this means for the broader Euro area. We're going to have that interview for you next. Stay with us. This is Bloomberg.
Peru is maybe first country inspired to me to how can I use the different ingredients. First time I went to Peru, trying to culture food, I never had this ingredients never used in Japan. Kind of like a wow, you know, and cilantros, chili, garlic, and olive oils. So a lot of good seafoods, complete a different way. Example, they have the fresh fish, but Japan, the fresh fish uses sashimi, but Peru use fresh fish, make the called ceviche, cooked with the lemon juice. You know, never use the soy sauce. First time I eat this, kind of the, wow. So then after this one, my open eye more, my cooking style that change, combined to Japanese style and another country food, then make a novel style.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome back. This is the opening trade. We are 30 minutes into today's session. Across the benchmark, we're seeing gains of 0.3% after the losses of yesterday. A bit of a turnaround then. The DAX currently up just 0.1%. It's stronger over in France, lifted by the luxury space. Some big gains there for some of those names. LVMH in the mix, of course, up 0.5% then on the CAC Garant over in France. The FTSE 100 up 0.4%. Some of the financial services and asset managers doing quite well as well today. St James's Place is one name in focus here on the FTSE 100. Guy, what are you looking at?
In terms of the breadth, what we're looking at is a 2-to-1 ratio, gainers versus losers. Let's call it 400 up, 200 down. That is the ratio you're looking at in terms of the market's internals. What you are seeing, though, is light volume today, which is interesting. We're going into a weekend when I think there's probably significant risk out there on the geopolitical front to watch out for, so pay attention to that. Single stocks, Montclair is out with very strong numbers this morning, particularly driven by China, which definitely appears not past peak puffer. That stock is up by 10%, nearly 11%, so doing very well this morning. Kingspan Group, the Irish construction company, this is where you see maybe the AI construction story benefiting some of these names in Europe. Its stock is up very nicely as well. Casilium's up by 8.54. So there's some interesting single stock names that we are watching out for. In terms of the downside, let's take a look at what we're seeing here. So Nestle is a little bit softer this morning, but actually where I really want to focus is some of these oil names. BP, Total, Shell, also down today. It's really interesting, actually. If you look at the FTSE 100 and the internals within the FTSE 100, some of the oil stocks are the biggest drags. Some of the defense names are some of the biggest drags as well, which is interesting going into a weekend when you see potentially big geopolitical risk coming out of the Middle East, Tom.
Here's what else you need to know then, and on that topic, a growing contingent of US military forces in the Middle East is escalating tensions in the region once again, as the US president ramps up pressure on Iran to strike a nuclear deal. Trump saying that Iran has 10 to 15 days at most to strike a deal over its nuclear program. Blue Owl shares plunged in New York after the alternative investment firm said it will restrict withdrawals from one of its retail-focused private credit funds. The company says the fund will instead return capital through periodic distributions funded by loan repayments, asset sales, and other transactions. The move highlights the risks confronting retail investors entering the fast-growing private credit markets. The Financial Times reports Nvidia is close to finalizing a $30 billion investment that will replace the long-term $100 billion commitment agreed on last year. The investment is part of a funding round that will value OpenAI at $730 billion US dollars, not including the additional funding. Guy.
Okay, let's talk about some of the data we're getting out of Germany right now, which is coming through actually fairly strong. But it's interesting that the manufacturing sector is not now necessarily where the strength is. Germany's services PMI comes through at 53.4. That is up from 52.4 last time round and is well ahead of expectations. German services are doing well right now. The composite number, therefore, is lifted up to 53.1, which again is above expectations. So this is a services story coming out of Germany. What you're not necessarily seeing is as big a pickup when it comes to the manufacturing data. So Germany's manufacturing data comes through at 50.7, which is a good number and is up from the 49.1 and is above the 49.5 that we were anticipating. But it does seem as if where we're seeing the real strength this morning is in the German services story. But the German economy certainly producing a kind of much more positive surprise than one we're seeing out of the French economy, which is really struggling for momentum. Joining us now to discuss all of this, Catherine Nice, Chief European Economist over at PGIM Fixed Income. Good morning, Catherine. Nice to see you. What do you make out of the contrasting stories we're seeing on the PMI front from France and Germany?
Well, it's not surprising that France is not doing as well as Germany. But let's start with the good news. I mean, I think this is a really good sign that growth in Europe is broadening out. We saw in the last couple of years, it was really the peripheral countries, you know, your Spain, your Italy, your Greece's, really driving growth in the region. And now we're seeing more of a broadening out to the core, including Germany. This is very much what people were expecting. And I think although maybe the numbers are a little bit disappointing on the French side, I think they could have been a lot worse, all things considered. And now with some of the uncertainty around the French fiscal picture really kind of put to bed, at least for the next couple of months, I wouldn't be surprised to see those numbers start to improve as well. So I think this is very good news for the euro area.
How much momentum does Germany have right now? Let's just focus there for a moment. It's taken a lot longer, I think, than some people anticipated to get the economy moving. It appears now to be moving. What's the upside here? How much better could these PMI data get?
So I think, firstly, fiscal, generally speaking, does have an impact with a lag. This is why when economies experience, cyclical weakness, it's really the monetary authority that tends to be the first mover because their tools can just impact economic activity much more quickly than fiscal can. So it's quite normal that fiscal support does take a long time to feed through, especially if it's targeted at things like public infrastructure projects, which require a lot of planning and organization, etc. So I think the timeline that we're seeing in Germany is not at all surprising. Now, in terms of your question about what's the impact, I think we've got to remember the amount of money that the German authorities are throwing at this problem in Germany is vast. And even if it's spent on things that people could argue about, it could be spent better, we could see more reforms, etc. The bottom line is that it's a lot of spending and it is going to have a big impact. You're talking about a delta on German growth that's going from something like 0.1 to 1. So it's pretty big. And I think we are seeing some really good signs of momentum that collectively should give us pretty high conviction that this is going to deliver.
Catherine, good morning. It's Tom. Is that enough momentum to pull the ECB off the sidelines?
What exactly do you mean? I mean, from their perspective, they're in a good place. Growth looks decent.
Do we have to think about rate hikes from the ECB? If not this year, then next?
Honestly, they've got a little bit of a Goldilocks situation going on over there because inflation looks incredibly benign. If anything, I think the risks are probably to the downside. We're seeing the impact of products in China on the euro area. Then, of course, we've had a bit of euro appreciation. and the momentum within the euro area in terms of domestically generated inflation looks incredibly benign. So I think for now, the risks are, if anything, to the downside. But if this momentum continues, I think that, you know, what we could see is that the ECB makes an adjustment to what it thinks is neutral. So it's not necessarily a hiking cycle in the traditional sense, but it could be that that long-term neutral is just a shade higher from where they are now. But I honestly, I don't think they're quite there yet.
On the ECB, if Christine Lagarde steps down before the end of her term, does that undermine or shore up credibility?
Oh, tough one. So, I mean, my sense is that it will shore up credibility because it gives, you know, the other authorities within the EU time to really think about the appropriate sort of set of people that need to be in these leadership positions. I can see the attraction for Lagarde. I mean, to step down after all the, you know, peaks and troughs that she's been through at the ECB at a time when growth is pretty much close to potential and inflation is a target. The ECB is much more insulated, more generally, from interference than, say, the Fed. So I don't think that there's going to be as much risk, shall we say, around, you know, maybe the rules of the game changing around monetary policy in the euro area as we might worry about elsewhere.
Okay. Catherine, the reason for this potentially is that people are worried about what happens after 2027 in France, and that we could have a right-wing government that would destabilize the economic outlook. If there are signs of concern, I'm not going to go as far as panic, but there are the signs of concern that has already led to the stepping down early of the French central bank and the potential stepping down of the ECB's chief. Shouldn't the rest of us be worried about what the impact on European growth could be?
I think that this is a risk. We're going to have to see how this plays out. But a lot of the risk is already priced in. I mean, we've been having a difficult situation in France really for well over a year. You know, as we get closer to the French election, markets, you know, are going to have a better idea about how to price this risk near term. But, you know, this is not sort of popping up out of the blue. It's something that people have been thinking about for some time. And, you know, there is a bit of time between now and 2027. I think it's quite natural for people to, in leadership positions, to look ahead, to think about, to think about, you know, putting in people in positions, in leadership positions when they have the authority and the discretion to do so. This is not particularly unusual. And the sort of set of candidates that people are talking about all strike me as very credible, competent candidates. Turning to France and the risk there, you know, things have gone a little bit quiet. We do have some regional elections coming up that you know, could give us something to think about in terms of going forward. But when I think even about some of the mood music coming out of, for example, when Bardella has spoken previously, I have heard, sort of reading between the lines, you know, that there is going to be a respect for EU fiscal rules, etc. And so maybe this will be less impactful for markets than maybe what people fear.
Just briefly, want to get your take on the UK, Catherine, before we let you go. So the UK, we're seeing gilts gaining again today. Gilts have had a good couple of weeks, so yields down again. The benchmark is at 4.33, the 10-year, the 2-year at 3.56. The UK posting its biggest ever budget surplus. Is there further room to run, do you think, for the gilt rally that we're seeing, further downside for yields?
So I'm going to confess I've been quite dovish on the Bank of England. I do see scope for them to play catch up and to bring rates down decisively over the next couple of months in the run up to the summer. I think people are discounting the potential for sort of a virtuous circle to take hold, that with inflation falling back, it really gives a lot more fiscal breathing space, which in turn just boosts, credibility of the existing fiscal plans. And by April, we could see both the impact of the fiscal measures that Reeves has announced, plus the lower interest rates, really start to, inject a bit of a feel-good factor for UK households and firms. So I think people have discounted that possibility. I don't want to look like I've only got rose-tinted glasses on, but I think we are seeing shades of that. I mean, retail sales today were pretty good, and as you say, the revenues are a bit stronger in part, because of these lower interest rates. So I think it's really not all doom and gloom, and actually the UK economy is doing, reasonably well considering the challenges.
Well, look, we like ending on a positive note on a Friday, so thank you for that. Catherine Nice, Chief European Economist at PGIM Fixed Income. Now, switching focus, shares of the biggest private investment managers on Wall Street tumbling after Blue Owl said it would no longer allow for redemptions from one of its retail-focused private credit funds. It's a complicated story, but we have now Bloomberg senior reporter Silas Brown to walk through what exactly is going. What is happening then in the credit market?
Yeah, so you're right. The shares of the largest private capital managers, that includes Ares, Apollo, Blackstone, and Blue Owl, have tumbled yesterday off the news of this kind of slightly chaotic unwinding of one of Blue Owl's historic BDCs, and I think. There's a tainted sort of cocktail of concerns going on in private credit. One of them's around loan valuations and the kind of ability to mark loans effectively. The other is a concern about a kind of broader concentration risk around software and the threat of AI. And I think Blue Owl has kind of seen itself, and is seen by many as the kind of poster child of the success of private credit, and it now is kind of carrying the burden of that responsibility.
I just want to get a little bit more specific in terms of what is happening here. Blue Owl, what is it saying in terms of redemptions?
Yeah, so this is you're right. I mean, it's a very nuanced picture. This was a fund that, unlike most BDCs, was not a kind of perpetual vehicle. Yeah. So there was a natural unwinding that was going to occur. They tried to do this through a merger of a public entity. Yep. That was then scrapped, and it was a sort of boisterous response from investors. And so they then have decided to do this kind of alternative thing, which was to sell slivers of the direct lending investments and basically repay investors through those sales. Yep. And they've sold it to 4 institutional investors, one of which, interestingly, is Blue Owl-owned insurance vehicle. And so I think they see this as a quite positive outcome. And by all accounts, some analysts agree. I mean, the loans were sold at close to par. I think that does show a degree of resilience in Blue Owl's credit portfolio.
There was a lot of talk yesterday about effectively redemptions not being allowed in this fund. Is that actually the case, or are they just winding the fund down?
So a normal BDC would get redemptions quarterly, and this is a different route. So that they are not doing quarterly redemptions in the same way as they did do. What they're doing is they're selling assets, and then with the proceeds of those sales, they are distributing that cash to investors. So it's a kind of slightly complicated.
So money's not locked in. The money's going to come back. It's just going to happen at a different cadence.
Different cadence and different method.
Okay. So, just a BDC.
Yeah.
A business development company, then.
Accurate.
Yeah.
So according to Gemini, a type of closed-end investment fund established by Congress in 1980. Is this less about credit quality, what's sitting on the books, and more about a run on the banks, basically?
So I think this is a very good question, and I think this is the heart of the issue. I think private credit fund managers have for years said one of the great strengths of the market is that we don't have liquidity duration mismatches in the way that other financial markets have. And I think through BDCs and their insatiable appetite for retail cash, I think that this does expose a degree of vulnerability for the market because, the clue's in the name. This is a private, untradable asset class. And so they do have problems with illiquidity. And so I'm not suggesting that necessarily this is an issue in this specific instance of Blue Owl, although they have had investor withdrawals in another bigger fund as well that are substantial. But I think what it does is show there's a kind of glint here that I think is concerning investors in the public markets, I think, which illustrates some of the tumbling, the consequences, behind the tumble.
you bring some clarity to the complexity, Silas. Thank you very much indeed. Really valuable insights. Bloomberg's Silas Brown covering that story for us. Coming up, billionaire Steve Cohen has taken the top spot, so from private credit to hedge funds, on Bloomberg's annual list of the world's best paid hedge fund managers for the first time. How much was Cohen's total earning from his hedge fund? 0.72, of course, last year, just in a single year. The answer when we come back. This is Bloomberg.
Estava sitiada.
Nisso eu começo, eu não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering, and someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Nisho talagi kon ahmalep ahmata suara pangop ahmalep manjang lenya ay kun mamanya.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Haslida Amin in Davos, Switzerland, and this is Bloomberg.
February 24th, as affordability, immigration, and national security dominate the headlines leading into the midterms, President Trump will deliver his State of the Union address. Balance of Power will bring you live global coverage starting at 8 p.m. Eastern.
Welcome back. Now, before the break, we asked you how much did billionaire Steve Cohen make from his hedge fund, 0.72, last year, in a single year? The answer, drum roll, 3.4. Let's bring up the number, 3.4 billion US, 3.4 billion US dollars. That works out, by the way, to more than $9 million a day. Not bad for a day's work. Cohen has taken the top spot on Bloomberg's annual list of the world's best paid hedge fund managers for the first time. In less than a decade, Point72 has added 12 offices, more than doubled its global staff to 3,000, and expanded the number of its trading pods to more than 190. Guy.
Quite like sport as well, which is interesting. Okay, let's talk about what is happening out there right now, what we are watching. Oil touching its highest level in 6 months. This after President Trump said Iran has circa 15 days to reach a deal over its nuclear program. Ziad Dawood, Chief Emerging Markets Economist for Bloomberg Economics, joins us now from Dubai to talk about this. Ziad, how do you see this playing out? The oil market has added a little bit of premium. What kind of risk are we looking at here that prices go significantly higher from here in terms of how the market needs to price this risk?
Well, I think if you look at the geopolitical situation, Guy, there's on the U.S. side, we're seeing the biggest mobilization of U.S. military assets in the region since 2003. We're seeing a deadline, a 10 to 15-day deadline from President Trump to Iran. And on the Iranian side, we've seen threats from the Iranian leadership that the conflict could spread to the wider region. And we're seeing basically fire drills from the Revolutionary Guards that are resulted in the temporary closure of the Strait of Hormuz. That's big risk to oil. The degree of risk depends on how wide the conflict spreads. If it remains confined to Iran, we're talking about 5% of global supplies. If it affects the Strait of Hormuz, we're talking about 20% of global oil supplies. If we're talking about the wider region beyond Iran, that includes Saudi Arabia and Iraq and Kuwait and the wider Gulf, we're talking about 1/3 of global oil supplies. That's a lot of oil at risk that is very hard to replace. And that's why we're seeing war risk premium in oil, which we estimate today is about $5 per barrel.
Wow, yeah. So from 5% to 20% to maybe 1/3. I mean, that's a big range and a lot of variations. What is being priced in right now?
So we track the daily geopolitical risk premium in oil prices. We have that available in the terminal. And currently, we estimate about $5 per barrel are due to the Iran war risk premium. To understand that in the wider context, it's important to just figure out, just to have three levels of oil that are important. There was a $60 oil per barrel that we had before the escalation with Iran. There is a $72 oil per barrel that we estimate where oil will head to if you get complete outage in Iran. And there is $108 per barrel where oil will head to, according to our estimates, if you get the closure of the Strait of Hormuz. The fact that prices have moved by $5, that tells us there is the markets are pricing a probability that you're going to get some outage, probably from the Middle East.
Okay, Ziad Dawood, really important update for us of Bloomberg Economics. Currently, Brent trading a little softer in the session, down 0.3, but holding above $71 a barrel. WTI at 66. That divergence is still there. WTI down 0.2%. Here's what else to think about through the day then. 9 a.m. UK time. So in the next couple of minutes, we're going to get Euro area followed by UK PMIs. That's at 9:30. The US PCE data and GDP data due at 1:30 p.m. UK time as well. Plus, we're going to get US PMIs at 2:45 p.m. 3 p.m. UK time, we're going to be watching the Supreme Court as they mull the future of Trump's tariff campaign, and more Fed speak from Laurie Logan as well.
After you get through all of that,
yes,
there are interesting things happening elsewhere. It is almost the weekend. You've got the curling this weekend, curling tonight.
Yes.
Goals.
So Great Britain versus Canada.
Yeah, beat the Swiss.
Beat the Swiss, very close.
Yep.
What was it, 6-5?
No, I think it was a bit more than that, actually. But yeah, it was a surprise that we were so
beat the Swiss.
That we were so convincing.
So the Canadians have been embroiled in Touchgate.
Yeah, we'll call it that.
Nudging, touching.
Not going to go down this road too far.
What's it called again?
I don't know, the rock.
The rock.
No, it's not the rock. It's the stones.
The stone.
My mind went blank then. London Fashion Week this weekend, which I know you'll be paying a great deal of attention to.
Absolutely.
You got the BAFTAs, which actually I think you probably will be paying attention.
I'm interested in the BAFTAs. Generally interested in the BAFTAs. You though.
Six Nations coming up.
Six Nations. I mean, Scotland, England. That was a bad
setup, wake-up call. The Scots after losing to the Italians, the Scots were all over it. The England need to come back and beat the Irish. We'll see. T20, I think, is kicking off this weekend as well. I think you got the ice hockey final. I think that's Sunday.
Oh, that will be fun.
Massive weekend of sport.
Elbows up.
Oh yeah. It's been some great ice hockey. Actually, the game I was watching, the women's game last night, fantastic game. Anyway, let's talk of the weekend. We've got some great Bloomberg weekend newsletters coming out as well. Just pay attention to that as well as you watch the sport. You can do two things at once. Have a great weekend, folks. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance. Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
You know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romain Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Oil hits a 6-month high and stocks edge lower with risk sentiment hit by escalating tensions in Iran. U.S. President Donald Trump says Tehran has 15 days at most to reach a deal over its nuclear weapon program. Washington has carried out the biggest military buildup in the Middle East since 2003, before the invasion of Iraq. And Britain records its biggest monthly budget surplus on record, providing welcome relief for the Chancellor, Rachel Reeves. Let's check in on how global markets are faring. With geopolitical premium building up in many of these markets, the handover from Asia Pacific quite cautious today, but S&P futures leaning towards positive. A lot of focus on the data that's coming later this afternoon, PCE data, GDP data, as well to watch out for, and personal spending figures. The USD also seeing a bit of a bid on back of this geopolitical uncertainty in the Middle East region. And Brent, we were at $72 a barrel about a couple of hours ago. We've pulled back somewhat, but still we are tracking weekly gains. And actually, Brent is sitting at the highest level in the last 6 months. And then gold also catching a bid. We are trading above $5,000 this morning. And some breaking numbers coming through from the Eurozone. We have the Fed composite PMI numbers just dropping now, coming in at 51.9 versus a forecast of 51.5. So we have broken through the forecast to the upside, beating estimates. And earlier on in the day, we had the German composite PMI number also beating estimates, coming at 53.1 versus forecast of 52.3. Similar story for France as well. So better PMI numbers coming through for the month of February in the Eurozone. Let's take a look at how some of these European markets are faring in the first hour of trading. And you can see here that we're brushing off some of the uncertainty around geopolitics in the region. There's a lot of green on the screen, as you can see, with big performance on continental Europe. And most of these indices are up, and also paying attention to some of the earnings that are dropping as well. So a more positive start for Europe. And for the conversations that matter and the insights you need, let's get started with the Pulse.
Newsmakers and market movers. This is the Pulse.
Good morning and welcome to The Pulse. I'm Joanna Bersecci in Dubai, filling in for Francine Lacroix today. Let's start with that breaking news on European PMI numbers and bring in Bloomberg's Alex Weber. So, Alex, just looking at this, we have seen a jump in the composite PMI higher than forecast. Talk us through these numbers.
Yeah, the headline number is certainly reassuring. It confirms that we're sort of gradually continuing to grow in the Eurozone. But I think the real takeaway from today's numbers is when you look at the manufacturing sector, especially in Germany. And there the PMI indicator jumped to above 50. That's the level that indicates growth for the first time since 2022. So that's a real milestone that we've seen here. And that's obviously because of the massive government spending we're seeing in infrastructure and defense. The advance in the index was driven by new orders. So that just shows that this whole transmission of fiscal policy is starting to work, and it should translate into higher growth for Germany and for the broader Eurozone.
Yeah, pretty remarkable that Germany's manufacturing sector grew for the first time since 2022. It's been a really long time since the manufacturing sector actually grew in Germany. What does this all mean, though, for the European growth outlook as a whole?
So for now, I would say it mostly confirms the assumption that we're going to see a pickup, especially in Germany. Germany only grew 0.2% last year, and that's expected to pick up to somewhere around 1, somewhere north of 1%. So you need to see this kind of momentum for that to become true. We've already seen some signs in the factory orders at the end of last year. Now we need some further confirmation from production numbers. We're also going to have new business sentiment surveys on Monday. Those have tended to be a bit more negative. We're going to see if those pick up as well. And then this will also translate into somewhat stronger growth for the Eurozone in the coming quarters.
Bloomberg's Alex Weber, thank you so much for bringing us the latest on those PMI figures. Let's turn to geopolitics now. A growing contingent of U.S. military forces in the Middle East is escalating tensions in the region once again, as the U.S. president ramps up pressure on Iran to strike a nuclear deal. President Trump has now signaled limits to the diplomatic process, setting a 15-day deadline for Tehran to reach a deal. Let's speak to Ziad Dawood, Chief Emerging Markets Economist for Bloomberg Economics. Well, Ziad, there's been days of speculation now that the U.S. are readying themselves for an attack on Iran. And I think the president was pretty explicit. He's essentially said there's a 10 to 15-day window in order to get a deal done now.
Yes, Jemima, I don't know, will it be an understatement to say that something serious is simmering here in the Middle East where we are? I think if you look at what the U.S. is doing, it's amassing the largest military mobilization since the invasion of Iraq in 2003. We have the 10 to 15-day deadline from President Trump to Iran. And there were news reports about, the U.S. strikes on Iran would be long, would be big, and will come sooner than we might think. And if you look at the Iranian side, they're not de-escalating either, right? Yeah. So they're doing military drills that are resulting in the temporary closure of the Strait of Hormuz. The Iranian leadership is saying if there are strikes on Iran, they're not going to stay in Iran, they're going to spread to the wider region. It's hard to escape the following conclusion, that the U.S. strikes on Iran are probably going to come, and that the Iranians will probably not limit themselves to symbolic attacks like they did in the past.
Okay, well, words of foreboding there. It's interesting because most of the times, and you know this, whenever we have a geopolitical flare-up in the region, markets tend to react very briefly and then move on past it. But I wonder whether this time may be different, and whether actually, if there is a serious regional escalation, I'm not just talking about Iran, whether there could be implications for the global economy at this point.
Yeah, what has happened, the translation from Middle Eastern geopolitics to the global economy happens through oil. And what we've had in the last 2.5 years, we've had unimaginable escalation on the geopolitical side in the Middle East. Things that we didn't imagine would happen did happen. And on the other hand, oil prices are $20 lower than they were before October 7th, 2023. Yeah. The question is, Iran will put this to another test. U.S. strikes in Iran will put this to another test. Yeah. And markets are not pricing zero geopolitical risk premium. We track this on a daily basis. And we estimate that markets are probably pricing in $5 into each barrel of oil as a premium on Iran.
Yeah, I do want to ask you, and we have an oil segment coming up, but just with the lens of an economist hat, how influential this region is looking ahead in terms of the marginal price of where oil trades? Because, you could make the case that the U.S. has become a lot more independent in terms of where its oil needs are derived from. Most of it is coming from domestic production. And so actually, the situation today is very different from how it was historically in the past in terms of the ironclad hold that this region, specifically Iran, might have over oil markets.
True. Let's look at oil and then look at the energy mix. If you look at oil alone, Iran produces about 5% of global oil supplies. The region as a whole, once you include Iraq and Saudi Arabia and Kuwait and the UAE, we're talking about 1/3 of global oil supplies. And that's oil. Now, you might argue that oil is becoming less important as an energy sort of input to the world with the rise of renewables and other items. If you add up the oil and gas that comes from the region, and you look at as a share of the total energy mix, the region provides or supplies about 15% of the global energy needs. That is unchanged from the 1970s. Yes, oil is becoming less important, but gas is becoming a more important energy input, and the region is producing more of it. And guess where it's coming from? It's coming from one oil field that's shared by Iran and Qatar.
Okay, well, there you go. I got my answer then. Ziad, thank you so much. A chief emerging markets economist for Bloomberg Economics. Well, let's talk more about oil prices, which have risen some 6% over just the last 2 sessions on those U.S.-Iran tensions, sitting at a 6-month high now. Joining us is Anthony DePaula, our Middle East energy markets reporter. So, when I look at the price of oil here, I just wonder how much of this geopolitical premium is accounting for an actual potential hit to Iranian exports versus an actual potential disruption to the Strait of Hormuz. How are oil traders thinking about this?
Hi, Jumana. Good afternoon. Yeah, I would say that I would put the hit to exports and the hit to production kind of in that same risk basket. And I don't think we're seeing that in the oil price yet. I think what we're seeing right now is a risk premium related to the risk of this elevated tension, the risk around the probability that something is likely to happen, as you just had Ziad on talking about. So we've been hearing from investors and analysts and traders that they're looking at something on the low side, a $3 to a $10 on the high side risk premium related to the possibility of some kind of activity, some kind of attack in Iran. And that's what we're seeing now. Pretty much the high side of that risk premium in prices right now from where we started when we started looking at prices at the start of this latest escalation. So while we're at that peak of that risk premium, if we do get some actual attack and we get some actual impact on production or exports, oil is going to shoot above that. We will see a spike if there is an attack, and if there are reports of any infrastructure being hit. We've not only got the risks to the Iranian infrastructure and the exports, but also the risk of what will be an Iranian retaliation and whether that hits other oil producing and exporting infrastructure in the region, in countries like Saudi Arabia, the UAE, even Iraq. So those countries are all potentially at risk if there is a bigger Iranian retaliation than we saw in June. So these are all factors that could push the oil price even higher than where we are now, Jumana.
Yeah, so it's not just the first derivative, the second derivative as well needs to be accounted for. But Anthony, if you rewind back to last June, if you think about OPEC Plus and how much the group has actually put back in terms of extra oil production to the market, this time around, how much spare capacity are they actually sitting on and are capable of supplying the market with, should there be a big disruption coming through from Iran?
Yeah, well, this speaks to, I think, kind of that question that you were talking about before about how influential the Middle East is in terms of oil markets. And the Middle East is still influential because they are that swing producer. This is the region where they keep oil supply fallow, say, not being produced, so that they can bring it back to the market at a time of emergency. Of course, as OPEC Plus increases production, that cushion of unused spare capacity gets smaller and smaller. And really, we're talking about that cushion being the smallest that it's been in a long time, because as OPEC Plus has increased the production through the autumn. Right now, they're in a pause period during this first quarter, so they're not increasing production at the moment. But Saudi Arabia is up to about 10 million barrels a day of production. out of a overall sustainable capacity of 12 million barrels. So that leaves them that 2 million barrel a day cushion, which is not enough to replace Iran's production, which is much higher, over 3 million barrels a day. Plus, if you do see some impact on exports from this region, of course, Saudi Arabia, the UAE, Iraq, they all export through the Persian Gulf, through the Strait of Hormuz, which Iran threatens to close, to block again and again. It has never happened, but that's always a risk that the oil market is looking for. So that spare capacity has been reduced a little bit. Most analysts and traders will think that the UAE is producing above their quota, so that limits their spare capacity. So really, when we look at spare capacity, we're looking mainly at Saudi. It's about 2 million barrels a day. The oil market will react negatively, meaning price going up, if there is any hit to production or exports. And then it will probably have another additional negative reaction, meaning potentially higher prices, if it sees that spare capacity too tight to meet that demand. So we are kind of in a period where the spare capacity is tight. At the same time, under normal market conditions, as you and I have talked about over the last year, we've been looking at a glut in the oil market. That has kind of been canceled out because we've got all this geopolitical risk on the price right now.
Yeah, absolutely. And not many people saw this coming. Anthony DePaola, our Middle East energy markets reporter, thank you so much. Well, Anglo-American investors are focused on the miners' combination with Teck Resources to create one of the world's biggest copper mines. The CEO, Duncan Wanblad, spoke to Bloomberg earlier about expectations for the merger.
Our expectation was that the time to completion would be somewhere between 12 and 18 months. So that would put us somewhere between September of this year and March of next year. And I believe we are absolutely on track as far as that's concerned. So we have had no indications from China, either positively or negatively. We are in a process with China, and this is moving at the speed and the pace that we expected it to do.
On the diamonds business, on De Beers, Duncan, you talked about the complexity given the market. What is your sense as to where we are in the market journey, where we are in terms of that competitive threat, the softness in the Chinese market? When do the conditions become good to get this across the line?
Yeah, look, a number of things are sort of impacting. I think this time last year I said, well, we were slightly hopeful that we were starting to see some green shoots insofar as we were starting to see a net positive inflow of diamonds back into China. We were seeing very, very robust activity for polished goods in India, and the US was stable to improving. So these are three key big markets for diamonds. But at the same time, of course, we saw massive production increases, particularly coming out of Angola during the course of the year, which put quite a lot of pressure on pricing. And at the same time, the lack of a trade deal between the US and India resulted in a 50% tariff on all Indian goods, and the vast majority of rough diamonds go to India for cutting and polishing. So those were sort of the impacts during the course of the year. But the fundamentals in terms of what changes diamonds, I think, is just the time it takes for hopefully this trade deal to be done. But secondly, the time it takes for consumers to fundamentally realize the difference between lab-grown diamonds and natural diamonds from a value perspective. And certainly we are seeing that today.
That was Anglo-American CEO Duncan Wanblad speaking to Bloomberg earlier. Well, coming up, we discuss risk-off sentiment as well as the Fed and the AI trade with Lala Connor, global market strategist at eToro. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
February 24th, as affordability, immigration, and national security dominate the headlines leading into the midterms, President Trump will deliver his State of the Union address. Balance of Power will bring you live global coverage starting at 8 p.m. Eastern.
You are watching The Pulse. I'm Joanna Versace in Dubai. Now, oil rose to a 6-month high and stocks trimmed losses as escalating tensions between the U.S. and Iran weighed on risk sentiment. Joining me now is Lale O'Connor, global market strategist at eToro. So, Lale, I'm going to start with just the geopolitical developments and whether one should be heading into the weekend concerned about the real possibility of military action in Iran and how you're thinking about it from a market's perspective. Should people be hedging for a potential escalation here?
Sure. Look, the market is thinking that this is a negotiating tactic. Obviously, it's creating demand for safe haven assets, such as the U.S. dollar. I think that will continue heading into the weekend and maybe next week as well. Expect more increase in price of gold and other sort of like more safe haven assets. So, and of course, it will create volatility in the markets, and that's expected.
Yeah, I mean, the main winner always seems to be gold in this situation. No matter what happens, uncertainty anywhere, gold seems to be a winner. But let me just talk to you about the recent batch of data that's come through from the U.S. Surprising to the upside. We had an upside surprise on the labor market data. And then the Fed minutes this week, also quite hawkish as well. How do you think that creates a setup going into the second half of the year with what will be a new Fed chair and pressure on the Fed chair to cut interest rates?
Sure. Look, I think for rate cuts, more or less, we're expecting 2 rate cuts. I don't think the new Fed chair does change that scenario much, but I think what it changes is the fact that he really doesn't like QE, that he wants to see a tighter, a smaller Fed balance sheet, and therefore that has implications that will play out in the next few years. It cannot play out in a short period of time because it would create funding stresses in the markets and volatility and sell-off as well. But it's quite important. So what we're saying is that, you know, for him to be able to pursue quantitative tightening again, he needs to make sure that financial deregulation is going to be in place, which I think is going to be the theme this year, for them to be able to, again, increase banks' balance sheets, where banks can take on, say, more long-duration treasuries and maybe even MBS. So I think this is the story for the new Fed chair. Regarding the data, I think that, you know, soft landing still intact. It could be the case that if oil prices stay elevated for longer, that would spill over to long-term inflation expectations and therefore might complicate Fed's reaction function. But it's too early to say that is going to be the case. Again, what we know so far is that this is a negotiating tactic.
Yeah, the other thing I've been watching this week is just how well the greenback has performed. And for once, you are actually seeing money go into the dollar with the uncertainty in the air. It is acting like a safe haven, the best week, I believe, since October. Do you think the decline in the greenback is coming to an end now because of the reasons that you just cited as well, potential quantitative tightening alongside a slightly more hawkish leaning Fed?
I think it will stay soft, Jomana, for some more time. Again, it's very much tracking what we've seen Trump 1.0, where it's declined by around 10% since the beginning of 2025. So I would say that, downward pressure coming from the rate cutting cycle is going to impact the US dollar. And let's not forget this administration wants a more sort of like competitive U.S. in terms of trade, right? But at the same time, they don't want to lose the U.S. dollar's reserve currency status. They don't want to lose its sanctions role as well. And therefore, they are managing that depreciation. However, as you said, come second half of 2026, we might see some elevated pressure on the U.S. dollar, but I don't expect it to be nowhere near 2022, 2024 levels.
Yeah, and, it's interesting what you say about the U.S. administration actually advocating or wanting a weaker USD because, in theory, it should help with trade. But actually, if you look at the trade deficit numbers that came through yesterday, the trade deficit, U.S. aggregate trade deficit for 2025 was just as big as it was in 2024. On the flip side, this morning, you're looking at a massive UK surplus. And I think, it really just goes to show how the difference in the budget situation can actually influence where a currency is heading. I'm curious to see how you're thinking about the pound from here. On one side, perhaps you've had the weakness of the USD play out, but on the others, you have, the better budget dynamics. At the same time, a Bank of England that's likely to start cutting in the next month.
Correct. We do expect the Bank of England to cut. I think inflation numbers are heading in the right direction, and that will put some pressure on the sterling vis-a-vis the U.S. dollar. Now, for trade deficit, of course, these things play out over multi-periods. So it's not going to be the case that, the Trump administration is pursuing a competitive trade agenda, and therefore you will see that coming to the data right away. It's not going to play out right away. I think it's going to play out over a period of time, and therefore the impact on the U.S. dollar as well.
Yeah. What is your read of the earnings season, respectively, that we're getting between the U.S. and some of these European markets? Because, again, you could point to the data suggesting that the earnings growth actually is coming through from the U.S. and not in Europe, but European markets are outperforming.
Sure. I mean, U.S. earnings growth is around 14%, which is healthy. Again, it's very much driven by tech, communication services, industrials. Although when you look at the beats, you see that, beats are lower than what we've seen in the past few quarters. So it really tells me that actually the environment is coming to a point where, for instance, investors will be more discerning in terms of not really rewarding last year's spenders for this year as well. They really want to see execution, especially from these capex, high capex spenders. So in Europe, very similar story as well.
Yeah, big questions for the second half. Lale O'Connor, global market strategist at eToro, thank you so much for joining our show. And coming up, President Trump says his Board of Peace has received about $17 billion for Gaza. More details next. This is Bloomberg.
climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are gonna kill everybody. So we gotta figure this out. And we're not gonna do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg. Good morning and welcome to The Pulse. I'm Jemana Bersecci in Dubai, and these are your top stories. Oil hits a 6-month high and stocks edge lower with risk sentiment hit by escalating tensions in Iran. U.S. President Donald Trump says Tehran has 15 days at most to reach a deal over its nuclear weapon program. And Washington has carried out the biggest military buildup in the Middle East since 2003, before the invasion of Iraq. And Britain records its biggest monthly budget surplus on record, providing welcome relief for the Chancellor, Rachel Reeves. President Donald Trump said his Board of Peace has received roughly $17 billion in pledges towards humanitarian and reconstruction efforts in Gaza. Trump made the announcements during the group's first meeting in Washington. He said the U.S. would contribute $10 billion, which was a small price to pay to secure lasting peace.
The United States is going to make a contribution of $10 billion to the Board of Peace. Thank you. And we've had great support for that number. And that number is a very small number when you look at that compared to the cost of war.
Well, we're joined by Bloomberg senior Middle East reporter Sam Daher. Sam, so this inaugural Board of Peace meeting took place yesterday, typical Trumpian event. Maybe just walk us through some of the highlights. Who was there and also who was not there?
Absolutely. I mean, obviously, there was a lot of pomp and circumstance and razzmatazz, as we say. Trump spoke for almost 47 minutes and calling out all the leaders that were there. Obviously, there were notable absences from the European side. We only had Bulgaria and Hungary, who have become members of the Board of Peace. The European Union sent an official as an observer, so that tells you a lot. I mean, one analyst I spoke to said Trump, in a way, this peace board is a way to ally with so-called middle powers like Turkey, Saudi Arabia, the UAE, and others to work outside the UN system, which his administration believes is broken, to try to resolve some of these intractable conflicts. Chief of them, the Arab-Israeli conflict.
Yeah, well, the UN have estimated that reconstruction costs could get up to about $70 billion for Gaza. Yesterday, an announcement of up to $17 billion. You say that is one of the big takeaways from this, and that they did secure some pledges?
Right, and obviously the announcement on the International Stabilization Force, the ISF. You had countries like Indonesia say they'll send 8,000 soldiers potentially, and others also pledging to send forces. And also there was an announcement that a police force in Gaza is being constituted. This announcement was made by Nikolai Mladenov, the High Representative for Gaza, and he said 2,000 people have signed up already. But the biggest question here is, and whether any of this moves forward, including the ISF. I mean, no country is going to send their forces until it's clear how the disarmament of Hamas is going to play out.
Exactly.
And Israel has said Hamas has 60 days to disarm, right? So I think reconstruction, sending the ISF, even getting the body that was formed, headed by Dr. Ali Shah, that's now in Cairo, to actually move to Gaza to administer the day-to-day affairs. I mean, all of that is tied to how things are going to be resolved on disarmament.
Yeah, ultimately, that's a sideshow compared to the bigger task at hand, which is that question of disarmament and a big focus of Israel. Sam, thank you so much. That was Bloomberg's Sam Darir on Trump's border peace. Now, in the last couple of minutes, we also got some breaking data coming through from the UK. So also PMIs, the UK composite PMI has risen to 53.9. That is versus the forecast of 53.2. That's the composite number. And a lot of that was driven by the manufacturing figure, which rose to 52 versus the forecast of 51.5. But the services PMI figure in the UK actually fell to 53.9. This is versus a forecast of 53.5. So actually still a beat versus expectations. And those are the figures that are coming through from the UK. When we also had European PMIs just a short while ago as well, indicating a better number than what had been priced in. Now, let's talk about the U.S. trade deficit. It hit $901.5 billion in 2025, one of the highest levels since 1960, as a year of aggressive tariff policies led to volatile swings in imports and exports. Now, while the gap with China narrowed to a 20-year low, the deficit widened with Taiwan to a record. For more, we're joined by our trade expert, Brendan Murray. I will say, Brendan, it was surprising to me when I saw these figures, just how wide the trade deficit still actually is. And you would think that maybe U.S. consumers would have modified behavior on back of the tariffs. That doesn't appear to be the case. So what did drive the trade deficit to these levels?
Yeah, I think there were two main takeaways. The first one is that President Trump's tariffs on imports are shifting trade flows rather than shutting them off. And you can see that with the different trade relationships. The bilateral trade with China is way down, but it's way up with Mexico, for instance. It's way up with Vietnam and Thailand. The other issue is there are a lot of imports that are exempted from tariffs, and those include computer equipment, chips, and things that are fueling the AI boom that are coming from countries like Taiwan. So there are holes in the tariff wall around that President Trump has built around the U.S. economy, and yesterday's report showed us exactly where those flows are shifting around and what goods are still allowed to get into the U.S. tariff-free.
But ultimately, has there been a rerouting of trade away from China? Is that showing up in the data?
It absolutely is. You can look at the situation with Mexico, for instance. Mexico's trade balance with the U.S. is going to it's going to surpass China's in the next couple of months at the same pace in terms of the imbalance. And so a lot of goods, a lot of Chinese companies have set up operations in places like Vietnam, Thailand, and Mexico. And those goods are being, as the Trump administration would say, transshipped, as in rerouted around tariffs. And so that is definitely one thing that we're going to see, and the Trump administration has said that they want to crack down on, and they're trying to do that with a lot of these bilateral trade deals that are announced, like the one with Indonesia yesterday.
Yeah. Another thing that's sort of been hanging over markets, we've been waiting for weeks now on this Supreme Court decision on the legality of Trump's tariffs. It could come today. It could come in the next couple of days. What are the Trump administration's options should the tariffs be deemed illegal?
Yeah, this next opportunity comes at 10 a.m. New York time today, and we'll see if the Supreme Court has the nerve to announce its decision before the President's State of the Union. The administration has said if the ruling goes against them, they will immediately put other tariffs in place using other authorities. Those options include the main one, at least, it would be a tariff of up to 15%, but it will only last for 150 days. So the administration, if it loses this case, is going to be forced to pull together this patchwork of tariff authorities to try to replace the sort of broad tariffs that the president has rolled out since April of last year.
Brendan, thank you so much. And I'm sure we'll come back to you once we actually do get an opinion from the Supreme Court. Brendan Murray. Well, U.S. Ambassador to the EU, Andrew Puster, called Western reliance on China for critical minerals a major supply chain risk. Speaking to Bloomberg, he also said relations between the U.S. and Europe are improving despite recent tensions over Greenland.
It's improved a lot since Davos. We're working together on a critical minerals deal, which both the Europeans and the Americans recognize is essential. If we're going to go forward with an AI economy, we need to work together on that. We've got the trade deal coming up in front of the Parliament the week of March 9th in Strasbourg, and we're very hopeful that that's going to get passed and we can move on with the trade deal, which is so important to transatlantic prosperity, both in the United States and in Europe. And the Denmark, Greenland, and the United States are now negotiating a solution to what happened in Greenland. I think everybody's happy about that. I think people are ready to move on and ready to focus more on things that are going to have a material economic benefit going forward.
And I know that's something that you've been very focused on, whether it's on the trade deals, also this conversation now accelerating around rare earths. How do you see that evolving in terms of a point of overlap between the EU and the United States and trying to get sort of secure lines for those rare earth metals, particularly in the context of China? Is that something that you see progress being made on, and can you sort of elaborate on that progress?
Yeah, I think they made very, very significant progress at the Secretary of State held a ministerial in Washington, D.C. about a week ago. The European Union Commissioner Séjourné attended and made very, very complimentary remarks. The Secretary of State likewise made very complimentary remarks. All of the countries that were there realized that the West is going to be at a severe disadvantage if it doesn't have access to the processing and mining of these critical minerals on its own, where it has to be dependent on China. That's a huge supply chain risk. Everybody agrees on that. Now we need to come up with the agreements that'll solve that problem.
That was the U.S. Ambassador to the EU, Andrew Puster, talking to Oliver Crook. Now, the threat to annex Greenland has intensified doubts about the integrity of NATO. And in this week's Bloomberg Originals documentary, we take a closer look at the president's public justifications for the proposed U.S. land grab.
For decades, a 1946 U.S. offer to acquire Greenland from Denmark was a state secret. The exact offer is unknown, but U.S. diplomats had previously floated a price of $100 million in gold. But it was a non-starter. Greenland was not for sale. Sound familiar?
We need Greenland for national security. One way or the other, we're going to get it.
President Trump plans to buy Greenland. Is that how this ends?
It wasn't. But even if it had, how does one price an island that you think secures a hemisphere?
What is, for example, the value of being able to stop a missile before it hits New York City?
While the security rationale seems to be quite strong, the economic case is not so clear.
In the end, Trump relented, and many pointed to a 1951 agreement with Denmark that already gives the US wide military access to Greenland. But then again, few ever believed the issue was really just about security.
It's clear that President Trump wants to recreate the sphere of influence of the United States over the Western Hemisphere.
Greenland is very keen to do more business and trade more with other nations. At the moment, most trade goes through Denmark.
Back in 1946, at least one answer to how much is Greenland worth was $100 million. Today, it's basically more money than you could print.
And you can watch What's the True Value of Greenland now via the Bloomberg terminal. Well, Andrew Mountbatten-Windsor, former prince and brother of the UK's King Charles, has been released under investigation after being arrested on suspicion of misconduct in public office. The arrest came after further details of his relationship with convicted sex offender Jeffrey Epstein emerged. Mountbatten-Windsor has consistently denied any wrongdoing. Let's bring in Bloomberg's Michelle Hussein. Michelle, talk us through the latest regarding this investigation.
Well, Jumana, as you say, the former prince was returned home last night, UK time, after essentially spending his 66th birthday with the police. The allegation against him, the arrest was made on suspicion of misconduct in public office. And while we don't know the details of what the police are looking into, the broad assumption is that this relates to the former prince's time as a UK trade envoy and what appeared to emerge from the Epstein files, that there were confidential documents that he appears to have passed to Jeffrey Epstein. Those were documents that came to him through his role, essentially details of investment opportunities and reports on visits to different parts of the world that he had undertaken. This morning, as things stand, there is a search that is continuing on in the Windsor area at Royal Lodge, which is the property that he lived in for many years and which essentially his brother, the king, forced him to move out of just in the last few weeks, which is why he is currently living on the king's private estate at Sandringham in Norfolk in the east of England. Essentially, this is an ongoing investigation, but there are no charges at the present time.
And Michelle, what does this arrest and the investigation mean for the royal family?
Well, it's worth remembering that the former Prince Andrew has always denied any wrongdoing in association to his relationship with Jeffrey Epstein, but this does put the royal family into difficult and uncharted territory. However, after news of the arrest came yesterday, they made choices, and you can see that most clearly in the statement that was released in the name of the king himself, which essentially, when it referred to Andrew Mountbatten-Windsor, made no reference to him being his own brother, to being part of his family. It said that he learned of these events with the deepest of concern. Some of the crucial lines, I think, was where the king said in that statement, "Let me state clearly, the law must take its course." And also right at the end where he said, "My family and I will continue in our duty and service to you all," essentially separating him and the immediate family from Andrew Mountbatten-Windsor. And that, in essence, is part of a distancing that has been continuing for some years now, including during the reign of his mother and Andrew's mother, the late Queen. She was the one, after he gave a disastrous interview to the BBC in 2019, who removed his royal patronages from him, who said he couldn't wear military uniform in public anymore. Nevertheless, when she died, one of the ceremonial occasions was a vigil around her coffin, and Andrew, alongside his three siblings, were part of that. The four of them stood at the four corners of her coffin as the public filed past. I remember commentating on that occasion at the time. So there has been a distancing, but still, where things stand now is at another degree entirely. He does remain eighth in line to the British throne, and even while that is largely symbolic, he's down below Prince William and his children and Prince Harry and his children. Nevertheless, that remains part of his status. So there's an interesting question about whether the UK government, in association with the monarch, takes steps to change that.
Yeah. Michelle, thank you so much. And also, just to note that Michelle Hussein also has a special podcast out looking at the arrest of Andrew Mountbatten-Windsor. That is available now if you want to get more details. Well, coming up, with award season in full swing and Warner Brothers acquisition talks still ongoing, we discuss the future of the entertainment industry with the CEO of cinema group Vu. That's next. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Netflix co-chief executive Ted Sarandos says the company's planned acquisition of Warner Brothers Discovery will lead to more films in theaters, addressing a key complaint from Hollywood. Speaking to Bloomberg, Sarandos said that Netflix promised to keep Warner Brothers films exclusively in theaters for 45 days.
Our pitch is very simple because it's the truth, which is we're going to keep Warner Brothers running pretty much like they are today, releasing their movies in theaters for the traditional 45-day windows. And in fact, it's even quite better for theaters because now that we're going to be in that business and own a theatrical distribution entity, we're going to take some of the Netflix films and put them through that as well. So it's very likely that you'll have even more outcome of high-quality films for the theaters if this deal goes through.
That was the Netflix co-CEO Ted Sarandos. Now joining me now to make the case for in-person cinema experiences is Tim Richards, the founder and CEO of View Entertainment. Really good to have you with us. And of course, looking ahead to the BAFTAs this weekend. But let me just start with the landscape because it's becoming increasingly competitive. You've had for several years now a big push from the streamers. Quite simply, how do you stand out?
Well, I've never really looked at what happens in home, terrestrial TV or streamers as being competition. Our competition is out of home entertainment. But in terms of standing out, we have to kind of constantly reinvent ourselves. We have to constantly innovate, trial test, and make sure that we give our customers the very best possible experience. We've been testing and trialing now for the last 18 months in particular in this post-pandemic, post-strike era. And just in the last 18 months alone, we have rolled out approximately 40,000 leather recliner seats. We've constructed a brand new seat with integrated wine coolers and champagne coolers. And we've also completely gotten rid of our concession stand and put in a completely free area, which has got merchandising, it's got healthy food options, it has traditional concession fare, and it has hot nibbles as well. It's been an absolute game changer for us.
Yeah, interesting. So it looks like you're leveraging that premium experience, which presumably is higher margin as well. What's the consumer uptake been like?
Well, it's been really interesting because particularly on what we're calling View Your Way, which was where we have, our goal was really focusing on our customer's journey from car seat or from bus seat down into our cinema seat. And we wanted to completely eliminate queuing, completely eliminate lineups, and we have. We have gates at the entrance, and we have this free flow right through to where you can pick up, you can see here in the picture, you can pick up whatever concession products you would like. And the consumer reaction has been extraordinary. What we were not expecting, we were expecting to have higher spend, which we have. We were not expecting to get additional growth. And our cinemas where we've introduced this concept, we're seeing massive growth in attendance. And it can only be explained by primary demand growth. And that's really what we're seeing. So our existing customers are going more often, but we're also seeing growth that we were not expecting. So it's been a big win all around.
Yeah, what about the uptake from Gen Z? Are they actually showing up to the movies, or is this a generation that prefer to sit at home and browse TikTok?
And that is the common thinking. Gen Z, and particularly kind of the emerging Gen A as well, have walked away. Nothing could be further from the truth. 25 saw a 25% uptick for Gen Z in particular, and you can see Gen A kind of sneaking in there as well. And I think part of the reason for that is this is the generation or generations that were mostly affected by lockdown. This is a generation that were at an age where they should have been out with their friends doing silly things, and they weren't. And once everything came out in the post-pandemic period, they were more social than previous generations. So they are our future, and that's why we're excited about welcoming them in. And they've been setting records with some of their movies, whether it be, on the younger side to Minecraft to horror films, which have been really over-indexing.
So interesting what you're saying about Gen Z. Look, I want to go back to something that you said at the beginning about the streamers. And I do want to bring this into the conversation because there's this ongoing bid for Warner Brothers and Netflix emerging as a major player there. What does this tell you about the state of the industry and the fact that Netflix does actually have so much clout?
Well, I mean, it's interesting because Warner Brothers is this iconic studio. I think everyone's a little bit nostalgic about, the best option here is for Warner Brothers not to sell. It is going to sell, and it is going to absolutely sell to either Netflix or to Paramount. And that's kind of the situation that we're in right now.
Okay. Looking ahead, I mentioned that the BAFTAs are coming up this weekend. What does the award season, the shortlisted films for the BAFTAs tell you about the consumer watching habits and the types of films that are resonating these days?
Well, I mean, what's really exciting about what's happened in the last year in particular is that we've broken records now for every genre of film, for every demographic. And, you can see when movies like Wallace Island or I, Liar there's really kind of over-indexing, and it's that full range all the way up to Minecraft and to Zootropolis, which broke records, broke a number of records. So I think when you have a movie like Hamnet gross the way that it did, it's really a good indication of what to expect for the next few years in the industry.
Tim, a real pleasure to chat to you. Thank you so much for coming on The Pulse today. Tim Richards, founder and CEO of View Entertainment. And a look at U.S. futures before we head out for the weekend. Some big data dropping in the U.S. in the next few hours. The PCE data, personal income, spending, GDP, all of that to watch out for. But I guess the big focus for markets is going to be what happens in the region with those reports of the U.S. amassing a huge armada around the Persian Gulf. And we'll see how things unfold over the course of the weekend. Geopolitics in focus. But coming up next is Bloomberg Brief. This is Bloomberg. Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies. which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
You know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's 5 a.m. in New York City. Good morning. I'm Tyler Kendall in for Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Oil trading down after rallying to a 6-month high as President Trump gives Iran 15 days to reach a deal. A private credit warning. Blue Owl sells a $1.4 billion portfolio of loans to help pay out investors and markets. So wait the latest PCE data and a possible Supreme Court ruling on President Trump's tariffs. All right, happy Friday. Let's take a look at these markets. Futures pointed higher after we really saw geopolitical tensions yesterday push stocks down. S&P futures up about 0.2%. NASDAQ 100 futures up 0.3%, and small caps up as well, up about 0.1%. Let's also check in on the bond market as we await a flurry of economic data here in the U.S. GDP. Also, that December PCE inflation report delayed because of the government shutdown. And if you're keeping track, that's the last U.S. government shutdown, not the partial current one that we're in, as it appears Washington is no closer to funding the Department of Homeland Security. On the long end, the 30-year trading at 4.69. On the short end, the 2-year yield at 3.46, and that 10-year yield sitting just above 4.07, up not even a basis point. Now, we also want to check in on some individual stock movers to watch. So let's head over to London and Abir Abu Omar. Hey, Abir.
Hey, Tyler. Let's start with the world's top gold miner. It's not having a particularly good day this morning, down 3% in the pre-market. And this is a two-sided story. So its reported earnings, quarterly profit was good, but it's down on the fact that investors are not looking favorably at the news that it's going to be churning less gold this year, a closure in one of its mines. And so investors not looking favorably, as I mentioned, down 3% this morning in the pre-trade. Moving on to Open Door, this digital real estate company is having a good morning, 14% up in the pre-trade. It's paring down some of the gains from earlier. It was up a little bit more, but it's still up quite a bit, 14.5 now, and it's up on the back of earnings yesterday. Now, this is one of those stocks that is gaining from the AI story. It's repositioned itself to benefit from artificial intelligence, Tyler. And then finally, Moncler, which is already trading in Europe this morning. It's up quite a bit, 11.8% this morning, and it's a good day for puffer jackets on the back of strong earnings and also strong Chinese demand. So that's Moncler for you. Tyler, back to you.
All right, Abir, thanks so much. We'll check in with you later in the program. And coming up this hour, we'll discuss more on credit risks with Kayla Cedar of State Street. But first, President Trump warns Iran with an ultimatum.
We're either going to get a deal or it's going to be unfortunate for them. I would think that would be enough time, 10, 15 days, pretty much maximum.
This as the U.S. military deploys a vast array of forces in the Middle East. Joining us now is Bloomberg's Sam Dagger. Sam, thanks for being here. When we're talking about what could potentially tip the U.S. towards military action, do we even know at this point what this White House is looking for when it comes to a potential deal?
I mean, obviously, the nuclear file is front and center, but our understanding, I mean, based on reporting that we've done here at Bloomberg, is that the U.S. has been pushing hard also to include issues like Iran's arsenal of short-range ballistic missiles, right? Because Iran still possesses quite a stockpile of that. Israel had destroyed more like the long-range missiles, but Iran still possesses the short-range missiles, which are capable of reaching, U.S. interests, U.S. bases anywhere in the Middle East and North Africa. And the other thing that the U.S. wanted to talk about is Iran's support for proxies, albeit these proxies have been, badly weakened, particularly Hezbollah in Lebanon and Hamas, obviously. But you still have the Houthis in Yemen. You still have the proxies in Iraq. The U.S. wants to put that on the table. And Iran has been resisting very hard and saying, I only want to talk about nuclear. Iran's foreign minister, Arakji, after the talks in Geneva, said, they've made good progress. He said, again, these are his words, that they're in broad agreement over a set of guiding principles. I mean, not much details there. And he said Iran is now working on drafting the framework for the next round of talks. The White House said there was little progress.
Right. I mean, you hear from the Secretary of State, Marco Rubio, saying that those other agenda items really need to be on the table. That then brings us to the question about what is behind this massive buildup of U.S. military assets in the region. Sam, when we're seeing now 2 aircraft carrier strike groups, what is that telling us about those potential options on the table that the U.S. is weighing?
Absolutely. I mean, I can tell you, like, countries here in the region, in the Gulf where I'm sitting in Dubai, I mean, the United Arab Emirates, Saudi Arabia next door, Qatar, all these countries are very nervous. They're saying, well, this buildup is ultimately going to lead to something. It's not just like, buildup for the sake of buildup, or maybe to use it as pressure or leverage on Iran to sign a deal. As you know, Iran has warned that maybe some of the first steps it would do would be to block the Strait of Hormuz. This is the the waterway on the mouth of the Gulf here, through which a quarter of the world's seaborne oil trade passes. And obviously, a lot of the countries here in the Gulf, Dubai is within the range of Iranian missiles. So these countries, particularly the UAE and Saudi Arabia, have kind of preempted all of this, and they've told Iran at the end of January that they won't allow the U.S. to use its territorial waters or its airspace to target Iran. So they're quite nervous, and that, they're watching and they're seeing this buildup, and they're saying this is ultimately going to lead to something.
All right, a lot to watch. Bloomberg's Sam Dagger. Sam, thank you so much. And turning now to trade, the U.S. and Indonesia have finalized a trade agreement that cuts the tariff rate to 19% and will see Jakarta facilitate the purchase of an estimated $33 billion in U.S. goods. U.S. Trade Representative Jamieson Greer, in a statement, writing, quote, "This landmark agreement breaks down trade barriers while advancing the economic and national security interests of the American people." Joining us now is Bloomberg's Brendan Murray. So, Brendan, what else are we learning about this particular trade deal, and how are we seeing this be part of the Trump administration's bid to counter, say, China in the region?
Yeah, exactly. This deal has been in the works for 7 or 8 months now. The initial framework was announced back in July, so it's taken that long for the two sides to get this over the line. What it does for Indonesia is it brings its tariff on its imports down, so it's competitive with others around the region. And for the U.S., it opens up some markets, agricultural markets, energy markets. It lowers tariff and non-tariff barriers for U.S. U.S. exporters to get more access to Indonesia's booming population and middle class. And so both sides seem to have walked away pleased with how this worked out. There were some provisions that were stripped out from the original July framework, the rules of origin being pledged on both sides being one of those that didn't appear in the most recent statement. And Indonesia, importantly, agreed to some digital commerce provisions that the U.S. has been pushing for. So that has been a barrier to broader agreements at the WTO level over the longer term. So that would be a key win for the U.S.
Well, Brendan, we are waiting today potentially for the Supreme Court to rule on President Trump's broad-based IEEPA tariffs. It may rule, it may not rule, but I am curious how this limbo, essentially, when it comes to those IEEPA tariffs, have impacted trade negotiations like this one that we're seeing inked with Indonesia, but also the fact that we finally got that long-awaited announcement from Japan earlier this week when it comes to which investment deals they're going to fund.
Yeah, a lot of these countries that have been negotiating have been slow-walking the talks and trying to sort of wait out the Supreme Court decision to see where the administration will go. If they lose this IEEPA authority that the president has used broadly on most major U.S. trading partners. And so India is one of those ones that's been negotiated now even longer than the Indonesia deal. And it's been one of the toughest for Washington to get over the line. But we understand now that they feel like they can sign that in March. So we'll see if that actually happens. But a lot of these countries are looking at this, the administration and saying, what happens if the Supreme Court rules against you? Where are you going to go with tariffs after that? The administration has said it's going to use other authorities to immediately impose tariffs, but the uncertainty about those will just return. What level are they going to be? What sectors are they going to hit? And how broadly are they going to hit certain trading partners?
Well, let me follow with India because this is a pretty significant development that they feel that they can host a signing agreement in March. India was one of those first countries that came to the White House to negotiate. Can you just give us an update on where we think they were able to bridge the gaps that have been delaying an agreement going into place?
Yeah, there's lots of sticking points, the main one being access to India's agricultural market for U.S. agricultural exporters. That has been one where the leadership in India wants to protect its domestic farmers, a huge constituency, and that has been for a long time the sticking point between the U.S. and India on trade, and it seems like that's continuing to be the barrier to getting a deal. But they sound confident most recently that it's coming together. These trade deals often take years. These are certainly running into the many months, but the U.S. and India feel like they can get it done in March.
All right, a potential Supreme Court decision at 10 a.m. Eastern we'll be watching. Thank you. Brendan Murray leads our trade coverage out of London. Now to other top stories trending on the terminal this morning. The UK swung to a record monthly budget surplus of £30.4 billion in January, driven by higher tax receipts. That's the UK's biggest budget surplus on record. This is welcome news for Chancellor Rachel Reeves ahead of next month's spring statement. U.S. and Chinese fighter jets briefly faced off above waters near the Korean peninsula this week. That's according to a Yonhap News report. The U.S. planes didn't enter China's air defense identification zone, but Beijing scrambled planes as they neared that region. The face-off marks a rare confrontation in that area between the two superpowers. And HSBC cuts 10% of its U.S.-based debt capital markets team. Sources say at least 6 people in New York were let go on Thursday. That includes 1 managing director and 2 directors. The bank unveiled a cost-cutting program last year. It reports earnings Wednesday next week. And coming up, asset manager Blue Owl finds buyers for its private loans to pay out investors. More on that next. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
February 24th, as affordability, immigration, and national security dominate the headlines leading into the midterms, President Trump will deliver his State of the Union address. Balance of Power will bring you live global coverage starting at 8 p.m. Eastern.
This is Bloomberg Brief. I'm Tyler Kendall in New York. Blue Owl is said to have sold its $1.4 billion portfolio of loans. This as the asset manager attempts to pay out investors in a fund that was hit with a wave of redemptions last year. For more, let's bring in Bloomberg's Silas Brown. So, Silas, Blue Owl found some liquidity here. Is this a good outcome for investors in the fund?
Yeah, I think it's a genuinely nuanced picture. In one respect, yes. I mean, the debt that they've managed to raise is at close to par. So, I mean, in terms of investor distributions, I mean, that's a great result. But I think also it marks a sort of end to a rather chaotic period for the fund and for Blue Owl itself. And so I think the kind of by hook or by crook nature of the distribution is somewhat concerning to investors. But I think overall top line figure, reasonably good result for investors.
Well, how has this highlighted the risks confronting retail investors entering what's this fast-growing private credit market now worth what, $1.8 trillion?
Yeah, I think the theory is quite interesting here. As is kind of obvious, private credit is an illiquid asset class, and these vehicles create some degree of liquidity, mostly for retail investors. But obviously, it's not a great look if you get a big amount of investor withdrawals and you're going to have to gate. Not that Blue Owl did, by the way. But I think the general picture and the kind of the chattering classes in private credit, be they analysts or journalists, would kind of point to this difficulty for private credit. If they do see waves of redemption requests and investor withdrawals, are they going to have to gate funds? You know, how are they going to mediate that liquidity mismatch? I think that's a challenge for the market going forward.
Silas, we also wanted to ask you about this Bloomberg News reporting that Bank of America is said to be committing $25 billion to private credit deals. I'm just wondering, based on the data, is there a potential for conflict here as the bank supports and will compete with these funds?
Yeah, I mean, Bank of America joins the private credit party. Look, I think banks have this perennial sort of, I guess, conflict on how to kind of confront private credit, because it's a competing asset class, and so it's taking a lot of business and lucrative fees away from them, and it's kind of quite similar to what they already do, which is underwrite and distribute transactions. So I mean, Bank of America joins a bunch of other high profile Wall Street banks like JP Morgan in kind of coming up with solutions, and I mean they are quite similar to JP Morgan in that they've earmarked a portion of their own capital to compete. In terms of conflicts, yes, I do think that that's potentially an issue, but I mean, you know, financial markets are fraught with all manner of different conflicts, so that's just a kind of another one to join the bucket list.
All right, a lot to watch. Bloomberg's Silas Brown. Silas, thank you so much. And coming up, NVIDIA is reportedly close to injecting $30 billion in OpenAI. More on that and a look at what else is making headlines in your front page news. That's next. This is Bloomberg.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So it, you know, folks know to find games there, but it's also a highly competitive gaming ecosystem. So its developedness gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, you know, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, you know, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, you know, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Tyler Kendall in New York. Time now for your front page news. First up on the Wall Street Journal, Christine Lagarde says she expects completing her mission as president of the ECB will take her until the end of the term. The statement comes amid speculation that she will resign early to allow the current French government to help pick her successor before next year's election. Next up on the Washington Post, the Trump administration is proposing to spend $2 billion a year to replicate the WHO after the U.S. withdrew from it last year. The effort would recreate systems such as labs, data sharing networks, and rapid response systems. Public health experts say the effort would be costly and unlikely to match the WHO's reach. And on the Financial Times, NVIDIA and OpenAI nearing a $30 billion investment. This will replace the long-term $100 billion commitment agreed on by the companies last year. Bloomberg Intelligence tech analyst Max Bloxham joins with the latest. So, Matt, put this into context for us. How surprising is it to see a potential retreat from that initial agreement amid all the concerns about this circular structure?
Yeah, I mean, obviously, it was kind of flagged fairly early on that maybe that original deal wasn't progressing as planned because there wasn't really any kind of updates. So I think actually maybe to me what might be surprising here is the size of the renewed deal. So like $30 billion of investment. The original deal saw $10 billion of investment at various tranches, and actually they're kind of pulling forward essentially a lot of that investment. And I think that potentially reflects a couple of things going on. One is that OpenAI's appetite for money to build out data center capacity and build its AI business is voracious, and they need as much money as they can get their hands on, so having more money up front makes sense. I think the second, perhaps from an NVIDIA perspective, is that with OpenAI thinking about going public, maybe the kind of valuation of this company could continue to go up quite substantially over time. And so under the original deal, because the equity transfer was staged with each $10 billion of investment, maybe they kind of decided that sticking to that original deal would have left them with less of an equity investment over time than putting $30 billion up front. I guess the short answer, we don't really know yet what the kind of full thinking is, but I think, to me at least, the fact they're going with $30 billion sooner is perhaps a little bit surprising, and perhaps a kind of confirmation of their confidence in the OpenAI partnership.
Well, can you shed a little bit of light on the intrigue part of this and how the companies are talking about each other, particularly the heads of those companies, Jensen Huang and Sam Altman?
Yeah, I think they're both talking about each other kind of very positively. I think certainly Sam Altman in India has sought to downplay the sense of any rift between the companies, and that they still anticipate NVIDIA being a very important partner, and they'll continue to be a very big customer of NVIDIA. Obviously, one of the issues there has been that OpenAI has been rumored to be looking at developing its own AI accelerators, and they're looking to diversify their purchases away from NVIDIA to companies such as AMD and Broadcom. So I think there's a balance there, and I think certainly, again, from the NVIDIA side, they're also looking to kind of hedge their bets. Obviously, OpenAI is an incredibly strong player in the AI market, but we have also Anthropic and Gemini and other platforms out there, and so NVIDIA is also looking to kind of make sure that it balances its exposure across all of the players, because they don't really know for sure which one's going to turn out to be the long-term winner.
All right, Matt Bloxham of Bloomberg Intelligence, thanks so much for joining us this morning. And coming up, we'll push ahead to PCE with Kayla Cedar of State Street. That's up next, here on Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's 5:30 a.m. in New York City. Good morning. I'm Tyler Kendall in for Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day ahead. Oil down after rallying to a 6-month high as President Trump gives Iran 15 days to reach a deal. Blue Owl sells a $1.4 billion portfolio of loans to help pay out investors amid concerns around private credit risks. And markets await the latest PCE data and a possible Supreme Court ruling on President Trump's tariffs. All right, happy Friday. Let's take a look at the markets. Futures pointed higher after heightened geopolitical tensions pushed stocks down yesterday. S&P futures up 0.2%. NASDAQ 100 futures up 0.3%. And small caps pushing higher as well. Let's also check in on the bond market as we await this flurry of economic data here in the U.S. The GDP number, also that December PCE inflation report delayed because of the U.S. government shutdown, meaning the last government shutdown, not the partial one that we're currently in. On the long end, the 30-year yield trading at 4.70. On the short end, the 2-year yield trading at 3.47, and that 10-year yield just above 407, not up even a basis point. For some stocks to watch this morning, we're going to head over to London and Abir Abu Omar for those details. Hey, Abir.
Good morning, Tyler. Let's start with the world's top mining company. Newmont is down a little bit this morning. Not a little bit. It's trimmed some of those losses from earlier, but it's down quite a bit this morning, 3% almost, and that's on the back of two things. So the quarterly results showed profit that was actually good yesterday, but one thing that the company pointed out was the fact that it's going to be churning out less gold this year on the back of a closure in one of its mines. So investors not looking favorably at that news, despite the solid outlook on profit. That's Newmont down 3% almost this morning. Moving on to Open Door, this digital real estate company is benefiting quite a bit from earnings that it announced yesterday, up 18.6%, adding to those gains earlier in the pre-trade session this morning. This is one of those companies that has benefited from this AI hype that we've seen in the market. We have the winners and losers of the AI disruption. Open Door has really repositioned itself to win from the AI hype. And then finally, Moncler already trading in Europe this morning, the biggest, or was the biggest percentage gainer in the stock 600 this morning, up 12.1%, trimming some of those gains, but it's on the back of solid earnings and strong Chinese demand. Tyler, back to you.
All right, Abir, thanks so much. We're now less than 3 hours away from the December PCE inflation report, and to go through it all, we're joined now by Stuart Paul of Bloomberg Economics for a preview. So, Stuart, let's get into this and what we're expecting, because we already got part of the picture right from the U.S. retail sales in December, which were on a whole pretty flat. So when we get this report, tell me, what are you looking for when it comes to services spending? And we keep in mind whether or not consumers are rotating away from, say, tariff-impacted goods.
That's exactly the entire question in this report. We have all the inflation inputs from CPI and PPI. As you said, we got a lot of the spending picture from retail sales, where spending on goods was just absolutely dismal. When we look at services spending, it looks as though it was a bit more robust, particularly in food services and accommodations. And we're also seeing some of that bid show up in prices. So when we think about the rotation, not only are we seeing some additional substitution away from goods and towards services, we're even seeing some of that spending show up in additional inflation pressure for things like discretionary services, dining out, and even things like video streaming. People are willing to spend more on Disney Plus, given the fact that they're not going to buy a new DVD player. No one's buying a DVD player, but given the fact that they're not going to buy a new imported TV, for example.
I also have to get your thoughts on GDP, because you and the team at Bloomberg Economics are estimating 3% growth for the fourth quarter. But this was, of course, the quarter that was most strongly impacted by the longest government shutdown in U.S. history. What would growth have been like if there wasn't that shutdown? And what are you predicting for the first quarter as we see that reopening effect?
I think that the fourth quarter would have looked a lot like the third quarter, closer to 4.5% growth had we not had the government shutdown. By our estimates, the government shutdown reduced economic activity by about $100 billion during the quarter. On an annualized basis, that shaves off about 1.3 percentage points from the growth pace that we're going to see in the fourth quarter. So again, a little bit of an unforced error, slowing down economic activity. Looking ahead to the first quarter, though, we expect to see basically all of that come back online. And a lot of it is showing up not just in government spending in the first quarter, tax refunds and other sort of stimulus programs, but we're also seeing a lot of investment enthusiasm, and that's going to help to buoy growth really throughout 2026.
Well, I'm glad that you brought up tax refunds, because it seems like this White House is really banking on the larger than normal refunds under the One Big Beautiful Bill for a GDP boost. But do we know, are consumers going to spend that money, or are they going to pay off their bills or save it?
It's a great question. Right now, the personal savings rate is super low at about 3.5%. That's about 3 percentage points below the pre-COVID norm. Folks not only accumulated and then completely ran down their savings, they drew down their savings, and they've been under-saving for well over a year at this point. I would not be surprised to see consumers sock away some additional cash when they get their tax refunds. But given how stretched thin people are right now, just to keep up their spending habit, they might need to put some of that cash to work once they get those checks.
All right, Stuart Paul of Bloomberg Economics. Stuart, thanks so much, as always. Joining us now for more is Kayla Cedar, macro multi-asset strategist at State Street. Kayla, thanks so much for being here. Let's just follow on the heels of what we were just discussing with Stuart. We're getting this flurry of economic data today. Can you just lay out to start what your base case is for Fed rate cuts this year, as we're gleaning a little bit more about the economic picture?
Absolutely, and thanks so much for having me today. I think the most important thing when it comes to the future path of Fed cuts is what's happening on the inflation front. Part of that is because we've seen a bit more stabilization on the labor market side of things. So focus then switches to, is inflation still sticky or not? And one thing that really stood out to me in the most recent CPI print was that we still see stickiness within that super core component of CPI. And so that's really saying that even though there's been less focus on goods, which makes sense, especially if we expect tariff prices to be passed through over time, but that shifts the focus to the service side. And the service spending is still pretty strong. And so I think what that means is that we're going to be on pause for a while moving forward in terms of Fed cuts.
Well, Kayla, I wanted to ask you about your most recent research note, where you're writing that, quote, although institutional investors are already overweight risky assets, it's clear they're content to add more exposure. To really change the narrative, we would need to see a rise in systemic risk that would catalyze a liquidity and eventually credit event. You're talking about how we would need to see this rise in systemic risk to change that narrative. But when we get news like Blue Owl yesterday halting redemptions, are there potential ripple effects here that could increase that systemic risk?
Absolutely. This is something that's really important to keep an eye on. I think when it comes to some of this risk, we have to think, A, is it just concentrated to the AI story? And if it is, where in that, is it just software and concerns around disruption that AI will have on certain parts of the market? Or is there a bigger story here? So there's a couple of things we've been looking at. One is when we think about, or where we see measurements in rising credit risk, it's really been concentrated in that software space. And so what that tells us is that it's not really rising in places like semis, tech hardware, and that means that the AI story really isn't over just yet. We see this in our institutional data as well, because although institutional investors have really cut their positioning in software and are now underweight, they've been adding exposure to semis and tech hardware that were already overweight at the beginning of this year. So we still see comfort in the overall AI story. Now, what about overall, market risk? We still see signals that systemic risk is actually quite low. What is high is turbulence and volatility, and that's where some of the risk is coming from. On the systemic risk side, the next question, though, is, okay, is that going to change, and what would catalyze that to change? One thing we really keep an eye on that front is liquidity, and we still see a solid liquidity environment. We still see signs that liquidity is getting to where it needs to go, and capital and credit are still flowing through the overall economy. So that's a good sign. I would say, there are concerns out there on the credit front, but overall, the overall environment is still quite robust.
Well, if we stick with AI, and we know that the tech sector has been a cornerstone of U.S. exceptionalism, I'm wondering, do you see this evolution and the spread of AI impacting this, and more broadly, the relative attractiveness of U.S. assets to the rest of the world?
There has been this sell U.S. narrative over the past year. We haven't seen that too much. And I guess I caveat that with, we have seen increases in exposure to other equity markets. However, the U.S. is still the biggest overweight by far. And so I think that context is really important to keep in mind. What drives that is fundamentals and profitability and earnings. And we still see the strongest earnings growth coming out of the U.S. relative to the rest of the world. And that has a lot to do with this AI story and this tech story. Even though tech has really been hit this year, especially that software space, when we look at large cap tech fundamentals, we still see rising earnings expectation, we still see solid margins, and we still see really strong revenues. So on that front, I think this will still support this overall U.S. equity market moving forward.
Well, if we keep with the theme of our eyes abroad, we are watching very closely those escalating tensions between the U.S. and Iran. I'm wondering, Kayla, how do you hedge geopolitical risk right now?
Absolutely. That's something that is front and center. I think that's something that's a little bit more challenging to do at the moment because there's just so much uncertainty around what that would look like and a lot of volatility on the geopolitical front. I think what makes most sense is stick with those solid quality, high quality parts of the market. Additionally, when we look at some of the rotation or broadening out that we've seen within equity markets this year, we have seen a little bit of an increase in energy. Now, I would caveat that that's not a huge overweight. And also when we look at earnings expectations in that part of the market, that's not super solid. So if you are looking for more of a cyclical rotation, I really like more parts like industrials where we've seen fundamentals start to improve as well. So, although there's a lot of geopolitical uncertainty out there, I think when it comes to asset allocation, sticking with high quality and sticking with parts of the market that have stronger fundamentals makes sense here because there's a lot of volatility on the geopolitical side of things.
All right, Kayla Cedar of State Street, thank you for joining this morning. And now to some other top stories trending on the terminal. HSBC cuts 10% of its U.S.-based debt capital markets team. Sources say at least 6 people in New York were let go on Thursday. That includes 1 managing director and 2 directors. The bank unveiled a cost-cutting program last year. It reports earnings Wednesday of next week. And shares of Ray-Ban maker EssilorLuxottica are on track for their worst week in almost 4 years. The slump is fueled by potential competition from Apple on smart glasses. Apple is planning to launch its own AI-powered eyewear in 2027. And President Trump is directing the release of documents related to aliens and UFOs. He accused former President Obama of giving away classified information when he discussed the idea of extraterrestrial life in a recent podcast appearance. The U.S. intelligence community released a report in 2021 detailing what it knew about unidentified flying objects that have been spotted by military pilots. The unclassified report contained few conclusive answers. And coming up, President Trump ramping up pressure on Iran with U.S. military stationing in the Middle East. Stick with us. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What word have you not heard over the last 2 weeks? Affordability. Because I've won affordability.
President Trump declaring victory on the cost concerns that have become a focal point of the upcoming midterm elections after polls showed voters have soured on his economic policies. Joining us now for more from Washington is Jonathan Tamari of Bloomberg Government. So, John, just first off, is that true when it comes to cost concerns? And also, is this a shift for the White House that in the past few months has really been playing defense when it comes to the issue of affordability?
So, there's data that suggests that, yes, inflation is cooling down a bit, but it's certainly not the kind of feeling that you're hearing from voters or that we're seeing from voters in polls, the sense that all of a sudden things are fixed and that they feel good about their own economic situation. Most polls suggest people are still pretty anxious, still pretty upset with the way things are going. And so I do think this is different than what you might expect, where the White House has said, listen, we inherited a mess, we're making progress, but there's still work to do. He's basically telling voters, look, the problem is over. don't worry about it. We saw in the last administration that approach did not work for them. It's a tough thing to tell voters not to feel anxious when they do feel concerned about their own economic situation.
Well, John, we're waiting today on a potential Supreme Court decision, and I'm wondering what you're hearing, not how the court will decide, because there's no way of knowing that, but how the Trump administration would ultimately react if their broad-based IEEPA tariffs are struck down. Because when I'm in Washington, there seems to be this divide emerging. On one hand, some feel that this could be a viable off-ramp for an administration playing defense on these affordability issues, and tariffs are such a core of their economic agenda. But on the other hand, we've heard time and time again from U.S. officials that they have all these other federal authorities, those other tools in the toolkit to use to impose tariffs if they can't use IEEPA.
Yeah, I would be surprised if we saw President Trump just easily back down if they lose at the Supreme Court. This has been core to his political identity pretty much since he first started running, and certainly core to his second-term agenda. He does have some options. They're not necessarily as powerful or as immediate, but he could impose trade licensing fees. There are provisions within different existing laws, the Trade Act, the Trade Expansion Act, where he could reimpose tariffs or attempt to under those provisions, but they're a little more limited. There might be a time delay into how quickly he can impose those tariffs. There might be limits on how far he could go if the Supreme Court does strike down his power on this, but I don't think he'll just back away very easily, even if he does lose at the court.
John, from domestic to foreign policy, you cover Capitol Hill very closely. And as we have our eye towards the Middle East and whether or not the White House is going to take military action against Iran, I'm wondering how Congress has been approaching the possibility of that when we have seen in recent months, for example, some lawmakers push back about the president's foreign policy initiatives when they're not conferred with ahead of time.
Yeah, I mean, we have seen that, as you mentioned, in Venezuela and some other instances where some lawmakers did raise concerns, but we're not seeing that right now on the Iran issue in the same way. Democrats are certainly saying that Congress should be involved here, that any major military action should require approval by Congress. There's maybe one Republican, Thomas Massie, who's raised objections, also Senator Rand Paul, so more than one, but there's not been a big outcry from Capitol Hill. Some of the Republicans who raised concerns about past actions are saying they're okay right now on Iran. So as has happened throughout this presidency, Congress looks likely to just kind of sit back and allow him to do what he wants, at least initially, and then maybe react depending on kind of what things look like going forward.
All right. Jonathan Tamari covers all things politics for Bloomberg Government in Washington. John, thank you. And Blue Owl is said to have sold its $1.4 billion portfolio of loans as the asset manager attempts to pay out investors in a fund that was hit with a wave of redemptions last year. For more, we're going to welcome back Bloomberg's Silas Brown in London. So, Silas, we were talking about this earlier in the hour, but as Blue Owl finds this liquidity, can you talk about what the mixed picture might be here for investors?
Yeah, it's interesting because I think, if you look in a very narrow way, I think this is a reasonably good result for investors. I mean, they're getting payouts at close to par on a kind of legacy fund that had experienced a lot of challenges before, and a whole series of plans to kind of get investor capital back that have since fallen by the wayside. So I think in the kind of narrowest interpretation, I think this is a good result, and certainly many analysts think the same thing. I think where the challenge emerges is, firstly, it was a slightly chaotic conclusion to this episode, and then secondly, I think, and quite importantly, what it's exposing is a kind of vulnerability for private credit, a market that has touted itself as immune to risks like duration mismatches and liquidity mismatches. And I think this is a kind of warning shot in a way for the broader market about the trials and tribulations of having to distribute cash back to investors in a more febrile environment.
All right, Bloomberg's Silas Brown, thank you so much. And coming up, a host of economic data and Fed Speak on deck. Your day ahead is next. This is Bloomberg.
East, and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
This is Bloomberg Brief. I'm Tyler Kendall in New York. Now look at what's ahead for today. First up, PCE, GDP, and personal income and spending all at 8:30 a.m. Eastern. That's followed by UMich sentiment survey at 10 a.m. Eastern and FedSpeak from Bostic and Logan throughout the day. Now let's take a check on some micro movers. Opendoor extending post-earning gains after its revenue beat the street's estimate. We also have Grail plunging as the healthcare company's cancer screener failed to meet a key goal in a test done by the UK's National Health Service. And also Newmont Mining down as the miner sees a decline in gold output for the year. Shares down 2.83%. Let's also check in on the broader markets today. S&P futures pointed higher, up about 0.2%. The dollar right now looking pretty flat, and the 10-year trading at 4.06. That's it for Bloomberg Brief this morning. Surveillance is up ahead. I'm Tyler Kendall in for Vonnie Quinn, and this is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility.
And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersecci in Davos, Switzerland, and this is Bloomberg.
Every decade, there's more evolution out of the S&P 500.
The 3 largest sectors representing the S&P are down on the year.
This is the most transformative trend that I believe we will see in our lifetime.
I wouldn't be surprised if we start to see a little bit of move back into tech. Trying to predict when these things are going to pop is a fool's game.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, shaken by geopolitics.
What is the goal if there is a U.S. military
strike? We're going to make a deal, or we're going to get a deal one way or the other. I would think that would be enough time, 10, 15 days, pretty much maximum.
The high-pressure campaign on Iran keeping investors very much on edge. As some private credit firms are struggling to regain confidence, economists are looking for the latest read on the U.S. economy. The latest GDP data just around the corner.
So today, Jonathan, is really filled with data and deadlines when it comes to this administration. The president yesterday putting a time frame on when a deal needs to be done with Tehran or potentially a strike. He said 10 to 15 days, and he talked about either make a deal or, quote, really bad things will happen. What we need to remember, though, last summer when the president gave a deadline of about 2 weeks, what happened within days? B-2 bombers flew over Iran and struck their nuclear facilities. So potentially this is also a tactic that he is using to try to distract the Iranian regime.
So crude responded to this. It's lower this morning by about 0.5% on Brent and WTI, but the rally we've seen over the previous 2 days, 6% plus. Clearly the equipment in the region, it's all about the optics. You want to signal maximum pressure and a bunch of different options. But this is outside of the president's traditional playbook. And you and I have talked about that repeatedly. The president's playbook is targeted fast, a clear objective that ultimately leads to a period of de-escalation. It's not about getting bogged down in a regional war.
And it's really hard to do that with Iran because we know what immediately their tactics are going to be in terms of response and also what the U.S. wants them to do in terms of a deal. These 3 red lines, Iran has never had that sort of engagement and have never had that appetite to come to the table. Wall Street Journal yesterday said what the president is weighing right now is an initial limited military strike to force his demands on this deal as a first step designed to pressure Iran. That would be the first initial strike, but then what happens after? That's the question.
So we've got to stay on top of this story, and this one too. Check out Blue Owl in the pre-market. Struggling to recover following yesterday's slide. We're down by 2%, down 6 yesterday. This is what we've learned through the week so far. Blue Owl said it's restricting withdrawals from one of its retail-focused private credit funds, so this is about redemptions. In addition to that, they've found 4 buyers for a portfolio of loans to help pay out investors, 3 of North America's biggest pension funds, and the headline, and a big headline here, its own insurance firm, which will come across to many as somewhat controversial. This is what the company's got to say. Contrary to what has been reported, we are not halting investor liquidity, we're accelerating the return of capital. There is going to be plenty of questions about this, and we can talk about Blue Owl as a firm, we can talk about private credit markets, but the number one question I think a lot of people will have for the bull case for the US economy, private markets have driven this economy for quite a while. What happens if that credit availability starts to dry up And that's a conversation we'll have in just a moment.
That's a huge conversation, and it's very concerning to a lot of individuals looking at this. The Blue Owl CEO also said we're simply changing the method by which we provide redemptions. This is why a lot of people have concern about what is actually going on. And you know what, Jonathan? It's always peculiar when JP Morgan's Jamie Dimon, October of last year, talked about cockroaches in the private credit market. And then what did we hear yesterday from Senator Elizabeth Warren on the same side of Jamie Dimon, talking about how this is a concern and concern that she has as a senator for retail investors that are involved in this space?
We've got a lot to talk about this morning. Coming up, we'll catch up with George Concavas of MUFG, with investors very much on edge. Stephen Cook of the Council on Foreign Relations as the US moves closer to striking Iran. And John Hill of Barclays ahead of the latest read on inflation. We begin this hour with stocks struggling to bounce, with a fresh slate of data very much on deck. George Concavas of MUFG writing, there is high conviction it's going to be about a year. The jury is still out, and we believe markets will resolve this inconsistency. George joins us now for more. George, good morning.
Good morning.
You do not seem to buy the high conviction outlook that this economy is going to rally and rally hard.
Yeah, no, look, I think it's all about the whole starting points, which has been a big theme of ours. And, you know, we, like your intro about the private credit, we have a lot of moving parts. We have this idea that we're going to rotate out of the really highly valued sectors like technology into the industries that need it. Those industries have been kind of kept afloat by low rates over the last 10, 15 years and by a lot of private credit as well. And so, like, if you start to kind of have wrinkles and some sort of constraint on credit in those areas, middle market type lending and small businesses will suffer from that. So, like, how can you rotate?
So
at
let's
least
go
in the
through
US.
this piece by piece, because this is an important story. And whenever we see issues like this emerge, and we've seen issues like this emerge repeatedly over the last decade or so, you'll see the comparisons, you'll hear the comparisons to 2007, right. 2008. Are the canaries beginning to fall in the private market coal mine? What's your response to that kind of language, that kind of coverage over the past few days?
Look, I think it's worth monitoring. But this really starts, to Anne-Marie's point, like really last year in October, right, with just the focus around the actual individual credits into the actual providers of the credit, at the same time, we have this big focus around potentially bank deregulation. And maybe this is kind of like part and parcel, fait accompli from 15, 18 years of banks being overcapitalized, not really lending to the real economy, and that forced private credit to take the place. And maybe we're coming full circle on that.
We've heard repeatedly coming out of the pandemic, the corporate balance sheets are a whole lot stronger. The consumer balance sheets are a whole lot stronger. Are you seeing stress on the consumer side starting to emerge as well? Or have you got the all clear on that front?
I mean, you cannot look at data in aggregate. That's the whole problem. It's been something we've all been talking about, this, the K-shaped economy. The 80, 90% are stressed. We can't not deny that. And so that's why it comes down to, collateral market valuations. And, can we really truly have that perfect rotation into the industries that need capital?
Based on the conversation we've had and that you've had with your clients, would you have guessed that we're only 2% below all-time highs on the S&P 500?
Yeah, listen, but at the same time, though, we've been coiling for quite some time. Really since October, November, we haven't gone anywhere, right? So with all this sort of optimism on growth, why isn't it being reflected in the markets?
It's clear this bull market has stalled. That's one way of putting it. There's a vicious rotation, though, beneath the surface. And to your point, the question we've got at the moment is whether that can be sustained into the more cyclical parts of the equity story. And maybe in conflict with that is what's developing in the bond market. The fact that yields have come down to 4% on 10s. Now, repeatedly, we've heard on this program, there's not much oxygen down here, that we can't stay at these levels, that yields have to climb, have to bounce. Do you agree?
I don't agree.
Why?
Look, a number of reasons. We could take an even bigger zoom out. Look at what's happening in Japan. Japan's inflation's turned the corner. Japan's rates are starting to head lower. We're still a fungible global bond market, and people are looking for the highest yields. And so, you kind of couch that with what we still think the Fed's going to cut 3 times this year, and you kind of think about the concerns around fiscal. And look, today's announcement from the Supreme Court, whatever we get there, might have an impact on the bond market. But even then, there's at least a turn on the fiscal outlook. It looks a little bit better, more stable at a minimum. So you take away the fiscal sort of concerns on the bond market, now you're back to pure fundamentals. And if you think about the rotation that's happening in the equity markets and you kind of compare and contrast to the bond market, it feels defensive. Like, why are bonds rallying at the same time as everyone's rotating?
George, why would we get a reaction, though, in the bond market if this administration has been clear for months that regardless of IEEPA, they will find other ways to enact their tariff policy?
That's true. It all depends on timing, rebuttal, and I just feel like, you'll have a market reaction if it's, sort of struck down. And we do think there was probably a plan B and plan C, to your point. But I still think the market would react to it. And,
Why do you still see 3 rate cuts, even though we have individuals like Fed Governor Myron coming out and saying he is seeing, a more robust labor market than he was expecting, as well as goods inflation firming?
Look, goods inflation is a small part of the inflation basket. The disinflation that's happening in the housing market is still stalled. If we do ever get the housing market to open up, I still think prices head lower first before they head higher. That's still disinflationary. The Fed has been scared by inflation for the last couple of years. In many ways, they've done a disservice. They should have cut rates and been done. They should have been done by now. Ultimately, they should have been done. Those 3 cuts that I've been kind of having in the back of my mind for quite some time, they should have been done, and then they would have a much more level playing field to figure out where to go to next. The minute saying that they're thinking about hiking, that was too premature.
Well, let's get to the commitment to 2%. This is what they've got to say about things. That several participants cautioned that easing policy further in the context of elevated inflation could be misinterpreted as implying diminished policymaker commitment to the 2% inflation objective. Is that a misinterpretation or just reality? That they've been above target for 5 years and ultimately
60 months, yes, 5
the
years.
commitment to 2% has diminished. Isn't that the ultimate conclusion for most people?
It is, but also it's all about the outlook of where you think you're going to end up landing, right? They cut when inflation was even higher, right? They started cutting when inflation was even higher. So this idea that now they're kind of getting skittish around what the landing looks like, I think it's too
You've heard what we've heard, and this is how it plays out in this program. People come on and we'll say to them, are the Federal Reserve officials, as they stand, going to cut interest rates? And they'll turn around and say no. But I expect an interest rate cut later this year, or I expect 2 or 3 interest rate cuts later this year. There is a belief that we've established a prolonged pause now on the FOMC until there's a change of leadership, and that once we get a change of leadership, the rate cuts begin again. Do you agree with that?
That's very convenient. That's the problem. Everyone puts all their views in the second half of the year because it gives you time to kind of think about it. Like, our view is more nuanced in the sense that any Fed will do the right thing if the data turns. And look, the jobs data that we've had up until now, it's not that great. And just to kind of bank on one number doesn't make any sense, especially if there's a high chance of it being revised in the subsequent months. So if we get a series of weaker jobs data and inflation still heading in the right direction, I wouldn't put past Chair Powell cutting at his last meeting.
George, you also had 4, though, originally priced in. And then a few weeks ago, you took it down to 3. Why?
Yep. I mean, look. I mean, the Fed obviously is, not showing a sense of urgency to cut rates, and the window does kind of compress as you move forward in time. And I still think that there's going to be a reluctance to cut right ahead of the midterms. So you get into this kind of late Q2. Not about being political. It's just more about when is it going to matter most. Like, you have to start easing sooner, and then you kind of see the net benefits of it.
Hey, George, it's good to see you. Thanks for dropping by. Lots to get through. George Goncalves there of MUFG. This morning at the front end of the curve, yields up by a single basis point, 347. Equities were positive on the S&P, then rolled over in the last 20 minutes or so. We're now just about unchanged on the session. With an update on stories worldwide, let's get your Bloomberg brief. Here it is with Yahara Anand. Hey, Yahara.
Hi, John. The United Kingdom recording its biggest budget surplus on record, revenue exceeding spending by over $40 billion in January, well above economic forecasts. The figures were boosted by a surge in inflows of capital gains tax and lower debt payments. Meanwhile, NVIDIA is close to finalizing a $30 billion investment in OpenAI. The Financial Times reporting this will replace the long-term $100 billion commitment the companies agreed to last year. Negotiations are in the final stages and could be finalized as early as this weekend. And a check on shares of Blue Owl. They are now falling 3% in the pre-market. The alternative investment firm saying it will restrict withdrawals from one of its retail-focused private credit funds. The company says the fund will instead return capital over time through loan repayments and asset sales, renewing questions about liquidity in private credit. That's Bloomberg Brief. John.
Yahara, thank you. Thanks for the update. More from Yahara later this hour. Up next on the program, a final warning to Iran.
What is the goal if there is a U.S. military strike?
We're going to make a deal, or we're going to get a deal one way or the other. 10, 15 days, pretty much maximum.
Up next, we'll catch up with Stephen Cook of the Council on Foreign Relations, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
This is how we're set up going into the weekend. Data at 8:30 Eastern Time. PCE, GDP, and a whole lot more. Look out for that. After that, UMich consumer confidence going into the weekend. Consumer confidence has been rock bottom on some readings. We're looking for a rebound. I think we're all hoping for a rebound for the year ahead. Let's turn to the equity market. That bounce in the equity market, can it hold? Unchanged this morning on the S&P. Going nowhere on the NASDAQ. Slightly lower on the Russell. Investors on edge for a bunch of reasons. Private markets will talk about that, but also concerns about the Middle East. Check out crude. Following a 6% plus move in the previous 2 days, we're at 66 on WTI. Brent just north of 71.
Well, there's heightened geopolitical worries right now when it comes to the Middle East and the buildup of military hardware in that region. It looks like the president could be poised to make a decision to strike Iran or use it as a negotiating tactic to bring them to the table. Either way, the president gave a deadline, 10 to 15 days. He said in some way, a deal will be done.
Let's stay on that story. Under surveillance this morning, a final warning to Iran.
What is the goal if there is a U.S. military
Well,
strike?
we're either make a deal or we're going to get a deal one way or the other. We're either going to get a deal or it's going to be unfortunate for them. I would think that would be enough time, 10, 15 days, pretty much maximum.
So here's the latest this morning. The U.S. amassing its largest military buildup in decades around Iran, with current and former officials saying the Trump administration appears ready for strikes on military and strategic targets. Jonathan Tamari of Bloomberg Government joins us now from Washington for more. Jonathan, we often throw this around and ask people to define success, but I'm struggling to define success on this front. What would success actually look like if the administration goes forward with military action?
I think that's one of the really big questions that a lot of people are asking, because they have not been making a public case to the country about what their goals are here, what they would see as success, why they've chosen now to have this large buildup. We know that the president wants to end or decimate the nuclear program. He's been trying that ever since he got back into office. But what exactly that looks like? Does he want regime change? Is there a certain measurements of where their nuclear program stands? That's all unclear. It could be part of his negotiating tactic to keep people off balance, but it also leaves the public and much of Congress in the dark about what exactly the goal is here.
So, Jonathan, this is really important. The president, I think, articulated a pretty clear objective when they went into Caracas. It was very clear. It was about removing Maduro. Whether you believe that should have happened or not, that's a different conversation. The objective was very clear. On this front, destabilizing the regime, taking out the regime, eliminating military capabilities, there's a whole range of things. I'm struggling to understand why they're almost refusing to articulate clearly what they want to achieve in Iran.
This has been the president's tactic, I think, on many of these foreign affairs issues in his second term. He believes he's enacting and basically facing the consequences later. He believes he's got the power to do it. And I think there's a certain appeal in the fact that he has had a number of strikes, military actions, Venezuela being probably the most prominent one, where he has gotten very quick results, has not had to go through, the process and the delays and the bureaucratic situation that you get when you go through Congress. I think he likes the fact that he's able to get very quick results, very positive results so far. But again, as we've pointed out here, this is we're talking about a different thing with the level of buildup that's happening here, with an involvement so far overseas, and an uncertain outcome and an uncertain path of what happens if a conflict does begin.
Jonathan, appreciate your time, as always, down in Washington. Jonathan Tamari there. Joining us to discuss is Stephen Cook, the Senior Middle East Fellow at CFR. Stephen, welcome back to the program. I asked Jonathan, our colleague, what does success look like? Struggled to answer. I think most people do. But there's an additional question we've all got to ask as well. What is success, and are the risks of pursuing it worth it? What's the answer to that, Stephen?
Well, first on the question of success, the success is anything that President Trump defines it as. And I think that that's the issue here, and that's what I think people are struggling with. He operates in a totally different foreign policy level than most of us who've grown up around the U.S. foreign policy establishment, which is he could very well order the strikes, and however they come out, he'll declare it a success, whether it's regime change or attacking the Iran nuclear program. Now, you asked a very important question about the risks. The risks are, of course, one, that it does not work and that the regime remains in place, retaliates against American partners in the region, fires on American forces in the region, and we're often running into a broader regional war. That is, I think, the worst case scenario for the United States. The Iranians are greatly weakened, but the Iranians still have the ability to cause a lot of trouble around the region. So if the United States goes, it's going to have to be sure that it's going to be able to affect the kinds of changes it's seeking. The question is, what are those changes? Is it removing the nuclear program, which, by the way, last June the president said was totally obliterated? Is it regime change? Is it going after the ballistic missile program, as the Israelis have been advising? We won't know if and when he orders those strikes.
Stephen, if there is a strike, what do you expect the Iranians to do immediately in terms of retaliation?
Yeah, they have been full of bravado in the last week. They conducted an exercise for several hours in the Strait of Hormuz, the very strategic waterway that connects the Persian Gulf and the Indian Ocean. They have threatened to rain missiles down on Tel Aviv. I think that is probably the most likely response from the Iranians, which is why the president has ordered the USS Gerald R. Ford and its carrier battle group into the region. That group of ships, along with the USS Lincoln, provide and augment air defense systems for Israel's already robust air defense systems and provides air cover for America's partners in the Gulf. But the Iranians are limited in terms of their ability to take on the United States. So that's why it seems likely they'll use what remains of their ballistic missile force to try to do a lot of damage to Israel and perhaps other partners in the region.
When the USS Gerald R. Ford arrives this weekend, it's going to be a massive military buildup. Do you think that buildup is enough for the Iranians to come to the table in earnest on the three top issues this administration has outlined: ballistic missiles, nuclear, as well as money to proxies?
Well, that would probably be the best possible outcome for the Iranians. But so far, at least publicly, they are digging in. They are saying that they will retain their right to enrich. They're willing to negotiate enrichment around the margins. They've come up with some ideas about a pause, which really doesn't matter, shipping enriched uranium out of the country. But I think the theory is amass a lot of force. If the Iranians don't capitulate, then you really do have to use that force, because otherwise your credibility is blown unless you use it. And the president has been clear. They either come to terms within the next 10 or 15 days, or he's going to use that force.
What do you think the outreach has been between the administration and allies in the region, Saudi Arabia, UAE, and Israel as well? On the oil front, do you think the OPEC members, if Iran starts to strike some tankers or close the Strait of Hormuz, are they willing to get some more exports on the market to keep prices down?
Certainly think that the Saudis and the Emiratis, who have said that they will not participate in American strikes on Iran, will definitely play ball on the oil front. First, I think there's a lot of American force in the region, so whatever disruptions there might be to the oil market, it'll be temporary. But of course, the Iranians have been putting oil on the market despite being under heavy sanction. But I do think we are at a moment where the Saudis and the Emiratis, despite Saudi financial and fiscal troubles, would play ball if it does mean a positive change to Iran.
How close is coordination right now between Israel and the United States? Because as you said, if there's going to be a retaliation, it's going to be across the Israeli skies.
Yeah, there is a very significant amount of coordination. There has always been a significant amount of coordination. And at these moments, the United States and Israel are working hand in hand. The Israelis have said that this is going to be an American operation, and they are going to be the wingman for the operation. There's also close coordination with other members of CENTCOM. If you look at where the United States is moving assets, it is throughout the region. Countries, although they are somewhat reluctant to publicly say that they support or will participate in this operation should it come to pass, are nevertheless keeping up with their responsibilities to CENTCOM and opening access to their bases and allowing the United States to operate from those bases.
Hey, Stephen, always good to see you. Thanks for your insight.
Great to see you.
And sharing some of your experience as well. Stephen Cook there at the Council on Foreign Relations. This was the week where things got real for financial markets and crude started to respond, particularly over the past few days. One off the back of the Axios story a few days ago on Iran, which read as following. The Trump administration is closer to a major war in the Middle East than most Americans realize. It could begin very soon. And then this from the Journal in the last 24 hours, which gives you a better idea of what the first move could look like. The president is weighing an initial limited military strike on Iran to force it to meet his demands for a nuclear deal.
So he might have that initial strike to try to force the Iranians to the table. And they say, the Wall Street Journal's reporting is that this target would be a few military or government sites. The question is, if Trump was to take that action, is it enough to force the Iranians to the table on 3 issues? It's not just nuclear. It's intercontinental ballistic missiles, as well as the support for the proxies in the region. And that is a big question mark. But to that Axios point, just look on Twitter. You could see all the hardware in the region. This looks like 2003 before the United States entered Iraq. So Americans should be prepared.
This is a high-pressure campaign to negotiate, and we'll see what comes next. 71.33 right now, Brent, 66 on WTI. Up next, we'll catch up with George Pollack of Signum Global as the president declares victory on affordability, plus Yahara drops by with your morning movers. Shares of Blue Owl continuing to fall on new fears for private credit. That stock is down again this morning by 3%.
crises, 2 essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We snapped a three-day streak without losses on the S&P in yesterday's session. This morning, just about unchanged, no bounce on the S&P 500. On the NASDAQ, up by 0.1%. In the bond market, on the week, yields drifting higher at the front end of the curve, together with the move in crude. We're up another basis point this morning, 347 on twos. And with that, encouraged by the hawkish Fed speaker the last week, this move on the US dollar, DXY, and the US dollar, looking at its best week of the year so far, potentially. Up on the week, softer on the session, but up on the week by 1%.
And there's really two narratives going into this when it comes to the dollar. Obviously, what you said in terms of traders paring back their expectations for the Federal Reserve to cut interest rates. Even someone like George, who thinks that there's going to be 3 cuts, he did have it at 4 at one point. And then on top of that, if you really are concerned about huge geopolitical risks and a flare-up in the Middle East, and not just a strike on Iran, but potentially if that was going to be a wider regional war, you want to go into the dollar.
Yeah, I can't read the geopolitics. I don't think anybody can right now. This could go either way. When you look at the move in crude, with Brent back in the 70s, you start to ask questions about whether it would restrict, contain their ability to cut interest rates later this year, or whether this tips the economy over because this economy isn't as strong as the last time we had a big energy spike off the back of the pandemic.
It's a great point. A lot of people have been putting into their forecast, putting into their how they view this economy with much lower crude prices. If you have a strike on Iran or a much regional war, you are going to see prices spike. How sustained is that going to be? That's a key question. And also, as I asked Stephen Cook there, are there going to be other countries that can quickly tap their production and get more barrels onto the market?
Brent right now 71.39, WTI 66.13. As we count you down to the opening bell, about 3 hours away, let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Blue Owl heading for another day of losses. Shares are down 3.3% in the pre-market after the alternative investment firm restricted withdrawals on one of its retail-focused private credit funds. Now, investors in that vehicle won't be able to redeem shares as usual. So this is becoming a bigger issue for a sector that was already caught up in the software sell-off due to exposure to that in their books. Plus, also we had the cockroach moment last year in October with Tricolor Holdings. So this just adding fresh questions about liquidity in private markets. Meanwhile, we have Alphabet leading the Mag 7 this morning, up 1.5% after it got a meaningful price target raise from analysts over at Tigris. Hear this, raising the price target from $280 to $415 and keeping their strong buy. The analysts there making the case that Alphabet has multiple powerful growth drivers, including AI-driven ads, plus momentum in its cloud business. And we end on Akamai Technologies. This is a cloud technology company that gave a weaker profit outlook than expected. It became the latest company to warn that rising memory costs are going to eat into margins, and they're just going to have to raise prices. So shares are falling nearly 11%. John?
Yahara, thank you. More from Yahara later this hour. On our radar this morning, the Supreme Court could announce the fate of President Donald Trump's tariffs as early as this morning. Justices may rule over the president's use of emergency powers to justify his signature economic policy. Elsewhere, shares of Blue Owl falling. The company selling a $1.4 billion portfolio of loans to help return cash to investors. Blue Owl finding 4 buyers, including 3 of North America's biggest pension funds and its own insurance firm. And finally, the Fed Governor, Stephen Myron, changing his tune on interest rate cuts for the year. Myron saying a strong labor market and firming goods inflation would, quote, make me undo what I did in December.
So he's coming back, backtracking slightly, but he says if I had no more data in hand right now and had to put a dot at the March meeting, I would respond to the data again and probably end up moving my dot back to where it was in September. So what we see from Stephen Myron is very open in terms of how he is immediately looking at the data and what that would mean in terms of his view on interest rates. He's not doubling down. He's saying, I'm going to move where the data tells me to move.
Some good news on the affordability front, and this has been a target, a big effort of this White House under President Trump. Mortgage rates, they've fallen to the lowest level in more than 3 years. And I imagine that's going to be part of the pitch at the State of the Union next week.
Well, remember, we were supposed to have a huge housing policy directive from this administration at Davos. The president was preoccupied with other things like Greenland. So now I imagine we are going to get a lot more details when it comes to housing and making it more affordable for Americans to climb on the housing ladder at the State of the Union. But we have seen already this president do a lot when it comes to housing in terms of mortgage-backed securities, having the FHFA buy more of those. But in terms of trying to loosen up the housing affordability crisis, there's a lot that potentially could be done, but people are saying, will it actually be enough?
Let's stay on that story. The president taking his economic agenda on tour, declaring victory over affordability.
We inherited a mess with high prices and high inflation, and we've turned it around and we've made it great. They caused the affordability problem, and we've solved it. What word have you not heard over the last 2 weeks? Affordability. Because I've won affordability.
This as cost of living concerns are set to take center stage at the State of the Union address next week. Joining us now to discuss is George Pollack of Signum. George, welcome to the program. You heard the president's own words. I'll repeat them. They caused the affordability problem, and we've solved it. Does the public agree?
No, unfortunately, while the president you got to respect the president for trying to frame his message and frame his idea as we enter the midterms. The public does not agree with him, especially if you look at the voting approval rating with young voters, Hispanics, Black and African and Asian American voters. They're all on a serious decline and they're not recovering, and they feel that the economy is leaving them behind.
George, as you know, the president is right to point out this is a problem that he inherited, a problem, though, that he now has to own. And they have made an effort on things like housing, and we discussed that mortgage rates have fallen to their lowest level in more than 3 years. There is some runway here into the midterms. How much more do they need to do, and what options, what tools, what levers can they pull?
Well, look, I think Congress on housing is going to probably pass housing reform legislation this year, and they're probably going to include some kind of provision to ban institutional investors from buying single-family homes. It will not be at the bar of 100 that the administration is currently proposing, but on the optics, at least, it could be seen that the administration is taking on Wall Street and taking on those who are supposedly making housing unaffordable for those looking for single-family homes. On energy, the issue is the administration has to lean into its ideas, how they're rebuilding America's energy infrastructure and just doing what they say, drill, baby, drill, and how that in the long run will pay off for American voters.
George, when it comes to the institutional buyers, though, that's less than 2% of the market. Could it actually move things?
No, that's the reality. It's not going to move things. I think everyone who follows housing understands that where the issue is more on supply side than it is addressing institutional investors. But if you look at the polling on institutional investors, I think close to 50% of Americans blame institutional investors for higher costs, and it creates a good picture for the president of taking on some elements of Wall Street, which going into a populist midterm is probably a beneficial political position to take.
What else could the White House do without relying on Congress when it comes to housing? We have seen them direct the FHFA to buy more of mortgage-backed securities. What other levers do they have to pull?
I'm sure they could try to do something in terms of cutting off certain tax credit loopholes for institutional investors. They could propose trying to force Congress, again, I know you're asking what they can do on their own, but to do something with the capital exclusion tax. So right now, I think that's at $500,000. Put that up to $1 million, $2 million to try to convince older homeowners to sell out and capture those tax benefits. But really, from the White House's perspective, they need to work with Congress to get something, because I think they're kind of limited on their levers within the White House itself.
George, when it comes to focus on affordability ahead of the midterm elections, we also, of course, had the president for months talking about a tariff dividend check. That conversation has pretty much evaporated. Do you have an update? And I'm thinking about it today, especially as we may get the Supreme Court releasing the opinions on IEPA.
Look, I would not be surprised if the president continues to push for it, but the issue is he's also killed off the idea of a second reconciliation bill because he seems to implicitly understand that the GOP does not have the votes. So when we go to the State of the Union next week, I imagine he's going to call for Congress to pass some kind of tariff rebate check. But he's either going to have to say, Congress, if you do, you have to do this, or if you don't, I'm going to try to find a way for the administration to do it on our own.
George, drill, baby, drill. You mentioned that phrase. We're drilling here in America. We're producing almost 14 million barrels of crude every single day. Crude, though, is rallying. Crude's back up into the 70s on Brent, WTI approaching those levels off the back of a bigger presence in the Middle East and the threat of military action on Iran. George, does the president want to address the nation next week in the State of the Union with crude rallying off the back of military action in Iran?
If you listen to those in the MAGA universe like Steve Bannon or Kurt Mills, they can't believe the president is choosing to focus on foreign policy going into the midterms. Their whole thing is, if you want to focus on foreign policy, do it after the midterms. Right now, you need to be focused on domestic concerns like affordability, and they can't understand it. And they think this president is so focused on issues that he thinks make him look good legacy-wise that he's forgetting that he still has to deal with the political consequences in November.
So, George, are you basically saying he's losing the base at the moment?
He is absolutely losing elements of the base based off, one, the affordability concerns, and two, in 2016, it was the New York Times that the Clinton the hawk tunneled the dove. And for a lot of people within the wider MAGA universe, they believe that. And they think these foreign policy entanglements, as much as they may build an opportunity for long-term peace, are not in the U.S.'s long-term interests, and the focus needs to be on domestic issues.
George, appreciate your time. As always, thanks for jumping on. George Pollock there of Signum weighing in on the situation in the Middle East, what it could mean for the State of the Union address next week.
It could potentially mean the president is going to be addressing the nation, as you say, with gas prices going up because oil prices are going higher, because he decided this weekend to potentially take a strike on Iran. The USS Gerald R. Ford will be in position by Saturday, so that's the earliest we could potentially see this president take that strike. That is going to be very challenging, especially since for a lot of Americans, they're going to start to remember 2003 and the invasion of Iraq, and that does not have a very good reputation on the minds of a lot of Americans.
What's the objective? Do we know what the objective is?
Well, I think the objective, according to the Wall Street Journal, of initial strike is to get the Iranians actually to the table and negotiate on, but there's three top issues. And to think that Iran and this regime, that they view this as existential, is going to negotiate on all three, I think is very naive. It's not just nuclear. It's also their intercontinental ballistic missiles, as well as the money to proxies. Does anyone actually think Tehran is not going to be giving money to these proxies in the region when this regime views this as existential? I don't think so. And the other big question is, what does the next day happen? Even if the regime was to actually be obliterated, what is day two? There's no defections right now, and there's no real opposition on the ground.
Crude oil, big move this week, up by more than 6% in just 2 sessions this morning, pulling back just a little bit. We're down by 1/10 of 1% to 71.56. With an update on stories worldwide this morning with your Bloomberg Brief, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. President Donald Trump says his Board of Peace has received roughly $17 billion in pledges toward humanitarian and reconstruction efforts in Gaza. The president also says more than half a dozen countries have promised personnel for a stabilization force in the war-torn territory. Former Prince Andrew has been released under investigation after being arrested on suspicion of misconduct in public office. The arrest coming after new details emerged about his relationship with convicted sex offender, the late Jeffrey Epstein. The brother of King Charles has consistently denied any wrongdoing. And Minneapolis Fed President Neil Kashkari taking aim at NEC Director Kevin Hassett, accusing him of trying to undermine Fed independence. It follows Hassett criticizing a New York Fed economist study which found U.S. companies bear most of the burden from President Trump's tariff hikes. Kashkari defending the study. That's your Bloomberg Brief. John?
Yahara, thank you. This was a mistake for more reasons than one, but I think the ultimate reason for me is this is a blog that hardly anyone read. And now everyone's reading it.
Well, now everyone's reading it. You got to make the blog great again. You come out and, throw some swings at it, put some darts on it.
And the headline now is that economists who believe that the Americans have to bear the brunt of tariffs should be disciplined.
Yeah. That is what the White House.
So that's what everyone's reading now.
Yes, that's everyone reading, yeah. And also now people are actually reading the report, and that report said that Americans are 90% of those tariffs, they're bearing the cost of that, and potentially those tariffs might be named illegal at 10 a.m. today. Wait and see.
A communication misstep, perhaps, from the White House. Up next on the program, dialing back the dovish tilt.
If we don't adjust policy down, then I think that we do run risks of rising recessions. The need for me to dissent for 50 becomes a little bit less as we come down.
Up next on the program, we'll catch up with John Hill of Barclays. He joins us next, live from New York City. You're watching Bloomberg TV.
this is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3. Then, I'm not, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in 1.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg. What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Stocks are going nowhere this morning, just about unchanged on the S&P 500. Similar story on the Nasdaq. On the S&P, still within 2% of all-time highs, around those kind of levels at the moment. This came from Bespoke. Fantastic stat from them. The S&P has seen its tightest trading range to start a year since 1966. The difference between the S&P's high and low close this year has been just 2.67% at the time of writing at some point yesterday. That stat's amazing. For all the pain, all the massive rotations, we're around 2% away from all-time highs, and the trading range has been incredibly tight for 2026 so far. Just ridiculous. The noise elsewhere and the calm at the index level. Let's turn to some of the noise. An important story blew out in the pre-market, shaping up as follows. Trading softer yesterday, down again this morning by 4.5%. So here's the latest. They've found 4 buyers for a portfolio of loans to help pay out investors. 3 of North America's biggest pension funds and its own insurance firm. And there's 2 different ways to talk about this. One, there are some really deep pools of capital that will step in and everything's going to be okay. This can be contained. That speaks to the 3 biggest pension funds in this country for North America. Or there's a deck chair story and you had to turn to your own insurance company to try and get some funds.
And you have to think, is this the first of potentially more cockroaches to come to pass? This is what Jamie Dimon talked about in October. This is what Senator Elizabeth Warren is talking about on Twitter, saying the administration needs to be careful in terms of she thinks that they're encouraging Americans to put more in their 401ks and retail investors invest more in private equity. Right now, is this going to really hurt investor confidence in this space?
Blew out down by more than 4% in the pre-market. We'll keep tracking that story throughout this morning. Under surveillance this morning, dialing back the dovish till.
If we don't adjust policy down, then I think that we do run risks of rising recessions. So I think it's important that we keep on adjusting our policy rate down. But at the moment, it's not my base case, in part because I think that we ultimately will end up continuing to adjust interest rates down. The need for me to dissent for 50 becomes a little bit less as we come down.
So here's the latest this morning. The Fed Governor, Stephen Murrin, moderating his stance on policy after recent labour market and inflation data. The next read on inflation due in just under 2 hours' time. Joining us now is John Hill, the head of US Inflation Market Strategy at Barclays. John, welcome to the programme.
Thank you for having me.
Before we get into the data a little bit later this morning at 8:30 Eastern Time, I want to lean on your most recent report. Reducing inflation surprises. What are you tracking at the moment that enables all of us to do that?
So the observation I was trying to make is, say going into the CPI last Friday, we were getting a ton of questions from clients about diverging signals in the alternative data. So specifically, like the Adobe Digital Price Index, super strong, upside risk, right? Something like Trueflation, very, very weak, downside risk. We saw a disappointing result. And I think the observation to make is that you're not really forecasting the future with these prints. You're trying to figure out what happened last month. And as we get more and more better high-frequency data, we're not really going to be able to nowcast. It's more like the past is going to be increasingly certain. And it's especially going to be increasingly certain for things in the inflation data that use, say, digital prices. That's easy to scrape online. That's easy to aggregate. And you can be like, oh, we kind of know what it was in January already. Like a great example of this, there's a widely followed feed on Bloomberg, daily retail gas prices. You take the month average of that, do the month-over-month change, you can pretty much know what motor fuels is going to do in CPI. And kind of my observation and hypothesis going forward is that's going to be more and more and more of the category. And it's especially relevant for today. We have core PCE coming up in 2 hours or so.
Yep.
We already know the vast majority of inputs to PCE because it comes from CPI and it comes from PPI, and we know that data. So while it's new data, it's also kind of realized at the subcomponent level. And so, for example, when we map all the individual components, we actually think core PCE is coming at a decent 0.4% above what is listed as the Bloomberg consensus.
Does it make it less of a market event as more and more people basically figure this out? Or is there some forward-looking components in this data that is worth paying attention to?
Yeah, there absolutely will be forward-looking components, and that's because the way that these indices are built, not all of it is just scraped online, right? Some of it's modeled. A lot of people focus on OER as a thing. But the observation also is that, the market's just going to reprice earlier and earlier. So it's not that the market moved to PCE at 8:30 today. It's that once everybody refreshed their sheets after CPI and PPI were in, it was like, oh, wow, core PCE is going to come in at 0.4. Legal services distorts this higher. The big drop we got in used cars that mattered for core CPI matters a lot less for core PCE. So it's kind of like rotating where that repricing is. And in the modern world, you can look at digital prices, you can look at generative AI, pick your favorite tech topic. The world's getting faster, the world's getting earlier, and the market's going to reprice as such.
Do you think Fed policy gets noisier or quieter?
I think Fed policy just needs to be more data dependent. You can even see, if you listen closely, Powell has picked up on this. There have been a couple times where core PC hasn't actually been released, and he'll say, indicators suggest. They're doing this at the Fed as well. And to be fair, everybody kind of should if you care about these detailed component kind of things. And as a result, I think it also makes the market more sensitive to some of these alternative data feeds. So it's no longer going to be sufficient just to look at CPI for what's happening. Now, to be sure, there are issues with revisions and reweightings and different scopes and all that, but the world's broadening out and it's speeding up.
What do you most focus on in the alternative data space?
We try to be agnostic. I focus heavily on U.S. fixed income, and so the cash flows on those products, it really only matters what CPI says. So what we focus on is, in the alternative data, what actually correlate well with different parts of CPI. There are certain used vehicles that pay close attention. As an example, there are food tracking prices. And I think not only over time is that this kind of the lower bound of where we're at, I think it's going to get better, faster, and more widely consumed.
You mentioned the Bloomberg basically tracking the motor fuel.
Mm-hmm.
I track AAA almost every single day to see where the gas prices are across America, especially when the president says we're going under $2 a gallon. How important is the oil story right now in terms of those alternative data spaces, given the potential conflict we might have in the region, the spike we've seen in crude prices?
It's absolutely essential. And it's one thing where you can look at futures prices. We already have good visibility on that. But consumers buy gallons of gas, not barrels of oil. So it's better to try to track the residential true cost. And this could be meaningful, if oil prices continue higher or really, really spike, this could be meaningful for headline CPI, right? First order back of the envelope, every 10% move in WTI is worth about, call it 15 basis points in headline. And it gets larger the more nonlinear you get. So it's one thing to go from 60 to 66. It's another thing to go to 100, right? The second order consequences get much, much larger. I think it's one of the biggest macro stories out there right now. But, I wouldn't say I'm a geopolitical expert trying to navigate this.
Sure, but we can talk about sort of the different kind of scenarios here. A lot of people were asking me earlier on this morning before we came on, if this is different to where we are coming out of the pandemic, where we saw the spike, particularly when Russia invaded Ukraine, is the economy in a different place and the kind of impact it would have on the US economy has changed? How are you thinking about the different moments?
So one thing that was more inflationary post-COVID, if you think about, take a big step back, we had a sudden rapid surge in labor demand in the economy. We didn't have enough labor supply to keep up with that. And then in recent years, you had a lot of immigration, that increased supply-demand 101, that's downward pressure on prices. Now we're at a moment where we've seen a reduction in immigration. We have an aging domestic labor force. And so supply-demand is much more in balance, or closer to balance. And then if you introduce this price shock, it could feed through very differently.
So we're vulnerable to price shocks still, inflation shocks?
Absolutely. And part of the other, inflation wonks like to talk about expectations, right?
Sure.
We've gone through however many months now of above target expectations. If you have yet another shock, you could imagine those expectations being more susceptible to being reset higher.
John, this was smart. It's good to see you. Thanks for sharing your report with us as well. John Hill there of Barclays on inflation data, how to track things and what to look ahead to at 8:30 Eastern Time. Coming up on the program in the next hour, we'll catch up with Greg Battle of BNP Paribas, the former White House trade official Kate Kalukowicz, Alicia Reese of Wedbush, and Colin Martin of Charles Schwab. If you're just joining us, welcome to the program. Equities rolling over just a touch. We're down by 0.1% on the S&P. The bond market quite well behaved. Yields up by a single basis point at the front end of the curve, 347. But all eyes at the moment on the Middle East and what's happening with crude. Big rally over the previous 2 days, a bit softer this morning, lower by 0.5%. Crude on Brent, 71.32.
You know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
I'm a little bit skeptical of the sentiment data here.
It's very difficult to get a clear read, like on anything.
The data so far don't justify having lower Fed funds rate.
There is an intellectual basis for a cut.
In a healthier productivity environment, stronger potential GDP, you don't need lower rates.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. Your price action, your scores look like this. Equities just a little bit softer. We're down by 0.1% on the S&P. Likewise on the Nasdaq. In the bond market, yields a little bit higher at the front end of the curve, up by a single basis point. Twos at 346. Coming into this at 8:30 Eastern time. Tons of data. A read on GDP, PCE, and later on a read on UMich consumer sentiment. All worthwhile. What could change UMich? This move in crude. A 6% plus rally in the previous 2 days. Bit lower this morning, down by 0.6% at 71.25. But that's the main event at the moment. All eyes on Iran and what happens next.
Absolutely. And Wall Street Journal is talking about potentially the president is weighing an initial limited military strike on Tehran to try to get them, to control them, to go to the table, to really go after these 3 red lines he pointed out in terms of ballistic missiles, nuclear deal, and money to proxies. The issue, of course, for financial markets is if we see a huge spike in crude, what does that actually mean for the real economy as this administration is focused on affordability?
And seen. Just picture the State of the Union next week, the president addressing Congress and Supreme Court justices as well, at a time when maybe, and I stress maybe, they might be striking down his signature economic policy later on this morning. Plus, you add in a massive move in crude because you've just decided to initiate strikes against Iran. Is that the position, the seat you want to sit in next week?
Well, definitely that speech is not written yet because they potentially are going to have to edit it depending on events that come at 10 a.m. when the Supreme Court has an opinion day. Now, we've been here before. I always am refreshing the SCOTUS blog on opinion day for the past 2 months at 10 a.m. We have not gotten them yet on EIPA, but today potentially they will decide on EIPA. And then this weekend, everyone is talking about, there is reporting in the Telegraph that as soon as this weekend is when the president could decide to make that initial strike decision because the USS Gerald R. Ford will be in position. There's a tremendous amount of military hardware right now in the Middle East, which is why you see prices in crude going up.
Crude north of 70, north of 71 on Brent. Lots to track this morning, including this move in the pre-market from Blue Owl. Blue Owl down again after sliding yesterday and taking the likes of Apollo and Blackstone with them. Blue Owl down this morning by more than 5%. The latest from that firm is that they found 4 buyers for a portfolio of loans to help pay out investors. Of those 4 buyers, 3 were North America's biggest pension funds, and 1 was its own insurance firm. Now, there are 2 different ways, as we've stressed throughout this morning, to look at this. One is that there are deep pools of capital available to step in. The other is that you have to turn to your own insurance firm to move the deck chairs, and you'll make your own judgment on where we are.
So they have the $1.4 billion to liquidate in these assets, but as you point out, it's basically how are you thinking about what they are doing? What does it actually signal and mean? This is what the Blue Owl CEO had to say, quote, "We're not halting redemptions, we're simply changing the method by which we're providing redemptions."
It's getting difficult to put a floor under that story at the moment. It seems to regain confidence. That stock is sliding once again, and we'll stay on top of it right here on Bloomberg TV. Coming up this hour, we'll catch up with Greg Battle of BNP Paribas with stocks edging lower, the former White House trade official, Kate Kalukowicz, with a potential SCOTUS tariff ruling on deck, and Alicia Reese of Wedbush saying Netflix is the superior option to win the Warner Brothers streaming battle. We begin this out with markets looking to regain a firmer footing. Greg Battle of BNP writing, "We're cautiously bullish. We acknowledge that a hint of caution is warranted, but a move higher, up through 7,000, we think is a rally people might have to chase." Greg joins us now for more. Greg, good morning.
Good morning.
Have you ever seen such a stressful 2% decline from all-time highs on the S&P?
It is such a peculiar market. It's not just the narrowness of the decline, it's the range. You alluded to it earlier on the show, the range that we have traded on an index level. So tight. But under the surface, there are plenty of things that have got people worried.
It begs the question, have we really seen the worst of it at the index level?
Well, I think something really has to change. Like, there are signs of stress in the equity market. You can look at the VIX. The VIX troughed at 14 at the back end of last year. It's now up above 20. People are clearly worried. Either we need to see some kind of normalization in volatility or something happen in the equity market.
Well, let's get into the worries. Yep. What are the worries? What are the hierarchy of worries right now?
So I think the biggest one this year has been the declines in software, and people worried about the kind of existential threats to that business, which has driven this massive rotation under the surface in equities. Geopolitics, obviously, you've been talking about crude, Iran all morning. That remains something bubbling away in the background. But really, I think it's the rotation in software that has been the real pain trade for people.
Is it the equity story in software or the ripple and the rupture it could generate in private markets? What's of more concern at the moment?
I think the two things are very interlinked. Obviously, people are focusing a little bit more on private credit with the news flow this morning, but I think it's really predominantly an equity story. The extent of the rotation and the split between semis and software is very unhealthy.
So why are you still cautiously bullish?
Well, there's many, many things to be worried about, but everyone is worried about them. That's why the VIX is up at 20. When you look at the parameters of the option complex, what you can see is skew. The downside versus upside, the relative cost of that at 2-year highs. When we look at our positioning metrics, we see things like systematics, like CTAs and vol targets all having delevered. Flows have looked much less pro-risk at the start of this year. So there are lots of things to be worried about, but people are worried about them.
Right, so the fact that they're worried doesn't give you as much a cause of concern because you know how to deal with them. Jonathan mentioned what was going on with Blue Owl and private equity, and you said this is kind of interlinked what's going on in the equity market. So are you concerned that there are more cockroaches to come out of the wall?
There's definitely concerns about this, and we see the extent of the price action and some of the declines in equities. It's clearly unhealthy. So we're concerned about these things, but we do have to think about bigger picture. How does the world look for the equity market? Well, we're expecting double-digit earnings growth. Analysts are revising forecast higher rather than lower. Nominal GDP is very high, and the Fed is engaged in a cutting cycle. How much more they will cut, or if they will cut, is up for debate. But when we look at those things relative to history, that tends to point to pretty good outcomes for
It just begs the question again, though, why it's not working. So I'm going to keep coming back to hot nominal GDP, right there with you, understand it. The Federal Reserve is contributing to that, I'm sure. And on top of that, massive tech capex. Conclusion should be chase the beneficiaries. NVIDIA, it's done nothing all year. Make sense of that.
So I think it's quite hard to make sense of it. So part of it is working. When you think of the market, I split it into two halves. That more cyclical part that is correlated to the macro and the hot GDP, and the secular story. The cyclical part has worked this year. You can look at the performance of something like the Russell, the small and mid caps, equal weight S&P, the industrials. They've all been working this year. Tech has been the laggard. Now, what we've seen is software really capitulate, and that has taken the kind of wind out the sails of all of tech, really, at least in the large caps. Now, when we look forward, we have some pretty significant catalysts in terms of NVIDIA earnings, Broadcom earnings, NVIDIA GTC. So I think these events are going to be really key for, obviously, tech and therefore the broader market.
Is it an either-or at the moment, cyclical or secular, or do you want fingers in both pies?
No, that's not my view. My view is that you can barbell exposure, and you can go to both of those extremes. So you can pick some of the secular winners within the AI tech story, and I think you can go down the other end of the barbell exposure, which is the small and mid caps, things like Russell, which are exposed to that running at hot theme, and have a little bit of exposure to both.
From a sector perspective within the cyclical bucket, where do you want to be and what do you want to avoid?
I think the CapEx story has been a very strong one. You spoke about that just now. We've seen some of these huge CapEx numbers, which are a double-edged sword because obviously people have to pay for those. But some of the CapEx beneficiaries, we have an industrials basket that's tilted towards the CapEx beneficiaries. That's done very well at the start of this year. I think it's that part of the market that continues on the cyclical side to perform well.
Notable that you didn't talk about financials.
Yes.
Or the banks. Why not?
Yeah. So the banks is a challenging sector. When you look at it, it's quite bifurcated. Some of the large banks have been trading on pretty high multiples for a while, and we've seen the value sector, the value factor perform well at the start of this year, so valuations are compressing, higher valued stocks struggling. But then as you go further down the market cap spectrum, you are exposed to more risks, and if you are worried about things like private credit, it's not an obvious place to hide.
But at the same time, this is an administration that's taking deregulation, especially when it comes to the financials, very seriously. Does that not get you excited?
It doesn't necessarily get me excited. I think it's also a course of uncertainty. What is actually going to happen with the financials? What policies are we going to see heading into midterms to help housing or the consumer or affordability? It's very unclear. So I think it's something that could be a benefit to those parts of the market. There's a lot of uncertainty.
As you are cautiously bullish, are you looking at policies in Washington and potentially this administration wanting to keep it, run it hot and loose in terms of where you want to place money?
I think there's a huge amount of uncertainty around politics and where policy is going. So I think it's probably better to think about, which parts of the economy do we think are running hot and apply exposure proportionally to that rather than try and chase policy.
Can we finish with some scenario analysis?
Yeah.
Not your base case, I'm sure, but I just want to play around with the story a little bit. What would happen to your calls if crude did go to 80, north of 80, off the back of a military confrontation in the Middle East? Would that change much for you?
Yeah, I think in the short term, that'd be pretty painful for markets. The cyclical parts of the economy that have benefited from this running it hot narrative are not going to like a massive spike in crude. So I think that could temporarily drive a risk-off move. I think one of the things we've seen, whether it's policy or geopolitics, is that you have to be very careful thinking the first move is going to last. We've been in an environment where things have reverted very, very quickly. So if you get a spike in crude and that hurts equity markets, do you think that is going to be sustained, or is that going to be an opportunity to buy the dip? My personal view is I think it's an opportunity to buy the dip.
Greg, it's good to see you. Thanks for dropping by. Thank you. Greg Battle there of BNP Paribas. Not getting that spike this morning on crude. You have seen it over the previous 2 days. WTI is 66, Brent at 71 this morning, pulling back by about 1/3 of 1%. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross back over to Yahara for more. Hey, Yahara.
Hi, John. We're seeing shares of Blue Owl falling 4.6% in the pre-market. Here's the latest. The private credit giant selling a $1.4 billion portfolio of loans to help return cash to investors. Blue Owl finding 4 buyers, including 3 of North America's biggest pension funds and its own insurance firm. That's according to people familiar. This coming after it said yesterday it would begin limiting withdrawals to clients in one of its retail-focused funds. The hits keep coming. Meanwhile, ECB President Christine Lagarde saying her, quote, base case is to finish out her term in a Wall Street Journal interview. This after reports saying the central bank president would leave her post before the end of her term to allow French President Emmanuel Macron to play a role in replacing her ahead of elections. And oil is trading near a 6-month high on concerns the U.S. is moving closer to war with Iran. The U.S. is continuing its military buildup in the Middle East as President Trump says Iran has days to agree to a deal over its nuclear program. The U.S. now has more forces in the Middle East than any point since the Iraq War. That's your Bloomberg brief. John.
Yahara, thank you. Thanks for the update. More from Yahara later this hour. This from Peter Cheer of Academy. Of course, that firm filled with military experience and generals. While a diplomatic solution is the goal, it appears increasingly unlikely as the two sides are too far apart.
Yeah, because I think a lot of people realize that in terms of what the United States wants to see out of Iran, this regime is not ready to play ball on all 3 of those issues. And when you have this type of military hardware in the region, what do you think the next step is going to be?
Big issue. Major issue going into the weekend. Up next on the program, here's another one. Bracing for a ruling.
You have the Supreme Court now going to rule on whether or not we can use tariffs. Can you believe this?
We have a big decision. Hopefully we're going to get the right decision.
And to think I have to be in the United States Supreme Court for many, many months waiting for a decision on tariffs.
That's up next. The former White House trade advisor, Kate Kalukowicz, joins us for more. Live from New York City this morning. Good morning.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Equities this morning just slightly negative going into this. 8:30 Eastern Time, core PCE. Another read on the US economy later. New Mitch consumer confidence heading into the weekend. That drops at 10 a.m. Eastern Time and setting the tone for the President's State of the Union next week, potentially a ruling on his signature economic policy. The Supreme Court opinions dropping a little bit later this morning. That very much in focus.
And those justices go to the State of the Union. So you can envision a scenario. The president is giving his speech. We know he likes to go off prompt and off script. And he's going to call them out saying, why did you decide that my tariffs potentially were illegal? We might get some clarity on that.
How many people have said to us, though, on this program that, yes, that is the consensus view. That's the base case. That will be the ruling. But ultimately, it won't change anything.
Well, it won't change anything, because even if they can't use IEEPA to enact their tariff policy, there are other avenues this administration can use via USTR and via the Commerce Department to get that tariff rate per countries they want. Also, potentially, we can get a split decision. The Supreme Court could say, look, the fentanyl tariffs, that is an emergency action, but the reciprocal tariffs are not. And also, you've made this point. Are they just too big to fail?
Yeah.
And potentially the Supreme Court says, look, we're going to let them stay until you come back with a legal justification for them. Lots of different scenarios.
So we've been here before, a few times already this year. I stress potentially getting a ruling later on this morning. Under surveillance this morning, bracing for that ruling.
You have the Supreme Court now going to rule on whether or not we can use tariffs. Can you believe this?
We're getting rich because of tariffs, by the way. We have a very, very big case in the Supreme Court. If we don't win that case, our country is going to suffer so greatly.
I don't know what the Supreme Court's going to do.
We have a big decision. Hopefully, we're going to get the right decision.
And to think I have to be in the United States Supreme Court for many, many months waiting for a decision on tariffs.
So here's the latest this morning. President Trump's trade agenda hanging in the balance. A possible Supreme Court decision could be coming later on this morning. Bloomberg's Tyler Kendall has more for us now this morning. Tyler, welcome to the program. Is today the day?
Well, John, at this point, there's no way of knowing, though some court watchers have pointed to the fact that the justices did decide to hear this case on an unusually aggressive schedule, which could suggest that they may want to get an opinion out sooner rather than later, because, of course, we know there is just so much at stake here, including the ongoing trade negotiations that the U.S. is trying to pursue. Look at how in the last 24 hours we just saw this trade deal inked with Indonesia, and we're getting some headlines that potentially there could be a deal on the table when it comes to India. Their trade minister saying that we could see an agreement signed as soon as next month. But it's definitely been looming over all of these trade negotiations and agreements, and potentially even setting up a complicated legal fight if the court does rule against the Trump administration. They could potentially be on the hook for some tariff revenue refunds, and we know that so far the government has taken in about $133 billion worth of revenue from the IEEPA tariffs alone. We have to keep in mind there are those two questions before the Supreme Court today. One, does President Trump have the authority to invoke IEEPA to impose tariffs? And the second is what Anne-Marie was just talking about there. If he does have that authority to invoke IEEPA, did he do so correctly? Did those national emergencies that he declared meet that legal standard required under the law? Of course, those two instances were fentanyl and then those persistent trade imbalances. But John, you're right. We keep hearing this over and over again, that the Trump administration has these other federal authorities, those other tools in their toolkit. We're expecting them to likely double down on those Section 232 investigations and tariffs related to national security concerns if this goes against them.
Tyler Kendall with the latest. Tyler, thank you. Appreciate the update. Tyler Kendall there. Here in New York, for the next 24 hours or so. The president hasn't helped the agenda with recent comments over the past few days when he suggested that he ramped up tariffs on the Swiss because he didn't like the attitude of the person who called him.
Yes, he did. Him and the then Swiss president, now it's a difference, it's Guy Parmelin, but then the former Swiss president, Karen Sutter, they did not have a very good phone call. It got very acrimonious, I've been told, on that call. And the president actually told people, like, this is why I decided I'm going to hold off on the deal for a bit, much to really, it was very difficult for the Swiss in terms of the waiting period for that. Yeah, I'm not sure that helped him.
Kate Kilowitz with this to say, the former White House trade official writing, in a loss scenario, President Trump's focus will likely shift to generating wins in existing agreements through stakeholder engagement and sector-specific investigations. Kate joins us now for more. Kate, welcome to the show. We've been through this issue so many times because we've been waiting for this ruling. It's interesting just how many people expect the same ruling but don't think it will change anything. What kind of precedent would it set for how we put together and form trade policy in the nation's capital?
We are in a time, I think, that has no precedent. We are setting precedent right now. And that, as you described, it comes down to one man and maybe sometimes whether he likes the person across the table from him. So, you know, I'm not sure this is precedential at all, but I do agree with Anne-Marie. I do agree with others who have said, loss or not, this president is clear about his intentions, and I think he is going to achieve them one way or another. You know, the irony, of course, is that if the Supreme Court throws out the IEEPA tariffs or in some way changes the president's ability to use them, you know, this is just going to introduce a whole new range of chaos into the trading market and for companies trying to figure out what to do. We'll have a range of new tariffs they have to deal with.
Kate, what do you think is the base case today at 10 a.m.? What do you think, if the Supreme Court does decide to take up the ruling on IEEPA today, what do you expect them to say?
That's the million-dollar question, and I think we don't exactly know. As you were saying, there are a range of outcomes here. The president has used this authority to implement tariffs in a range of different ways. In some cases, he's very clearly articulated what he believes to be an emergency, whether it's the drug crisis in Mexico or problems in China. But, you know, he also used this authority to say we have trade deficits. That's the emergency. So I suspect the Supreme Court is thinking about all of these different actions and I guess potentially could make, you know, a split decision that some are okay and some need to be removed.
Whether it's Jamieson Greer or Peter Navarro or Howard Lutnick, this administration has made it very clear there is a plan B. What do you think the plan B will be if IEEPA is struck down?
Well, they have all made basically the same point, is the Congress has given the president authority over many years to mess around with tariffs, if we want to put it that way, bluntly. IEEPA is one way, of course, but we see these other actions. 232, of course, is the one that the president has used on sectors. We've seen it in steel, aluminum, cars, a range of others under investigation. He has the 301 authority, which is the baseline for the China tariffs. Even beyond that, there are other authorities that he hasn't touched yet. So I suspect Plan B is a range of these different policy actions, and I suspect, frankly, we've had months now to draw these up. They will move quickly and decisively if the Supreme Court strikes down some of these IEEPA tariffs.
What's the message going to be to U.S. partners and some of these other trading partners that came to an agreement with the administration? Are they going to want to formally enter new talks?
This is probably the biggest question for me because, you know, credit where it's due. The administration has negotiated nearly 20 agreements, I think, really securing wins for U.S. companies in key markets like, you know, India, Indonesia, we heard yesterday, Argentina, Europe, Japan, Korea. These are significant wins for U.S. companies. But, you know, absent the IEEPA threat on the other side, it is hard to imagine that all of these trading partners will remain committed to the deals that they struck with the Trump administration. But let's remember as well, these other tariffs, the 232 tariffs on autos and steel and aluminum and pharmaceuticals and semiconductors, they are components of several of these trade agreements, notably with Japan and Korea and Taiwan and Europe. So I suspect those trading partners, those governments are going to commit and stay in those arrangements.
Kate, we've been talking to you about trade now for a number of years. I was surprised, many others were too, about the posture the United States established with a country like Canada and the unintended consequence of that pursuit. We saw it in the trade data yesterday. Exports to Canada are just plunging, dropping off a cliff. The Canadians are just not engaging with the US economy in the same way, and we see that in the travel data from Canada into the United States. Kate, what's the approach going to be later this year when the Canadian Prime Minister is looking the other way and starting to turn to China?
Well, I think that the Canadian Prime Minister is trying very hard to show that he has other options on the table. But the reality is the Canadian economy is intertwined with the United States. 75% of their exports at least come to the US, and it will take time to diversify. So I suspect there is a challenge for Canada. They have to weigh the political and economic consequences of engaging with the United States. You know, you started this off by describing the president's approach to the Swiss president. I mean, I think this is personal with Canada. And, you know, we have some momentous things coming forward, not least of all, whether we renew or stay in the U.S.-Mexico-Canada agreement. The president and his team in the last couple of days have publicly been saying, you know, Mexico's doing great, Canada not so much. They continue to show that they're prepared to move on without Canada. But I think, you know, again, the Canadians are going to think about what is in their best economic interest. And I think it is to remain with the United States.
Kate, appreciate the update. Thank you. Kate Kalukowicz there, the former White House trade official. Also, got to confront the consequences of engaging with a country like China and the risks associated with a move like that for the Prime Minister.
And also, what does it mean for this country? Do you see what Ford is potentially doing? According to Bloomberg, went to a U.S. official and said we might do a joint venture with Xiaomi and make those cars in the United States. So is it very crystal clear what this administration's posture is towards Beijing?
The economy in Canada will take a hit. If you're running GDP really hot in America and you're not getting a slice of that up in Canada, you're going to feel that. You're going to feel that for sure. Coming up on the program, Alicia Reese of Wedbush saying Netflix's offer is superior to Paramount's in the bidding war for Warner Brothers.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you
the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
We're just about positive on the week so far this morning. We're down a little more than 1/10% on the S&P. On the Nasdaq 100, down by 0.2. Underperformance on a Russell, we're down by a third. In the bond market, at the front end of the curve is where the action has been. Yields drifting higher through the week, encouraged by some hawkish Fed speak and a move in crude that we need to talk about. 346.34 on Tuesday this morning. This is the move in crude. On the session, we're lower. On the week, we're higher by 5%. Much of that move over the previous 2 days. On the year to date, up by 17% on Brent, taking us back through 71.34 is where we trade this morning.
Geopolitical risk premium, you see it bleeding out into prices this morning, higher crude prices. And this is, of course, as the United States is amassing massive military hardware in the region. And you have reports the president is weighing his options in terms of if he does not get a deal, as he talked about, 10 to 15 days is the timeline, then there will be consequences. And the Wall Street Journal is talking about potentially an initial strike to cajole the Iranians to the negotiating table.
Will we see some action imminently over the weekend going into the State of the Union next week? We'll see. Crude softer so far this morning, but much higher on the year so far. As we count you down to the opening bell, 2 hours to go. Let's get you some movers, some single names. Danny has more. Hey, Danny.
Hey, John. The sell-off in Blue Owl continues at pace this morning, already closing yesterday at its lowest since August of 2023. At issue is whether there's a liquidity mismatch when you sell private credit in a wrapper to retail investors. They were facing a redemption about $1.4 billion worth of loans. They tried to fix that by merging two funds. That didn't go together. So instead, they sold off this loan book. And Blue Owl would point to the fact that those loans were sold close to par, saying that it proves that there is liquidity. The market having a different thought on that, though. Of course, there was also a familiar buyer for some of those loans, too. Among others, included Blue Owl's own insurance fund. So those, again, shares falling 4.4%, also about 18% short interest on that fund. Newmont earnings, there's some disappointment that they're going to be producing less gold than they have in prior years. That's because of some upgrades to some of their mines, also less output coming from a joint venture with Barrick Mining. Those shares down 3.8%. And finally, a little bit of a smaller company, but this is a cancer screening development company called Grail. Shares sinking, plummeting 47%. They had a UK study on one of their early cancer detections, and it was not statistically significant. So the disappointment in that study leading to a sell-off, John.
Danny, thank you. Thanks for the update. We'll catch up with Danny again in the next hour. So on our radar this morning, shares of Blue Owl falling. The company selling a $1.4 billion portfolio of loans to help return cash to investors. Blue Owl finding 4 buyers, including 3 of North America's biggest pension funds and its own insurance firm. Elsewhere, NVIDIA nearing a $30 billion investment in OpenAI. The Financial Times reporting the deal replaces a previous $100 billion agreement from last year. This coming as part of the latest funding round for the AI startup. And finally, crude oil trading near 6-month highs as fears of a U.S. attack on Iran are growing. President Donald Trump saying that Iran has 10 to 15 days to reach a nuclear deal. The U.S. is continuing to build its military presence in the Middle East.
Well, the last time the president said there was about 2 weeks that Iran had to come to the negotiating table. Within days, we saw him send over B-2 bombers and went after the Iranian enrichment sites. So 10 to 15 days also could potentially be the president having a distraction right now when it comes to the regime. Interesting, the foreign minister speaking to American reporters saying that the Iranian government hasn't offered any suspension and the U.S. hasn't asked for zero uranium enrichment. But what this administration definitely wants is tighter limits when it comes to enrichment. Plus, there's 2 other red lines: ballistic missiles and the entire support that this regime gives to the proxies in the region.
What negotiations are actually taking place right now?
The negotiations right now is the ones we saw in Geneva with Jared Kushner and Steve Witkoff with the Iranian regime. And then they said they were going to go back to their capitals, recoup, and then 2 weeks later have more negotiations. But Many individuals I talk to say for Iran, this is them just dragging their feet, and this is timing negotiation. Basically, they just are trying to drag this out for as long as possible to keep the president at bay.
6% move in the last 2 days on crude this morning. That rally stalls, 71.34 on Brent at the moment. Let's move on. Let's turn to Netflix. The company's co-CEO, Ted Sarandos, countering a key complaint in the high-stakes battle for Warner Brothers.
We're going to keep Warner Brothers running pretty much like they are today. And in fact, it's even quite better for theaters because now that we're going to be in that business and own a theatrical distribution entity, we're going to take some of the Netflix films and put them through that as well. So it's very likely that you'll have even more outcome of high-quality films for the theaters if this deal goes through.
His comments coming as the Justice Department assesses the deal's impact on theaters. Alicia Reese of Wedbush Securities writing, "We believe that Netflix can create jobs, boost production, and offer consumers more value at a reasonable price. The Netflix deal is superior to Paramount Skydance." Alicia joins us now for more. Alicia, welcome. This drags on. Is it becoming a distraction for the stock?
It is a distraction for the stock, absolutely. The issue is that Netflix is perfectly well balanced as a company without the acquisition. It has significant growth opportunities, particularly in advertising. Now, this certainly would help if they got the deal through for long-term growth, especially if they're able to, leverage their new advertising vehicle throughout Warner Brothers as well and drive that global growth. But they don't need it, and it's certainly been a distraction and has weighed heavily on the stock. But ultimately, we do think, Netflix will be okay without this deal, and the regulatory headwinds are, significant.
Well, Alicia, let's talk about why you believe they'll be okay, and you alluded to it. Do you think we're underpricing how they're positioned to take advantage of a big rebound in global ad growth?
Oh, absolutely. Yeah. And I think without the deal, the shares would have been okay. They did have a bit of a hiccup a couple quarters ago with their reporting, just because, the expectations are enormously high, for the stock because they've been, so healthy for so long. But the ad opportunity is growing. They're adding more capabilities throughout the ad stack. And the ability to do targeting on a global scale is significant with all of the users. And so I think a lot of that performative marketing capabilities that they have or will have and are building are wildly underappreciated at this point.
Because everyone else is looking elsewhere. So let's talk about the elsewhere. One feature, Alicia, as you know, of the hold-up in closing this deal, one aspect of all the complications, theatrical releases. Have they got a PR problem? And what are they doing to counter that now?
Well, going on Bloomberg yesterday and on Matt Bellany's The Town podcast, Ted Sarandos, I think, dispelled some of the concerns around that. You saw, Sean Gamble, the CEO of Cinemark, the other day on his earnings call, noted that, the 45-day window that was promised, it wasn't clear. Is that going to streaming right afterwards, or is that going to go to the TVOD window where you can buy or rent? The actual windowing matters a lot to Hollywood. And so Ted Sarandos did clarify that yesterday, that he does intend to take the titles to TVOD before the streaming window. And that helps a lot. They have an opportunity, Netflix does, to show Hollywood the real intent. They have Narnia coming out later this year. They have it set for an exclusive IMAX release and then going to streaming directly. If they change that to, an IMAX exclusive release and then created a wide release for that with a TVOD window, perhaps, that would give Hollywood a lot more backing for this deal. And that would create a lot less friction.
Do you think they need to do that to really show Hollywood that they're committed to theaters?
I think there's still a lot of skepticism, even with those promises. The skepticism is that they'll do that at first for the first few years, and then they'll shift back to their old ways. And so doing that with Narnia, where they don't have to, I think that would create a lot of goodwill.
I think it's obvious why people think that. Remember, Netflix was the blockbuster killer. You used to get the DVDs in the mail, and what's the point then of why you would want to go to a theater? You say in your note, the bottom line is that Paramount Sky needs this deal while Netflix does not. Why does Paramount need this deal?
Well, Paramount needs it because they're struggling to, get to profitability, and they need more, theatrical and they'll have to cut costs though. They're cutting costs pretty significantly right now with the current integration, and so looking for growth in this market, especially if they have the linear TV deal, and especially if they bring on the Warner Brothers linear as well. There's just a lot that needs to be cut, and there's not a lot of natural growth in that market particularly. So Paramount will have to build on its theatrical releases and build in other areas of the business, and that's not necessarily easy to do organically in its market.
Alicia, just to wrap things up, could I get your thoughts on the other threat to the studio business and the trajectory for the price of content, given the amount of AI initiatives we've seen develop more recently? And we've all seen these examples come out on social media of people just making their own movies. I have to say, it started out not so good, and now at the moment, from what I've seen over the past few weeks, things have moved on pretty quickly. What are your thoughts on the trajectory of things?
They are moving on pretty quickly, but you're seeing the studios come out vehemently against this, and putting out some cease and desist orders. This isn't going to fly because the issue is that those models were learning based off content that they shouldn't have had access to, and they certainly didn't pay for. If there were deals in place that they had paid for to teach those models, sure, but a lot of the AI models are based on content that they shouldn't have had access to, and they certainly didn't legally. And so there are a lot of ways for the studios to protect themselves against this, and hopefully that's swift enough to be meaningful.
Over time, though, for the studios, do you see it reducing the price of content?
I'm sure. I mean, just as, user-generated content has become more and more popular, it creates an alternative, certainly to more expensive content. But, really it comes down to what's the most compelling. And so I think, these kind of combinations, like you see, Netflix wanting to do with Warner Brothers, is more meaningful because, there are a lot of content alternatives out there. But if studios are able to leverage that to get better content to screens faster, that can certainly, thwart some of those AI efforts.
Alicia, thanks for jumping on. We appreciate it.
Thanks for having me.
Thank you. Alicia Reese there of Wedbush Securities. In Alicia's mind, Netflix has got options and Paramount doesn't have as many.
Paramount doesn't have the options. In her mind, Netflix will be fine whether or not they get this deal or not. They do have to do more in terms of convincing Hollywood that they are the right buyers for Warner Brothers, and they will continue to put movies out in the theaters. When it comes to AI, though, Jonathan, the studies that are done in terms of, AI is not going to completely take over Hollywood. There's this nature that you need authenticity, especially when it comes to movies. But production and post-production jobs, those could definitely become a lot harder to find given what is going on in AI.
Yeah, the unions are going to fight, and the companies are too, on some of these issues. Equities at the moment on the S&P, negative by 0.2% on the S&P, with an update on stories elsewhere. Let's get you an update with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. Tomorrow marks 3 weeks since Nancy Guthrie was last seen at her Arizona home. The FBI has received more than 20,000 tips in her disappearance. The Pima County Sheriff says DNA evidence found at Guthrie's home is still going through lab analysis, and several hundred personnel from multiple law enforcement agencies are assigned to the case. Meanwhile, the U.S. trade deficit with China shrank in 2025 to the smallest in more than 2 decades as President Donald Trump's sweeping tariffs reorder global trade. At the same time, the U.S. trade deficit widened to record levels with Mexico and Vietnam as China reroutes its exports. And President Trump is directing the release of government documents related to aliens and UFOs. The president accusing former President Barack Obama of giving away classified information when he discussed the idea of extraterrestrial life during a recent podcast appearance. In the interview, Obama said aliens are real, but are not being held in a top-secret military facility in Nevada. That's your Bloomberg Brief. John?
Yahara, thank you. So inquiring minds want to know, don't they?
I can't wait. The president overnight said that based on the tremendous interest shown, he's going to be directing the Secretary of War and other relevant departments and agencies to begin the process of letting us know what these two presidents are talking about. Honestly, if the U.S. government lied about aliens, I mean, let's just go there. I'm going to be very upset. We deserve to know.
Okay, let's hope we find out. Up next on the program, losing the case for lower rates.
If inflation is still well above, target, and if it's not going to fall very much, it'll be hard even to justify one rate cut this year, let alone 2 of them.
Up next, we'll catch up with Colin Martin of Schwab, live from New York City. You're watching Bloomberg TV.
phone is, what's great about it is it's a well-developed gaming ecosystem, right? So it, you know, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, you know, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, you know, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, you know, basically are gonna like unleash this with a bunch of creators, and they're gonna go figure out stuff that we didn't even imagine that they can do with that interactivity.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Haslida Amin in Davos, Switzerland, and this is Bloomberg.
It is the most read story on the Bloomberg terminal right now. It's this story right here. It's Blue Owl. It's down again this morning at the pre-market, negative by 3.5%. Yesterday, you all saw the reports that Blue Owl said it's restricting withdrawals from one of its retail-focused private credit funds. This is what we understand from the company. Contrary to what has been reported, we are not halting investor liquidity. We're accelerating the return of capital. As part of that effort, this is what we found out today. The 4 buyers for a portfolio of loans to help pay out investors came from 3 of North America last week, but the previous few months. A story we'll keep tracking for you. For the broader equity market, equity futures on the S&P 500 shaping up as follows. We're negative here by 0.2%. The Nasdaq down by 0.2 also. The Russell down by 0.5. In the bond market, yields just about unchanged, elevated through much of the week, bouncing off a year-to-date low, 345.70 on 2s. Under surveillance this morning, losing the case for lower rates.
The data so far don't justify having lower Fed funds rates. If the economy is strong as it is and is accelerating, if inflation is still well above, you know, target, and if it's not going to fall very much, it will be hard even to justify 1 rate cut this year, let alone 2 of them.
So here's the latest this morning. Investors preparing to make fresh bets on the Fed's rate path. A busy morning of economic data on deck, including GDP and core PCE in the next 40 minutes or so. Colin Martin of the Schwab Center for Financial Research writing, good news on the economic front lately, but that doesn't change our outlook for Fed policy. We still expect 1 or 2 rate cuts later this year. Colin joins us now for more. Colin, welcome to the show. What underpins that call for 1 or 2 rate cuts later this year?
Well, it's based on our expectation that inflation will gradually lower from here, but I'll echo the points that Rubini was making in that clip you just showed, that right now, you know, things are going pretty well. And, you know, we're looking at real yields right now. And if we look at where inflation is, still too elevated, and relative to where the Fed funds range is, you know, we're still seeing real yields in the, call it, anywhere from 1 to 1.5 area. If over time we see inflation continue to move lower, that gives the Fed some cover to continue cutting rates. But right now we just don't see it, especially with the improvement in the labor market lately. I think it's too early to tell if the drop in the unemployment rate will be sustained or if it'll hold there. But it's certainly good news that, you know, we're a few tenths off that peak we saw a handful of months ago.
That's an improvement in the labor market. Colin, the attention is on the other side of the mandate at the moment. Will we see a big enough improvement on the other side of things to give them the space to cut interest rates? And when I see forecasts for rate cuts later this year, the justification is often not that we'll see a deterioration in the labor market, but you'll see disinflationary trends take hold and give them the space to reduce rates, which begs the question this morning, how would your scenario shift if we got a spike in crude off the back of heightened geopolitical risk in the Middle East?
Yeah, well, I don't know if it would change too much. We're still, I'd say, more on the dovish side, if I'm going to give our team a descriptor like that, relative to market expectations, 1 to 2. But I think you're right, John, in that we've seen this shift of what's driving expectations. It was clearly the labor market for a while, but with the improvements there, now it's back on inflation. Inflation's still too high. We're hopeful it can come down, but it's still too high. With the pickup in crude, if that leads to let's say, just stabilization, or worse, a potential increase in inflation, that would make it more difficult to cut rates going forward. But also, I think just the general economic momentum right now. The economy is doing okay. It's been growing at or above trend for a number of quarters right now. And if we look into 2026, obviously there's a lot of headlines about tax refund season, what the impact of the fiscal stimulus from last year's One Big Beautiful Bill Act means. I think that can keep growth going, keep spending going. So I think there are some headwinds for inflation that can keep it elevated. So I think that's a key reason why we're not expecting the Fed to do anything soon. If we do see those improvements, and maybe it would take somewhat of a slower economic growth trajectory to bring inflation down a little bit, that's why we would see those rate cuts. But I'm fully on board with the risks you're talking about. If inflation is staying not just north of the Fed's 2% target, but in the 2.5% or 3% range, to us, that's still too high for the Fed to consider cutting rates.
There was a recent report about how Americans are bearing the brunt, 90% of the tariffs enacted by this administration. Today at 10 a.m., the Supreme Court might rule them illegal. Do you think that has an impact on the inflation story going forward this year?
Yeah, it could. If we look at we've seen that study. Obviously, studies have made a lot of headlines. Has it
for other
translated
reasons?
into the Exactly. I'll leave that for other guests to discuss. Has it shown up in the inflation data? You can make the case that the tariffs have impacted inflation, but it's impacted, obviously, the things that are imported, specifically on the goods side. So if you look at the big picture inflation readings we get, it's tough to see that actual impact. But if you dig in, there is an impact there. So does that change our view? I'd say not much, because it really only appears to be impacting it at the margin. If you dig deep in, and it doesn't appear to be changing inflation expectations too much. If you look at inflation expectations, specifically market-based ones from tips, break-evens, and things like that, they've been pretty steady for the past few years. So I don't think our view is going to change much, regardless of what happens with the Supreme Court tariff announcement.
Hey, Colin, we got this post from the president just moments ago on social media. Let me share it with you. It says the Democrat shutdown cost the USA at least 2 points in GDP. That's why they're doing it in mini form again. No shutdowns. Also, lower interest rates. Too late powell is the worst. So let's just go with the first line, that it cost the USA at least 2 points in GDP. I'm sitting here, Colin, trying to decide whether he knows the GDP print, and he's basically given us a number. What's your interpretation of this?
Really put me on the spot this morning. I'll put it this way. So GDP is expected to be strong-ish last quarter, despite the government shutdown. I think there should clearly be an impact to our GDP numbers. And I would assume that's the president trying to explain why, if it comes maybe on the low side. But even if it comes low, it's still okay. And that's our theme right now, that we're seeing growth at 2% or more on an annualized basis. And I think that's a good thing, even if we saw that government shutdown. And if we look ahead, I think growth's going to continue to be strong. So I'm not going to get into the weeds of what happens for one specific quarter, because we think the trend is still pretty resilient.
Colin, just before you go, you're a fixed income guy, and I'd love your reaction to developments in private markets. A lot of focus on redemptions of certain funds of certain companies. But when you look across fixed income, both private and public at the moment, markets across the board, do you see a tightening of financial conditions? Are things still loose? Any credit stress that you're concerned about?
There doesn't appear to be too much credit stress. I can't say no credit stress, because we are seeing it. We focus more on the public markets just because that's where we can see the data. And we're seeing a bit of a bifurcation right now. High yield bonds, kind of the benchmark for leveraged finance through the years, is still doing well right now. Year to date, the Bloomberg High Yield Bond Index is up. Spreads are still low, although they've been bouncing around. And we don't appear to see too much stress under the surface. We're seeing some concerns in the loan market because there's a lot more tech exposure there. The Bloomberg Leveraged Loan Index is actually down year to date. So we're seeing this kind of diversion between two what many people would think are similar investments. So we're seeing them move somewhat in opposite directions. But generally speaking, we're okay taking some risks because we just haven't seen any stressors really spread into the broad market. So for our investors at Schwab, if you're willing to take a little risk, we think actually high yield bonds are potentially an opportunity there. On the private side, it's tough to say if these things are good or bad in a vacuum, but I really think it comes down to the liquidity and investor profiles. And you've kind of gone over the headlines just this morning before we started talking about who's buying these bonds or these loans from Blue Owl. And it's pensions funds, it's insurance companies. These are the traditional buyers of private capital. And they view them as their long-term sleeve or permanent capital sleeve. And when we have a new investor base come in who doesn't necessarily think that way, who's used to getting in and out, I think that changes the dynamics a little bit. So again, I don't know if it's good or bad, but I think it's just investors need to know what they're getting into so that they're prepared to hold these things for a while.
Hey, Colin, good to see you. As always, thank you, sir. Colin Martin there at Schwab on the latest in fixed income. Up next, Jitanya Kandari of Morgan Stanley, Dana Towsey of the Towsey Advisory Group, Kathy Bostjancic of Nationwide, and Tony Wong of T. Rowe Price. The third hour of Bloomberg Surveillance, just around the corner.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
every decade, there's more evolution out of the S&P 500.
The three largest sectors representing the S&P are down on the year.
This is the most transformative trend that I believe we will see in our lifetime.
I wouldn't be surprised if we start to see a little bit of move back into tech. Trying to predict when these things are going to pop is a fool's game.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. Your scores, the price action looks like this. We're down 1/10% on the S&P. After snapping a 3-day run without losses on the S&P 500 in yesterday's session, we add to them this morning. The Nasdaq is down by 0.14. The Russell is down by 0.37. In the bond market, after drifting higher all week, 2-year yields this morning turning just a little bit lower. The 2-year at the front end, 3.4528, 10 still just north of 4%. Coming up a little bit later this morning, 29 minutes away, we'll get some data, core PCE and GDP. On GDP, the president with this to say just moments ago out on social media, the Democrat shutdown cost the USA at least 2 points in GDP. That's why they're doing it in mini form again. No shutdowns, also lower interest rates. Too late, Powell is the worst.
So you have to think, is the president just looking at some of the analysis that has come out? And a lot of people have talked about this GDP report will cover the longest shutdown in modern history. So potentially that means growth would have cooled, even though it was robust. And I think annualized pace, individuals are projecting 3%. Or did the president see the report and is somewhat leaking and telling the market, I've seen the report and this is the reason why it's lower than, what was Howard Lutnick talking about, north of 4 or 5%. At one point, the president interview said 15% when it comes to growth. So I think that's a question I asked the White House, and I'm waiting their response.
When you get that response, share it with us.
Absolutely.
We're looking out for that ahead of the State of the Union next week. Looking out for this as well. A move in crude. Let's bring up the prices this morning. Pulling back by 0.4% on Brent, down by about a third on WTI, following a big 2-day spike over the previous 2 days off the back of a couple of reports indicating we're getting closer and closer to action in the Middle East.
And those reports are going along with what we're seeing in terms of maps and military hardware moving into the region. We're going to have another U.S. aircraft carrier landing there by Saturday. Biggest military buildup, as we talked about yesterday, since 2003, and the invasion of the United States when it comes to the Iraq War. And now the Wall Street Journal has this report yesterday that's talking about what the president potentially the thinking would come if he decides to go for initial strike. Initial strike to get the Iranians to the table to have this negotiation, this deal. And if that falters, potentially then it's a longer, protracted regional war. And you have to think the immediate response the Iranians would do to retaliate is going to hit energy facilities as well as potentially close the Strait of Hormuz and go after tankers. And that just means oil is going to go higher.
Brent crude this morning down by about 0.4% following a big rally this week. Up on the week by around 5%, 71.38 on Brent. Coming up this hour, we'll catch up with Jitanya Kandari of Morgan Stanley Investment Management with stocks edging lower. Kathy Bosjancic of Nationwide breaking down the latest inflation data, and Tony Wong of T. Rowe Price looking ahead to earnings from Nvidia. We begin this hour with stocks adding to losses after snapping a 3-day winning streak. Jitanya Kandari of Morgan Stanley Investment Management writing, we see a shift from concentrated sources of growth and returns to a greater dispersion and wider set of opportunities, both within the US and across global markets. Jitanya joins us now for more. Jitanya, good morning. How are you considering developments in the Middle East and the risk aversion we're starting to see and a move in crude off the back of threats of military strikes in Iran?
Yes, I do think that the probability of that is clearly rising. I do also believe that the Middle East is now one of the middle powers, as you can see, that region between the Western and the Eastern Hemisphere, which is getting dominated by US on the West and China on the East. And that region is becoming very critical from a logistics standpoint, from a trade capital standpoint. So I do think that the higher likelihood of tensions in that is going to cause some market volatility.
Geopolitics is traditionally very, very hard to predict, so I'm not going to put you on the spot and ask for a prediction. I'd like to go through a range of scenarios, one in particular. If we do get another spike higher in crude, and year to date we've already seen a move of almost 20% on crude, whether that would upend some of the cyclical trades that a lot of people have gained some enthusiasm for coming into 26.
I think the most important manifestation of an increase in oil prices will be on the CPI. And I think that the inflation outlook, which has been relatively okay, even the expectations of core PCE in our models is about 2.7%. If assuming crude prices at these levels. So I think that can really be detrimental to the inflation situation, which then leads to the rate story and therefore, of course, some of the cyclical trades unwinding. And so that's something to keep in mind. But I do not think our base case view here is there is still supply, there is still OPEC capacity to supply oil. So there could be an interim move, but I think overall, the demand-supply situation is not justifying a spike in prices once the dust settles.
Could it, though, galvanize the hawks on the Fed to potentially want to continue their wait-and-see mode or even hike?
Yeah, I mean, I think that, the interest rate expectations in terms of 2 cuts are the maximum we can get. And based on the current CPI and the PCE at 2.7%, as I mentioned, I think that at these levels, one can expect maybe a cut or maybe none. So that will definitely be an issue for Fed cuts.
When do you have your first cut priced in?
Next year.
Next year. So
Yeah.
this whole year will be wait-and-see mode when it comes to Federal Reserve. Is that even possible to Kevin Warsh at the Fed?
Well, I think it's going to be a function, as I said, of inflation, but also employment. And that clearly there has been some stabilization, but we're not out of the woods there. So there will be an equal emphasis there. So I think we could definitely see a cut, but the fact that QT is over and the Fed is expanding their balance sheet, that may be under question under Warsh because he has not been really a proponent of that.
Let's stay on equities. On the equity side in the US, the rally stalled at the index level, and we can see that the S&P within around 2% of all-time highs. It's taken off elsewhere, Japan, South Korea. South Korea's had a massive move year to date. And EM equities, looking at the EM equity story for year to date, double-digit gains so far. What's happening there? What am I buying? What's the story at the moment? What's the bet?
I think you're buying uncorrelated sources of alpha outside the AI trade and the maximum juice on the AI trade, which is the AI enablers. So in Asia, it's a lot about the semiconductors, the networking equipment exports, the capex that's coming with those exports, and the net worth effect that's happening with the buoyancy in exports. In pockets of Latin America, you have a commodity tailwind because a lot of these countries are actually in the critical mineral supply chain and copper and uranium and all that we need to power this AI story. And then in Eastern Europe, you have spillovers from pockets of Europe and the stimulus there. So the core versus the periphery versus Eastern Europe, I think the smaller cap countries look interesting, which are in the emerging space. So different sources of drivers across different regions, which is powering this. And lastly, the monetary and fiscal orthodoxy in the EM world has been much more superior than the DM world. So that is showing up in terms of central banks cutting rates, in terms of fiscal balances being in a much better situation than the developed world, especially the US.
When you look at the backdrop, how much of it is a cyclical story versus secular? Is it a mix of both?
It's a mix of both. I'd say one interesting theme that is developing in North Asia specifically, which seems to have structural legs, is US will not be able to really onshore everything, right? Whether it's shipping, some electronics, biotech, automation, robots, and that supply chain, the autonomy supply chain. They won't buy from China, but they'll buy from North Asia, which have export similarity like China, and where those vendors will be US preferred in terms of supply of all these things. So I think that's another area outside semis and tech that is seeing momentum in terms of the markets.
So you want to be exposed to those, what potentially are these partners with the United States when it comes to national security and core features of the AI trade?
Right, and even like shipping, in autonomy. Look at the robot density in China compared to the US. So the second derivative plays of sensors and LiDARs and everything that is in the supply chain of autonomy, which is coming on the factory floor, in the low altitude economy, in space. So yes, I think Korea, Japan are some interesting markets there to source a lot of this, because China is going to not be the preferred vendor.
Do you think the midterms will be a catalyst to potentially pour money back into the United States because there'll be looser fiscal policy?
The interesting thing is that, there has been de-Americanization on the trade side, where regional trade blocs and trade deals are being made. On the capital side, interestingly, we are still seeing a lot of FDI come into the US. So I think that is because part of the trade negotiation has been bring capital back. I was at a healthcare conference. A lot of the companies said we're bringing manufacturing back. So I think that seems to happen and will continue. But I think the big thing on the midterm is, what does the Democratic win of the House mean? We've seen a lot of Trump trades in the market. Does that come under question? Gold is a Trump trade, regional banks and deregulation. So I think one has to be really discerning, because that could have some sentiment impact tactically in the market.
You think the financial story is vulnerable?
I don't think the financial story is vulnerable, because I do believe that the consumer and the private sector from the banking side is delevered in the US. There's no excesses. The excesses are residing more else, in private, probably. But I don't think it's vulnerable, but I think there has been a decent momentum trade there, and one has to be just discerning.
Can we finish on that on private markets? So I'm not going to talk about the story too directly, because I imagine you can't talk to it directly either. I'll talk about it in general terms. When you start to see redemptions and certain funds struggle to meet redemptions, people start to have concerns about what's developing. And the story this morning, of course, is Blue Owl, and the stock is down again by 3.7%. Do you see risks of contagion, broader systemic risk emerging here, or is leverage so much lower this time compared to, say, 07, 08, that you can have pockets of instances like this that don't necessarily mean we've got bigger problems around the corner?
Yeah, I don't think there has been an excessive and a systemic crisis in the making here. Of course, that market's grown because the banks have retreated due to all the regulatory issues. Some of that will, with the deregulation, the banks will come back into that space. So the returns you made in private credit in the last few years, maybe you cannot make those same amount of returns. But there have been very strong players in this space, and I don't think this will lead to a systemic crisis, but definitely there is more competition in that space coming from the traditional banks.
Given how much, though, this economy increasingly has become dependent on being powered by private markets, do you think the economy in general could be vulnerable to a tightening of credit conditions?
I really don't believe there is a systemic crisis here, because in the history of markets, there is crisis only when there's excessive leverage, when credit grows way above GDP. Our thumb rule is when credit grows 20% more than GDP over a 5-year period, that is a red flag. I don't see that in pretty much many pockets of the world. Like, you don't. A lot of the credit side, there's been deleveraging. So yes, there's been retrenchment on the households and the corporate side in traditional banking channels, and some of these pockets have grown, but there is not like an excess in terms of empirical numbers.
Jitanya, good to see you. Thanks for your thoughts. Lots to think about. Jitanya Kandari there of Morgan Stanley Investment Management with an update on stories worldwide with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Hi, John. Blue Owl facing another day of losses. Shares are down 3.7%. The private credit giant selling a $1.4 billion portfolio of loans to help return cash to investors. Blue Owl finding 4 buyers, including 3 of North America's biggest pension funds and its own insurance firm. The sale was part of a plan to return cash to investors in the firm's Blue Owl Capital Corp. 2, a strategy aimed at retail investors. NVIDIA is close to finalizing a $30 billion investment in OpenAI. Financial Times reporting this will replace the long-term $100 billion commitment the companies agreed to last year. Negotiations are in the final stages and could be finalized as early as this weekend. And Senator Elizabeth Warren weighing in on the recent rift between the Federal Reserve and the White House. Senator Warren demanding that nominees to the central bank commit to protect independent research after any Director Kevin Hassett blasted a recent study from the New York Fed. Warren says nominees should swear under oath to not silence the Fed's independent research. That's your Bloomberg Brief. John.
Yahara, thank you. Thanks for the update. Up next, the morning calls plus Dana Telsey of the Telsey Advisory Group gearing up for a fresh round of data. That data 15 minutes away. Live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
We have core PCE coming up. We already know the vast majority of inputs to PCE. While it's new data, it's also kind of realized at the subcomponent level. And so, for example, when we map all the individual components, we actually think core PCE is coming at a decent 0.4%. above what is listed as the Bloomberg consensus.
That was a bit of a clinic from John Hill of Barclays a little bit earlier on this morning. Check out the full interview on Bloomberg.com and, of course, the terminal and on YouTube too. Equity futures this morning shaping up as follows. Equity futures on the S&P negative by 0.05%. Ahead of that data 12 minutes away. On the Nasdaq, we're down by 0.07. On the Russell, small caps down by about 0.25%. That's the price action. Let's get you some morning calls. First up, RBC raising its price target on Wayfair to 92, noting strong results despite a muted outlook. Elsewhere, Bank of America raising its price target on Deere to 672, citing the company's first big beat and raise in years. A stock a little bit lighter, lower, softer this morning, down by 0.5%. And finally, Bernstein raising its price target on Walmart to 134. The firm expecting Walmart to deliver in the fiscal year and recommends buying on weakness. A stock a little weaker this morning. We're down by 0.2%. Let's stick with retail. Earnings season painting a mixed picture after Walmart's tepid forecast. A fresh read on the consumer still ahead with core PCE inflation data just around the corner. Dana Telsey of the Telsey Advisory Group writing trade policy, geopolitics and tariffs remain key drivers of global supply chain costs, complicating margin management and pricing strategies. Dana joins us now for more. Dana, good morning.
Good morning. Thank you for having me.
It's good to see you. Let's start with Walmart. So conservative guide. Lots of people came on and said that's just about setting the bar lower for the new guy, the incoming CEO. Did you like what you heard on the call?
I did. Look what you heard. You heard about fashion apparel being up mid-single digits in comps for multiple consecutive quarters. You heard about tariffs and that the brunt of price increases have already happened. You've heard that their technological investments are paying off. The speed and convenience that they're offering the consumer, they're capturing a wider base of consumers from all different income levels. That sets up the stage nicely for next week. Can't wait to hear TJX's numbers, given that they've been a traffic beneficiary.
So when it comes to Walmart, though, and this guidance lower than the street was expecting, do you think that is just them doing what Jonathan said, conservative, because it's a new CEO at the top, and you expect that guidance to rise then, based off the call?
I think you keep going throughout the year. You have a first quarter coming up, which still has some tariff headwinds in it. Then you have the second quarter moving along. You've got the tax refunds that are coming in. That should be a sales driver, particularly in the first half of the year. So let's see what it looks like. They gave a wide enough range that there's a lot of places that they can go, and the investment spending should deliver returns.
Who else do you like in that range? The individuals that are going out shopping at Walmart. What other retailers are doing well like Walmart? Is it Target and Costco or no?
Not Target, it's Costco, but it's also TJX. Let's see what TJ reports next week. Keep in mind, TJ has diversity of categories, home and also apparel. They don't have food, because remember, Walmart is 60% food. That's different than apparel. Target reports their earnings on March 3rd. You have a new CEO there too, and he's going to have to lay out the game plan. It's a different story at Target than it is at Walmart.
Dana, so much of the last year or so, in fact, the last several years, the retail landscape has been about the success at the top and the bottom of the K. So at the very top, you've got ultra-luxury Hermes, LVMH, and at the bottom end, you're capturing the trade down, the discounters, TJX. I think some interesting stories happening in between now, and Ralph Lauren is one of them. Can you give us your thoughts on what's happening with that name, what the management team are doing to capture this moment?
A couple weeks ago, I wrote this piece on enhancing the core. One of the things you're seeing legacy companies do to reinvent themselves, they're taking their core product offering and updating it, modernizing it, and rejuvenating it. That's what Ralph has done. At the same time, they're also, as they call it, expanding for more, whether it's women's, whether it's outerwear, whether it's accessories, and they're doing it globally. And they're doing it with their own DTC business, in addition to having a stronger wholesale relationships with some of the department stores and other vendors they sell through. And let's not forget the awareness. Olympics, it's going on now. What do you see? You see Ralph Lauren. You think about all the tennis matches, whether it's the Australian Open, the US Open. So their awareness is going among a broader consumer. They're able to get some higher margins, and they're driving it through product that people want at a higher AUR. We're seeing legacy companies reinvent themselves. And for discretionary in 26, let's watch Victoria's Secret, let's watch Urban Outfitters, and let's watch The Gap.
Well, when it comes to Ralph Lauren, they're unapologetically American, Americana. We saw really American Eagle also lean into this. Is this a new phenomenon in fashion that some of these brands are leaning into that legacy of nostalgia of being an American brand?
I think there's legacy. It's American, but it's also newness, because what these brands are also doing, partnering. You talked about American Eagle, Sydney Sweeney and Travis Kelce. It mattered.
And Martha Stewart.
Yeah, yes, it mattered. It meant something. You look at Abercrombie, NFL. They're the fashion partnership with the NFL. You look at Gap, and frankly, the creative direction of Zach Posen with the Gap brand, and frankly, some of the partnerships they've done on the music side have driven interest in denim. That matters, and I think we're seeing that.
After New York Fashion Week, obviously everything moves to Europe. Moncler overnight had incredible numbers. A lot of this would be driven by China. What is your take right now about the Chinese consumer?
I think overall something to still be watching. I think we still need to see the strength rebound. We've seen some improvement in travel retail, but you need to see the European luxury goods do better in China.
What do they like right now? It used to be the cliche, the stereotype was just big brands plastered over everything, big logos. Has that changed?
I think some of it is their own Chinese brands. I think that's what's been different.
That's a shift.
Yeah, that's a shift. And it's been that way for the past year or two, and that's what's made it more difficult for some of the international brands.
So we're starting to become more accustomed to some of the Chinese brands with regards to the automobile industry. What are the names that you're tracking at the moment that maybe in the West we need to be slightly more aware of?
Oh, I think basically I'm looking at the European luxury goods names and some of the American names over there. When I think of Chinese names coming over here, it is the auto names that come top of mind.
BYD. It's amazing how quickly that has dominated a market like, say, Europe, and increasingly the one to watch is what happens north of the border in Canada.
Yep, Canada potentially willing to have more Chinese electric vehicles coming in. Also, this country, we have a report that Ford executives talked to U.S. officials about a joint venture with Xiaomi. Do you know why? They can produce these EVs in less than half the cost, basically, of, say, a Tesla. Remember that $7,000 BYD that looked like a brand new luxury car?
Nuts. Dana, just quickly, home bias, forgive me, New York.
No worries.
We've had some bankruptcies, Saks. What's going to happen with Bergdorf's around the corner?
We'll have to see. So far, they're keeping it. The new CEO, Jafar Van Ramdank, wants to try to put the business back together. I'd have always thought that LVMH would have had an interest in Bergdorf's, and then you'd have them having all four corners of 57th Street.
Yeah, that corner would be ridiculous.
Amazing, right?
Just own the whole thing.
Yeah.
Okay. All right, Dana, good to see you. Want to
Thank
watch.
you.
Thank
Nice to see you.
Thanks for dropping by. Dana Towsey of the Towsey Advisory Group. Ahead of this inflation data, a better story to tell coming out of Walmart to basically communicate to people on the call yesterday and through various communication efforts to suggest that the normalization in pricing story, that's done. The tariff bump might be over.
Tariff bump might be over, but you have to ask, what is going to happen in terms of the Supreme Court decision today? Do you see more companies lining up, want the rebates, only to then have to pay the tariff rates when the administration then enacts new policy?
So let's get to that economic data. Up next on the program, the latest PCE and GDP data set to cross. Mike McKee will break it down. We'll get reaction from Kathy Bostjancic of Nationwide in just a moment. Into that, here are your scores. Equity futures on the S&P softer by not even 1/10% on the S&P 500. In the bond market, yields just about unchanged to the front end of the curve, down a single basis point on 10s, 4.056%.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
seconds from now, a ton of economic data. Mike McKee challenged with breaking that down for you in just a moment, so bear with us. Going into it, your scores look like this. Equity futures on the S&P, just about unchanged on the S&P 500. Likewise on the NASDAQ. In the bond market, yields shaping up as follows. Across the curve, 2s, 10s, 30s look like this. Down at the long end on 10s by a basis point, on 30s by about the same. Your 10-year 4.05, your 30-year 4.68. With the economic data, let's cross over to Mike McKee for more. Good morning, Mike.
Good morning, John. We're waiting for it to drop here from the Bureau of Economic Analysis. It's not out quite yet, but any second now. Here we go. The numbers for GDP annualized, only 1.4%, raises the question, did Donald Trump leak something he wasn't supposed to? Personal consumption spending, only 2.4% higher. The personal income and spending numbers are more in line with what was anticipated. Personal income up 0.3, same as last quarter, same as last month. These are monthly numbers, and it is the same as forecast. Personal spending up 0.4. That's a little bit stronger than anticipated. The consensus was for a 0.3 move. Now the inflation numbers, the price index on a month-over-month basis up 0.4. On a year-over-year basis, it goes up from 2.8% to 2.9%, so a rise in the headline. The core up 0.4, and the core year-over-year is up to 3% from 2.8%. That is something that does not look particularly good if the Fed wants to cut interest rates again. But again, these are December numbers. We've got the January CPI. Next week, we get the January PPI. I'll break down more of the detail, John, and you can tell us if we're getting much reaction yet.
Yeah, I'll get to some of the price action for us, Mike. Equity futures still a little bit lower, down by about 0.1%, down by 0.2. You're seeing that play out on the NASDAQ, on the Russell, down by 0.5. If we switch on the board and turn to the bond market, so yields coming into this, we're down about a basis point at the long end of the curve. This is where things stand right now, just about unchanged. So we're raising some of that move. 10 still around 4.06%, 30 still around 4.70. Mike McKee, I'm going to turn to that post from the president in the last hour or so. And if we can bring that up on the screen for our audience who might have missed this. This is what the president put out on social media going into this print. He said the Democrats' shutdown cost the USA at least 2 points in GDP. That's why they're doing it in mini form again. No shutdowns, also lower interest rates. Too late, Powell is the worst. But that first line, Anne-Marie, the Democrats' shutdown cost the USA at least 2 points in GDP. Put that together with the print we just saw. People are going to start to ask some questions about what the president saw and how quickly he decided to say something about it.
Well, absolutely, because fourth quarter GDP came in at 1.4%. The market, the survey was looking for 2.8%, and the prior reading was 4.4%. So just before the print came out, the president took to Truth Social and said, oh, you can expect a much lower print, and it's the Democrats' fault. And many analysts were saying that it is going to be a bit of more of a weaker, cooler print because of the longest shutdown in modern-day history. But you have to ask, is the president seeing the data and then going to the internet and telling the world what to expect before the data comes out? And, you know, usually you're not supposed to do that.
And not for the first time either. Mike, to bring you back into the conversation, let's get to the essence of what the president's getting at here. How much of the downside surprise on GDP was driven by the government shutdown, and how can you tell?
Well, I'm trying to dig into that right now, John, but the internet is slow. Everybody hitting the refresh button on this one. But the way you'd look at it is non-defense spending by the federal government and what kind of contribution that made to GDP. There was a feeling, and Omar Sharif had put out a note on it this morning, that the last time we saw a long government shutdown like this, the way the BEA kind of calculated it was to take away the value of the hours worked by federal employees since they weren't working, and then that translated into higher inflation, which then translated into lower output. You subtract the inflation from the overall output numbers. So that may have been one way that it happened as well. I'm looking to try to find all this data. We're just getting the number breakdown now And I can, we talked about how consumer spending was just 2.4%. Business investment, non-residential fixed investment was 3.7%. Structures down 2.4%. That's the second quarter or fifth in a row that we've seen that. I guess a lot of this AI build out is coming in as equipment because equipment purchases were up 3.2% and intellectual property up 7.4% on the month. Inventories down 13.6 billion. That's not as much as the prior quarter, 23.9. So that doesn't add to GDP. And net exports, a negative 949.6 billion. It's almost unchanged from the third quarter, and that does subtract somewhat from GDP. Real final sales, 1.2%, and final sales to private domestic purchasers, 2.4%, same as the GDP number. So it does show a weakening economy in the fourth quarter. The question is, again, what did the government have to do with that? And I've got that number right in front of me now. Government consumption, federal national non-defense spending subtracted 0.7 of a percentage point from the GDP numbers. So it wasn't what the president said. The president was right about the fact that the government shutdown apparently did subtract something from the overall GDP number, but it wasn't 2 percentage points.
Mike McKee, thank you, sir. Fourth quarter federal spending fell at the fastest pace since 1972.
Well, are you surprised, given the fact that this was a more than 40-day government shutdown, the longest we've seen in modern day history, and this is why you see that federal spending just absolutely drop and sink because of that. Now we actually are in another government shutdown when it comes to DHS, but it's not going to have the same sort of impact on GDP.
Not seeing a massive impact on this market this morning either. Equities a bit softer, down by 0.2%, and in the bond market, yields essentially back to where they were. We're down a basis point on 10s to 4.06%. Joining us now to weigh in on all of this is Kathy Bochantic of Nationwide. Kathy, giving you about 6 minutes to go over some of these details. What jumped out to you, and what kind of read can we actually have about the underlying economy away from the messy politics?
Yeah, hi, John. So surprising headline number as you went through, much softer GDP, but the government sector really dragged on economic growth. So when I looked at it, federal outlays detracted 1.2%, it looks like, from headline GDP. So if you add that to the 1.4, right, if you add it back in, you're closer to what the consensus was looking at. So I think that was the big miss. It's just how much of a drag we got from the government shutdown. I think the other thing is net exports added less to GDP growth. This is a bit technical, but I think the trade figures yesterday, because the deficit blew out so much, it actually reversed a lot of the positive contribution most of us were looking for. So I think net, how do you look at the number? Well, consumer spending still looks strong, and as you highlighted, AI spending still looks strong. So I don't think it changes the picture all that much. If anything, we should probably get a rebound in federal spending and outlays now the government is up and running. So that will rebound and bolster Q1. So we probably are going to have to go and look at our Q1 GDP forecast and boost those a bit.
So, Kathy, what would you expect for Q1, and what's the trajectory from there into year end?
Yeah, so I think we start off Q1 on a pretty good note because, not just the swing, but we have at least $50 billion in additional tax refunds coming for the consumers. We have generous incentives for businesses to invest, and that's even away from AI. And we know the hyperscalers have ramped up by $200 billion or so their spending compared to last year, or at least that's their plans. So I think we could see GDP growth, somewhere, certainly mid 2% for Q1, maybe even as high as, going up to 3% for Q1. So I think the momentum here is good for domestic activity. And I also think the policy mix, fiscal policy, along with monetary policy, is very positive.
They're the tailwinds, Kathy. Here's the big question for the labor market. Does that hotter GDP story translate into better and broader jobs growth?
We think so. We think we've seen signs of that. I mean, even before the January number, which surprised to the upside, we had seen signs that private hiring was picking up, and even beyond healthcare. And healthcare, I think, will remain strong, and that's fine. That's a secular trend. But if we start to see investment pick up, I think we'll start to see some firming in employment. I don't think it's going to be a boom. I still think there's going to be a lot of productivity gains propelling GDP growth. But I do think we get a little broadening out. I think the one thing I'm a little concerned about this morning was the PCE price index. That came up 0.4 in December, both the headline and core. That's about 1/10 stronger than what we were expecting on both. So we have to watch inflation. We still believe, and we'll take a look at the numbers, but we believe that service inflation is trending lower. The tariff impact, as previous guests talked about, is fading. So that should set us up for inflation peaking sometime in the Q2 of this year, and then second half of the year moves lower.
That PCE is also what, of course, the Fed looks at in terms of their favored inflation gauge. Do you potentially think that this means they're going to be on pause for longer this year?
Well, we thought they were going to do that anyway. We were thinking that they needed to wait to see inflation peak, and we did think the year-on-year rate was going to accelerate, both for PCE and CPI. There were distortions with the government shutdown, of course. I think if it peaks and starts to trend lower, it still gives the Fed the ability to cut rates. And I think with the worse Fed, there's going to be an inclination to lower rates. So for now, we're still looking for 50 basis points of rate cuts.
Isn't that going to be challenging, though, for a Kevin Warsh to come in with a little bit higher inflation, given the fact that he was an inflation hawk at one point of time?
Well, I think he's made his current views very clear. He's pointing out that productivity is disinflationary, which it is. In the near term, it may not be so. But I think that we're going to get the service side cooperating. And I think if the tariff impact indeed fades as we think, I think that gives him the room to say inflation's slowing, and it'll slow even further once productivity, AI really impacts the economy.
Hey, Kathy, always good to catch up. It's good to see you. We'll let you go. Kathy Bosch-Jantic there of Nationwide, breaking down the economic data from moments ago, and there was tons of economic data. Mike McKee's going to jump back on and break down the details. Mike, you've had a second look at things. What do you see?
Well, the BEA has put out a note on what happened with the federal government shutdown, and basically they say what we were anticipating, that they have subtracted the contributions or the lack of contributions from employee work hours, federal employee work hours, from GDP, and it subtracted 1/10 or 1 percentage point from GDP. So if not for the shutdown, it implies it would have been 3.4% for the fourth quarter. Now, the important thing about this is that all that will come back because the employees they got back pay. So all that will calculate into the first quarter GDP, and we should see a rebound there. Another thing on GDP, 2.2% for the year of 2025. That's also a little bit lower than people had been anticipating, given what we'd seen in the third quarter in terms of growth. And then one more thing on the personal income and spending. Wages and salaries only rose 0.2% during December after 0.5 in November. So that's a fall off, and it may be one of the reasons that people cut back on spending some.
Mike McKee, thanks for jumping on and doing that for us. Mike McKee breaking down the economic data. From now, if you weren't already, ahead of major data releases, people will be glued to the president's social media account looking for clues as to what's about to happen in the economic data.
That's all I kept thinking at 8:30 is, and make sure you have your Truth Post social network on alerts to make sure that, the president, he's going to get briefed the night before, the morning of. CEA gets them the afternoon before. And now every time he posts about data, you have to consider, is this the president speaking because he's seen the actual data and he's been briefed on it? Or is this just him, looking at the same research we are and deciding that this is potentially the analysis he wants to go in before the data release?
Apparently not, based on that downside surprise on GDP just moments ago. Constructive stories to tell, though, still, from Kathy Bosch-Jantic of Nationwide about the future and the prospect of bouncing back over the next several quarters. With the economic data and a whole lot more, let's get it all wrapped up for you in your Bloomberg brief. Here's Yahira. Hey, Yahira.
Exactly, John. Recapping the data we just got, core PCE rising 0.4% in December, a tick above estimates that called for 0.3. The year-over-year number rose to 3%, also above estimates. Elsewhere, as you were saying, fourth quarter GDP annualized rose just 1.4%. Expectations called for 2.8%. President Trump blaming that on last year's government shutdown in a post on Truth Social. Meanwhile, speaking of the president, the Palm Beach airport is getting a presidential rebrand. It will be renamed Donald J. Trump International after Florida lawmakers approved the renaming, with Governor Ron DeSantis expected to sign it into law. The renaming requires FAA approval and an agreement with the name's rights holder. The rebrand will cost $5.5 million. And in the Olympics, the U.S. is taking home its first gold medal for women's figure skating in 24 years. 20-year-old California native Alyssa Liu delivering a flawless performance after opening with a daring triple flip. She edged out two Japanese skaters to become the first U.S. female skater to win gold since 2002. I highly recommend everyone go watch that. That's your Bloomberg Brief, John.
Very cool. Absolutely crushed it. Crushed it just yesterday.
First thing I watched when that was over, when they uploaded to Twitter, I was like, wow, this is incredible. And also, we need this. We haven't won one in 20 years. It's incredible for the USA.
It's been a while. Up next on the program, Tony Wong of T. Rowe Price looking ahead to earnings from Nvidia. Plus, Danny, as your morning movers blew out, falling on more concerns in private credit. That name is down in the pre-market by 4%.
Crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary. We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
There's many things to be worried about, but we do have to think about bigger picture. How does the world look for the equity market? Well, we're expecting double-digit earnings growth. Analysts are revising forecast higher rather than lower. Nominal GDP is very high, and the Fed is engaged in a cutting cycle. When we look at those things relative to history, it tends to point to pretty good outcomes.
That's why so many people are still bullish on this economy and on the market too. That was Greg Battle of BNP Paribas a little bit earlier on today. Going into the opening bell, equity futures shaping up as follows. On the S&P 500, futures negative by a third. On the Nasdaq, we're down by 0.5%, underperforming on the Russell. New lows there, we're down by 0.9. With an update on your single names, your morning movers, Danny has more. Hey, Danny.
Hey, John. It's the story we're all continuing to track this morning. That's what's happening with Blue Owl. Shares falling another 4.5% after already closing at the lowest level since 2023. Yesterday, the drama surrounding one of their privately held BDCs. It's a retail vehicle for private credit. They had a lot of loans that were coming due about $1.4 billion. They were also freezing redemptions on it. But they brought those loans to market, and Blue Owl would argue we were able to sell those loans close to par. It shows that there is liquidity in this market that does fit a retail audience. There are concerns otherwise about that mismatch. Even so, Blue Owl shares, they're falling, again, more than 4% this morning. They also sold some of those loans to their own insurance business. Here's one for Anne-Marie, her favorite drink, Celsius. Shares a nice little rally today, up 7.6%. They presented at the CAGNY conference. It's a consumer retail conference, and analysts were wholly positive after that presentation. William Blair, for example, pointing out that they're likely getting more shelf space at retailers. So again, a gain there. Also gaining this morning is AppLovin, which we should have in a moment. There you go, up 2.4%, posting a job posting that they're looking for software engineers who can build the backbone of a social.
Important for next week. I think Jensen's been amazing at forecasting what's going to happen next. And so to me, like, you know, the product that they have coming, meeting this inflection in terms of AI demand, driving the token cost lower, and, you know, creating a lot of demand for inference on that side as well. So I think that's really exciting and what I'm going to be looking at.
We're going through this massive build-out phase, and you can see that in the hyperscaler CapEx, the tech CapEx intentions for the next 12 months or so. Tony, the bottlenecks we're starting to hit, from GPUs to memory. Can I ask you a question that you've addressed in your research recently, whether that begins to signal that the build-out is deepening or peaking? Which one is it?
Yeah, so I think the bottleneck, you know, constantly is rotating. You know, I think that whenever you're going from 0 to 60 on this size of build-out, like, you're gonna have things that aren't what you need to fix. And so I think that we're seeing that memory, optics, and energy power have been those bottlenecks. And initially, it was like GPUs. And so I think that will just continue to be a factor, and the market will work through it. And then at the same time, you're going to see probably areas of the market that really pop because of that.
What do you make of NVIDIA in discussions? They're going to invest $30 billion, we're learning, in OpenAI, and it seems to be separate than the $100 billion they had originally outlined with OpenAI in terms of their investment.
Yeah, so I think that you know, OpenAI is going to be one of the most consequential companies over the next decade, and you know, it makes sense that when you're building these type of tech ecosystems early on, they do kind of require partnerships. And you know, to me, I think it's NVIDIA building out its ecosystem, as well as participating probably in the upside of OpenAI that they're going to help create. So I think it makes sense. I know it's a little novel, but to me, I think that this kind of financing is not unusual for new tech inflections like this.
Are you concerned, though, about the circularity of all of this?
Well, I think that, you know, NVIDIA doesn't need to invest, you know, for OpenAI. I think that, you know, this is something they want to do. And, you know, I think that there's plenty of demand out there to fund OpenAI. You can see that, you know, the amount of growth that they're doing, in addition to just like the advancements in the agentic AI, I think are pretty incredible. You see this not just in the US, but also in other parts of the world like Asia. And so to me, I think it makes sense. And, you know, at the end of the day, what really matters is that agentic is able to drive ROI for customers in the enterprise. And so to me, that's what makes the most sense.
That ROI, Tony, as you know, is going to lag spending quite clearly from the hyperscalers. And I just wonder whether the hyperscaler patience can weather investor intolerance.
Yeah, so I think that it's definitely a good question, and one that the market has been debating over the last few years. But I think that over the last month, there's been a lot of you know, improvements in the models, and I think that agentic when I talk to software programmers, those that were really kind of bearish on agentic, even like 3 to 6 months ago, they're looking at the newest iterations of Claude and OpenAI and ChatGPT and seeing like, wow, like this actually saved me hours of work and it only cost me about $2 in tokens. So, and this is just the beginning. It's going to get better. And so I think the ROI is proving itself, and it's going to start in coding and then probably expand to other areas. And as a result, I think broaden and convince the market even further.
Tony, thank you. Looking forward to see what you've got to say next week when we get those numbers. Tony Wong there of T. Rowe Price ahead of earnings from NVIDIA. That's on our radar for next week. Military action potentially in Iran over the weekend. Also on our radar into the Supreme Court decision a little bit later, maybe, on tariffs.
That's at 10 a.m. Potentially we're going to get the fate of these tariffs using IEEPA from this administration. Kate Kalukowicz said IEEPA tariffs have accounted for 75% of the revenue brought in by this administration. So that's going to be huge. And then don't forget, the State of the Union is next week. So the president might have to discuss a number of massive issues facing this country.
This didn't feel like a shortened trading week at all, did it? No. This year, honestly, this year is moving so fast and at the same time moving so slowly.
I know. It feels like it's decades and days.
Amazing. Coming up on Monday, Claudia Saab of New Century Advisors, Torsten Slok of Apollo, Jason Draha of UBS, and BMO CEO Daryl White from New York City. Have a wonderful weekend. This was Bloomberg Surveillance.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3. Then I'm not looks like pushing, not pushing. 3, 4. Turn same way. 5 and 6. So this is 1 to 6.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
It's Friday, just barely putting up gains for the week as we fall this morning. 30 minutes ago into the start of cash equity trading. I'm Danny Berger. Matt Miller is off, back on Monday. Bloomberg Open Interest starts right now. Coming up, a busy morning of economic data revealing softer growth and stubborn inflation. The U.S. deploys forces to the Middle East as President Trump ramps up pressure on Iran. And Blue Owl's struggles underscore the risks facing retail investors drawn into the booming private credit markets. Let's get a cross-asset check this morning after we got that economic data, which we'll break down with Mike McKee in just a morning. The S&P falls after some of that weaker GDP figures coming through, down 0.2%. It's been a real risk off because of some of the concerns over Iran. Brent crude, though, that does fall this morning, still above $71 a barrel. And two-year yields go higher by 1.5 basis points this morning. This week, it's been this tug and pull between higher inflation from higher Brent crude, but also a risk-off trade. So let's talk about the data. It's December core PCE rising faster than expected, and fourth quarter GDP climbed by half as much as forecast. So let's bring you over to the table this way, because I'm pleased to say that joining us is the man, only man we'd want to talk to about this. It's Bloomberg's economic and policy correspondent, Mike McKee. Michael, so data quirks and all, how did you interpret the pieces we got today?
Well, some of it distorted by the government shutdown, and some of it maybe people running out of gas at the end of the year in terms of the spending numbers. The inflation numbers affected by various categories in CPI and PPI, but remember, these are December inflation numbers. Still, bad look for the Fed to be cutting rates when you've got the PCE core at 3% for the month of December. That's quite a ways from their target. And also we saw the PCE headline go up. The only other thing about it is, though, the Fed will have another PCE report, plus more CPI, more PPI, and another employment report before their next meeting on March 18th. I might point out wages and salaries only rose 0.2% in the month of December, and that is a big decline from what we saw in November. Maybe that had something to do with why spending came in lower than anticipated. The number getting, of course, all of the headlines is GDP, because it came in significantly lower than anticipated at 1.4%. Consumption fell off, and we see that reflected in those spending numbers. Business spending did rise, most of that for software and intellectual property. AI, I guess. Inventories and trade contributed only a fraction to the numbers this time. But the big question is what happened with the government shutdown. The BEA says the government shutdown cost 1 percentage point to GDP. And the way they do this is very complicated, but basically they assume that since people aren't working and the government isn't paying them, they can subtract their wages from government spending. And that's how they figure out what the impact was. This will all come back because they all got back pay. Right. So we'll see a rebound in the first quarter.
I was going to say the president putting out before this post, I know it's been brought up more than once this morning, the Democrats shutdown cost the USA at least 2 points in GDP. That's why they're doing it in mini form again. No shutdowns, also lower interest rates. Too late, Powell is the worst. President DJT. To that point, Mike, how much of the data we got today can be extrapolated forward if it is facing some shutdown effects?
Well, right now, all we have is the Department of Homeland Security. And while they are almost all working, they're almost all working without pay. The Border Patrol folks, I think, are getting paid, but the TSA is not. And so that will be folded into the current quarter numbers, except that this is a very small number of people compared to what we saw in the fourth quarter. So it won't be 1 percentage point. The question when he posted this, of course, was he leaking data that he got last night? And he either didn't leak, he just guessed, or he exaggerated how bad it would be.
Although you've had like former government officials like Kevin Hassett before saying, get ready for bad jobs numbers, and the jobs numbers are good. Yeah. So maybe you can only trust it when it comes to the president.
Well, I think they want to lower the bar. True. And then they can say they outperformed. But in this case,
did they learn that from a Wall Street CEO or something like that?
Like that.
Mike, thank you so much. Always appreciate your time, Bloomberg's Michael McKee. Let's turn now to the other drama in markets, and it's private credit. Blue Owl finding 4 buyers for a $1.4 billion portfolio of private loans to help pay out investors. Let's get the details with Bloomberg senior reporter Silas Brown. And Silas, Blue Owl, of course, would point to this and say, look, there is liquidity in the market. Though the thing raising eyebrows is that one of the buyers was their very own insurance pool of capital. How should that be interpreted?
Yeah, I mean, I think it increasingly shows the sort of familial nature of private markets investing. I think, like, look, you know, as we spoke about yesterday, I do think it is somewhat of a result for the investors in these funds to be paid out at relatively close to par, and the fact that they found these 4 institutional buyers, one of which is affiliated with themselves, I think is kind of good from a kind of narrow perspective. I think more broadly, it's sort of, I don't know. I feel like the private credit markets don't need or don't react well to turbulence, particularly when it comes to BDCs and also the public share prices of these large private capital firms. So I think they want more slow news days than they're getting at the moment.
I mean, this is the weird thing. So you've covered this sector for a while. Like, private credit is usually a little bit more sleepy, a little bit slow, and now it's like the sexiest, you know, topic that could possibly be out there. And you're right, it's not just Blue Owl. It's a lot of these private capital giants that are being hit on this. It's a lot of BDCs that are having issues in terms of just the reaction of share prices. But have any of them come out and spoken about their own liquidity issues, or does it seem to really be centered around Blue Owl right now?
Yeah, I think Blue Owl has been the one who's been most maligned by this. And I mean, maybe part of this is just kind of that it was, you know, largely seen as the kind of poster child, a sort of success story in private credit, and was kind of relatively newer player. Certainly under the brand name Blue Owl. So maybe that's why they're getting a bit of the brunt of it. Maybe it's also that they were kind of very much branded themselves as a big software lender, one of the largest software lenders, and with the kind of headwinds that the software industry is going through now with AI, maybe that was one of the reasons why they bore the brunt of it. But yeah, no, I think, like, you know, for a sort of, for a once sort of sleepy corner of finance, and also a corner of finance that sort of somewhat relies on you know, steadiness. You know, these are long-term loans, normally long-term lockups from investors. I think this level of volatility and kind of market noise is not. I'm pretty sure they're considering this not desirable.
I'd have to assume that is correct, Silas. Thank you so much for joining. That's Bloomberg's Silas Brown, and we're going to get more on private credit in the next hour with a GP stakes company, so they invest in private credit managers. That's Bonaccord Capital partner Brad Pilcher. Now, oil at elevated levels amid fears that the U.S. may strike Iran if no nuclear deal is reached in the coming days. Brent is near a 6-month high as traders assess the risk to oil supply. Bloomberg Intelligence senior commodity strategist Mike McGlone joins us. And Mike, it was specifically Donald Trump that said that Iran has 10 to 15 days to reach an agreement before this risk presents itself. Can we understand what exactly oil markets are pricing in right now? How much higher do they have to go if we get near that 10 to 15-day deadline with no agreement?
Well, I love your question, Danny, because it nails it. It's exactly the uncertainty. We don't know exactly what's going to happen. Will there be a sustained supply destruction? Probably not. Will there be some kind of action? Probably. You don't move an armada there like that and not do anything. But the bottom line is, every time we have these pumps due to potential risks of supply curtailment in the Middle East, it pumps up prices to the upper end of the range. The Western Hemisphere, mostly the top producers on the planet now, which is U.S., Canada, and all the way down to Argentina, sell forward on the curve. They bring on more supply, rinse and repeat, the prices go back down. So to me, it's just a question of how high we go, and I think we're in that point of putting in the peak. It's just hard to trade it when you have such uncertainty.
When there's uncertainty, and we have seen this, gold has become in favor too, Mike. It goes back above $5,000, but just given the lofty prices of gold and the fact it seemed like gravity didn't apply, how useful of a geopolitical hedge is it right now?
That old store value has relative value that's just way too expensive now. I'm very concerned. Been a bull on gold forever, but now we're in that silly stage of just getting too expensive. And if you look at gold versus crude oil, basically takes about 76 barrels of crude oil per 1 ounce of gold. Danny, that's almost the highest ever. The 100-year mean is 20. So for the most significant industrial commodity to be that cheap versus the most significant store value, to me, the risk is when we get some kind of ease of global tensions, the market that has the most to potentially lose is gold. And that's simply going back to $4,000 an ounce. So I'm very concerned that gold's run most of its bull market rally, and even silver too.
4,000, Mike, just quickly, if it goes back to 4,000, are you expecting it to kind of drift down there? Are you worried that there's going to be a lot of volatility and painful on the way down?
Well, I'm glad you mentioned it. Volatility on gold, 180-day volatility is the highest since 2009. At the same time, volatility in the NASDAQ, 180-day volatility is the lowest since 2018. I fully expect that gold volatility to trickle over to the stock market, and that's going to be all that matters for most investors. Gold, I think, has already priced it in, and the best leading indicator for these risk assets go down is probably Bitcoin, and we know that's done. It's already leading the way lower.
Great point, Mike. Brilliant as always. Mike McGlone from Bloomberg Intelligence. Let's get a check on your futures market this morning. Decidedly risk off. A couple things. For one, you have what Mike was just discussing, this threat of escalation among Iran, and then you have the thing the other Mike was discussing, and that is GDP numbers coming in weaker. All of that sending stocks lower as the NASDAQ underperforms and the Russell 2000 underperforms even more with that concern about economic cyclicality. Those shares in the index down about 0.8%. Coming up, President Trump says that he won on affordability and may finally find out whether the Supreme Court today views his tariffs as legal. We're going to have your DC update coming for you next. This is Bloomberg Open Interest.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Let's get you to high interest stories. A look at what's making headlines around the world. One we've been closely following here on Open Interest. Private credit funds have long pitched themselves as safer because investors lock up money for years. But Blue Owl Capital now faces a wave of withdrawal requests from its retail private credit fund. The news challenges the idea that private credit is insulated from liquidity stress, as a new report shows that redemption requests at large BDCs jumped 200% in the fourth quarter. Senator Elizabeth Warren is urging tougher rules and more disclosure for the sector. Palm Beach International will be renamed President Donald J. Trump International Airport after Florida lawmakers approved the change. Governor Ron DeSantis is expected to sign the bill. The move still needs FAA approval and naming agreements as the Trump organization seeks trademark control. Rebranding could cost $5.5 million, drawing criticism from Democrats over spending. And President Trump says that he's won the affordability fight, pointing towards easing inflation, job gains, and tariffs he claimed revived U.S. manufacturing.
What word have you not heard over the last 2 weeks? Affordability. Because I've won. I've won affordability.
His comments come as polls show voters have soured on Trump's economic policies, endangering Republicans' hold on both chambers of Congress and the future of Trump's legislative agenda. Joining us now is Bloomberg Washington correspondent Tyler Kendall, and it's a true treat because Tyler's in New York today. Hey, Tyler, thanks for joining.
Thanks for having me.
Maybe someone should show President Trump the most latest PCE numbers, but if Trump is declaring that he has won on inflation, on affordability, what does that mean for some of his policy pronouncements that he's been trying to hand down to tackle affordability?
Right, so Danny, we've really picked up on this from a Washington angle because it almost felt like President Trump was signaling a shift in his messaging. This feels like a lot more of an offensive, of an aggressive messaging on affordability, considering that the White House really has been playing defense when it comes to the issue. You mentioned polling. I grabbed some of the most recent one we saw out just the other week from Pew. 72% of U.S. adults rate economic conditions as only fair or poor, and that's sort of the headwinds that this administration is dealing with. And to your question, we've seen them approach it perhaps two ways. One, floating those new populist policies that probably won't make their way through the U.S. Congress unless the president tried to take some sort of unilateral action, as we often seen him. And then also touting those policies that have already been enacted. Most notably, you're going to hear the White House push a lot about how Americans are going to get those larger refund checks under the One Big Beautiful Bill. The question, of course, then becomes what are Americans going to do with that extra cash? Save it, spend it, or pay off some loans?
I mean, Americans historically love to spend, so we'll see what happens. Of course, the other thing that could maybe change a lot of this is if we get a Supreme Court decision today. 10 a.m., the Supreme Court gives decision. Is there a possibility we could hear something on IEPA?
So maybe is the answer. We don't know when the Supreme Court will rule, though we're expecting them to rule at least before the end of their term, which is in June. But some court watchers have pointed to the fact that the justices decided to take this case on in what's considered to be an unusually aggressive schedule. So that signaled that perhaps they want to rule sooner rather than later. But at this point, there's really no telling. But it is such a pivotal part of the Trump administration's agenda. We know that it's hanging over the balance when we're talking about trade negotiations that are still ongoing. Right overnight, we just saw the latest deal inked with Indonesia. But it's also opening up this question about what potential refunds would look like if the administration ends up being on the hook. That decision may not be decided in this case. The court may not rule on whether or not we will see these tariff refunds, but Danny, keep in mind, under the IEPA tariffs alone, just this subset of tariffs, the U.S. government took in $133 billion last year.
So the other thing on the administration's agenda is this proclamation President Trump gave, 10 to 15 days for Iran to come to the negotiating table for some sort of deal. Where do conversations stand at this moment? Because there was that Axios op-ed this week that really had people concerned that we're heading towards some sort of larger conflict.
So when you ask the White House, officials will always tell you that every option remains on the table. That's what we repeatedly hear, but we have to put some context behind this, right? The first is that going into these talks, we know that there appears to be these contrasting parameters between what the U.S. and Iran want to see in an ultimate deal. Yes, the nuclear program, the question about whether or not Iran will be allowed any domestic enrichment capacity, but the second part of that is that we know the U.S. wants some of these other action items to be folded in. Iran's ballistic missile program, as well as its support for proxy militia groups in the region. And without that actually firmly on the table, it's hard to see what the Trump administration would be willing to agree on if they choose the route of diplomacy. The other backdrop of this, of course, is the massive buildup of U.S. military assets, which is raising the stakes and raising the alarms in that region.
Yeah, and I got to say, it seems like the market's finally paying attention to that, too. Tyler, thank you so much for joining us this morning. Bloomberg's Tyler Kendall. Coming up, we'll talk more about market reactions to that and otherwise. Nimrat Kang looking for software stocks that have been oversold by the AI scare. She's going to share her thoughts. That's coming up next. You are watching Open Interest.
morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Wall Street stock pickers are looking for winners outside of AI, as well as software stocks trading at a bargain. Among them, Northstar's chief investment officer, Nimrit Kang, saying we are leaning into industrials and healthcare and looking for AI survivors in the software space, which the market has prematurely discounted. I'm so pleased to say that Nimrit joins me now. And it's a space that's been really punished at some points indiscriminately. Nimrit, where are you finding bargains of stocks you like that have been thrown out with the bathwater?
Yes. Danny, it starts to feel to us like AI is the hammer looking for, any nail. So basically what we've seen in the last few weeks here is just indiscriminate selling. It doesn't matter, you see a tweet, a company launch some kind of a tool, and you'll see a major sell-off in the stocks. I think what we have to do as investors is to continue to look at companies that have proprietary data sets that are adding a value and are going to be the ultimate AI enablers in this whole landscape. So that's how we would be focused. And there are plenty of opportunities that we're seeing because since June of 2025, the semiconductor index has outperformed the technology index almost by 100 percentage points. That's a lot. And that's where we're seeing the value.
What is the moat then? What is the characteristic you look for in the software company to say this thing can survive whatever sort of AI startup karaoke company throws at it?
Yes. Really good question. It really comes down to what is so proprietary about it. And just to answer that, I'm going to frame this question a little bit. Back in 2016, 2017 timeframe, we went through this phase where companies were getting sold off every time Amazon put out a press release that they were entering a new market. As a matter of fact, they acquired Whole Foods, and what that ended up happening is Walmart, Kroger, all these companies got crushed, right? And reality, 10 years later, is that we have not all just started shopping at Amazon for our groceries. We still go to the grocery stores. And those stocks are up like 4 or 5 times from those lows. Same thing happened at industrial distribution. So I think for us as investors, we need to look at what is the proprietary thing that the company is doing? What is their moat? Take, for example, Verisk Analytics. This is an insurance analytics company that has proprietary data sets that are being used to determine what's the insurance loss ratios that should be used and how insurance companies can put through premium increases. Is that going to get completely disintermediated? Where are we going to get those data sets from? So those are the types of questions we're asking, and that's how we're trying to understand where the moat is.
The strange thing is also happening, Nimrit, where on one hand, you have this discussion of, is AI going to disrupt all these different companies? And then on the other side, you have a conversation of, are we in an AI bubble? Are things priced too richly that are building these AI capabilities? What about the other side of the trade, Nimrit? What do you think about the sensitivity about the hyperscalers and how much they're spending?
Yeah, it's actually a fascinating question, right? So 600 billion is what the hyperscalers are spending this year. That's 200 billion more than what they spent last year. To put it into context, the US defense budget for procurement R&D is something close to 385 billion. So we're spending almost twice that the US is spending on all kinds of procurement in on an annual basis. That's the level of tailwind that we're seeing. But what we're seeing, what you just mentioned, the market is saying this. You know, AI is going to take out whole pools of industries, whole number of profit pools are going to get completely disrupted, disintermediated, and yet somehow we're going to keep spending to buy these semiconductor chips and powering the AI revolution. Well, it doesn't make sense, because if you're going to see the return, then the obvious companies that are going to make that, monetize that return, hyperscalers are going to be a big part of that, and the AI enablers.
Nimrit, you're going to stick around with us. We have a lot more to talk about. You're going to stay with us through the opening bell. And as futures fall, just minutes away from the opening bell, we are down by 1/3%. That's coming up next.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurant opened. He asked me to come to open the restaurant in New York, and beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know what he doing, because I never watched the movies. You know, I was traveling the business. But of course, after people, hey, Nobu, so you must know him, and then I understand.
How is he as a partner?
He's for me, and a great partner. He understands to my concept. He support me 100%. But he's a very smart people. Sometimes so strange idea, but it's good idea. So, example, Nobu Hotels idea come from him. He say, hey Nobu, so we have a lot of new restaurants coming in somebody's hotel. For him, doesn't make any sense. Then we start Nobu Hotels in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Just seconds until the start of your cash equity trading day. I'm Danny Berger, and you are watching Bloomberg Open Interest. We are down this morning. A couple things going on. Fears over Iran escalation. Also, more negative GDP data. I mean, not literally negative, but not as good as we expected. So S&P futures fall by about a third. The NASDAQ doing even worse, down 0.6%. And the Russell 2000, because of those economic concerns, even worse, down 0.7%. Bell ringers. Starfighter Space, not gonna lie, pretty sick company name. They're a commercial space flight company. They went public in December, and their shares have risen nearly 200% since then, so feeling pretty good. Down at the NASDAQ, Red Cat. Guys, not a single tie. Not a single tie. Come on. Come on. It's a special occasion. I guess it's okay if you're at the NASDAQ. Maybe it's more chill. Anyway, Red Cat, they make data storage, different services for autonomous drones. Those shares up 60% about year to date. Let me take you to some other stocks that we're watching this morning. Blue Owl is one of them. We, of course, cover private credit here for you on Bloomberg Open Interest extensively, and this is no exception. Selling $1.4 billion portfolio of loans to help return cash to investors. Blue Owl would argue, look, we did that close to par. It shows there's liquidity. You're welcome. They did have 4 buyers. They include 3 of North America's largest pension funds. And maybe the thing that's going to raise some eyebrows, its own insurance firm was one of the buyers too. So that not helping shares out this morning. They are down 6.5%. As always, we invite Blue Owl to come onto the show and to discuss the latest as to what they're doing. Let's get back to these overall markets, though. We're back with North Star's Nimrit Kong. Nimrit, you were talking about this idea in your notes that the broadening out trade is going to happen as this economy picks up. I just wonder what you make of the most recent data we had this morning, where PCE continued to look sticky and GDP disappoints. Just how sure is the trajectory of this American economy?
Yeah. You know, the GDP data continues to be extremely noisy, right? Just like we had that bumper print in Q3 of 4.4, and now we have something like that's lower. I think rather than getting fixated on quarter to quarter, because we are going through this immense disruption in policy changes, government shutdowns, all kinds of imports, exports, so much noise. Instead, I think we need to just focus on the direction of travel. And we look at corporate earnings to get a sense of that. 13% increase in S&P earnings last year, projected to do something similar. So from that perspective, it's still a very healthy economy. I just mentioned something like, $600 billion that we're spending just on the CapEx from hyperscalers. We're going to get stimulus here. So there's plenty of tailwinds from the economy. But you're right, Danny. We haven't seen this translate into real economic growth. Look at rail traffic data, kind of flattish, right? Not much going on in home building. We need to see some broadening actually into economic data for the cyclical trade to have legs and continue going forward for the rest of the year.
How much of it is priced in at this moment, some of that rotation? Because it does have, I don't know, this might be going too far, but a violent feeling. Just the very fact that the surface level index has been pretty calm, but Goldman Sachs, or rather Citadel, pointing out that the absolute move of individual stocks has been averaging something like 10%. So as this rotation has been happening, how much of that is pricing in better economic data to come?
Yeah. It's primarily pricing in better economic data to come, because if you look at the analyst revisions, the revisions are still leading for technology sectors. We are not seeing that same kind of uplift that we're seeing in the stock prices. So the market is discounting well ahead of time. And that's why we would be a little cautious rather than going full on into the cyclical trade at this time. Let's take our time. Let's start to actually see some of the PMI, other economic data inflect positively. It almost feels like, the markets have become like bees, going from one hot trade to the other hot trade, right? First it's AI, then it's the cyclical rotation, then, it's outside of the US. So it's a lot of that herd mentality going on from one point to the other, and we just have to take a longer term view here.
It's a perfect analogy for what's happening right now, Nimrit. You did have Citi. They downgraded technology stocks to neutral. They say diversify away from the Mag 7, allocate into U.S. small caps. The latest Bank of America Fund Manager survey also showed investors rotating out of technology stocks. How are you thinking about technology exposure as well? Are you also thinking about rotating away from that, or is it just about lifting the exposure from the other parts of this market?
Yeah. I mean, technology remains essential to this story the way it is so far, right? You can't have the biggest tailwind coming to the economy from the technology sector, from the hyperscalers, and them not participating in a big way in this whole economic growth. So the two things have to happen here. Either we're going to have to start seeing a much bigger rebound in the economic activity outside of the hyperscaler spending, which we have yet to see. And a big part of that needs to come from maybe the interest rates need to come down. And that's a whole different discussion to get that segment of the economy going, but there isn't an impetus to do that yet. Or we need to go back, there needs to be just a balanced kind of market dynamic where we're not going from one segment to the other. Rather, it's just a broader, all sectors of the market are participating. And technology, you can't have a market continuing to do well and technology continuing to lag.
You also mentioned, Imran, in sort of the B trade of where we hive around. One of them has been international stocks. You've certainly seen that. The latest Bank of America flow show note this morning saying that we're moving away from U.S. stocks into international at the fastest rate in about 5 years. What do you make of the trade? Is now time to look beyond the U.S.?
Yeah. It's always been a time to look beyond U.S. Unfortunately, it just didn't pay off, right? So if you looked at the last 10 years, international EM bottom of the pile in terms of the returns in versus the U.S. equities. Now, all of a sudden, they're top of the leaderboard, EM up 34% last year. And then, of course, we see all kinds of chasing going on there. But I think let's unpack that. What is the EM and an international trade? It really comes down to three things again. First of all, it is an AI trade. Say what you may, but, you start looking at the major emerging markets, Korea, Taiwan, it's a semiconductor trade, AI trade again. The second one is defense spending going up in Europe and other parts of the world. That's another one. And the third one is the dollar debasement trade. So it kind of boils down to those three things. And, it's always good to be diversified and have a presence outside. But again, going back to the fundamentals, look at Europe. We're not seeing a broad-based pickup in economic activity or consumption in Europe or other parts. It's really, again, tied to the same big boom in AI and defense and de-dollarization.
Nimrit, this was brilliant. Thank you so much for joining this morning. Enjoy the rest of your Friday and your weekend. That's North Star CIO Nimrit Kang. All right, let's get a check on your equity market right now. About 8 minutes into your trading day, and we have moved from decisively lower to decisively nowhere. We, though, do have breath to the downside. So quickly, let me go over some of the winners. It does seem to be big tech's day. Alphabet having a very good day, up more than 2%. Amazon up there at the top of the pile too. NVIDIA, recall they will have earnings next week. How much does that change the tech trade? In terms of points moving, just because Apple is such a big composite part of this index, Apple is the biggest drag, even though it's only down 1/3%. Walmart, though, I just want to hang on that for a moment. It's down 1.7% this morning. It has fallen every single day this week. It is now down more than 8.5% so far the week. That will be, if it closes at this level, its worst week on record for this company. I mean, it's had a huge run up in share prices over the past year or so. So even with that, things are okay. But just to point out that they had earnings, and maybe there is some disappointment there with high expectations. So if you look at the sectors, consumer discretionary, or rather staples, is going to be near the bottom because Walmart's in there and all of its peers like Costco are also falling. Energy falls because the price of oil is falling today after a big pickup yesterday. I pointed out Alphabet, that was one of the biggest gainers, so communication services up there at 1.2%. We're going to get more into tech after this commercial break. Coming up, Netflix co-CEO Ted Sarandos tells Bloomberg that his deal with Warner Brothers will be good for theaters and accuses Paramount of spreading misinformation. We're going to have that fantastic interview with the man behind it, Ed Ludlow. That's coming up shortly. This is Bloomberg Open Interest.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Some breaking news to bring you. President Trump speaking to reporters at the White House saying that the U.S. is considering limited strikes on Israel. A limited strike, I think, is exactly, Israel, Iran, that would certainly be something different. A limited strike on Iran, please forgive me, Friday brain. This has been the concern that President Trump has given Iran a 10 to 15-day deadline in order to reach some sort of agreement. Maybe this is how he's thinking about what happens if that deadline to reach an agreement is not achieved. You can see that the price of oil, it was sinking, slightly drifts higher. Now is little change at this moment, just slightly higher. We'll keep an eye on the price of oil. It's also been something that's been sending stocks lower. All right, let's get to your top calls this morning. Some of the analyst action that we are focusing in on. First up, Barclays is upgrading Etsy following its latest results and agreement to sell Depop to eBay. The firm says that Etsy is at a tipping point and needs to return to steady positive growth. Shares up 5%. Next up, Walmart is getting cut at HSBC after the retailing giant issued a cautious consumer outlook. Walmart is often viewed as the barometer for the broader economy because of its size and reach, down 2.2%. Again, I pointed this out. It's fallen every day this week on track for its worst week on record. And finally, Barclays is initiating biopharma, calling the group a relatively safe haven in volatile markets and naming Eli Lilly as one of its top picks. The firm says Lilly is likely to lead the obesity drug market. Let's now turn to the deal and the drama over Warner Brothers. Netflix co-CEO Ted Sarandos said his company's acquisition of Warner Brothers could lead to more films in theaters. Here's his rationale.
We're going to keep Warner Brothers running pretty much like they are today. And in fact, it's even quite better for theaters because now that we're going to be in that business and own a theatrical distribution entity, we're going to take some of the Netflix films and put them through that as well. So it's very likely that you'll have even more outcome of high-quality films for the theaters if this deal goes through.
Sarandos also accused Paramount of spreading misinformation. Bloomberg Tech's Ed Ludlow conducted that excellent interview, and he joins us now. Ed, just your initial reaction to those comments that Ted Sarandos said to you.
Yeah, I think something that people have seized on overnight is at the end of that answer, he said, if the deal goes through. But in the sentence preceding it, he said, when we own these assets, we are going to have, you know, and that's kind of been the consistent thing. You know, in frank reflection on it, Ted Sarandos has always been confident that the regulatory road will be surmountable and that they are playing this by the book, particularly with the DOJ. And the process that it was codified in 2023. But the movie theater business is really interesting, right? That is the anxiety that they won't put in writing a commitment, literally in writing, to theatrical releases over a certain time period, but they have said that they will. And you know, the final thing that is kind of attached to that is he was frank about like Netflix's shortcomings versus Warner Brothers' advantage. Like Warner Brothers Discovery has been making movies for 100 years. Netflix has been making stuff for 10 years. They kind of want to leverage that with what they are good at, which is technology and of course, the platform.
Isn't this part of the issue, though, Ed, when you have Ted Sarandos admitting, here's some of our shortfalls versus Warner Brothers, doesn't that upset shareholders who, a lot of them have long said that Netflix doesn't need this deal, that Netflix, as it exists at the moment, is okay and everything else is a distraction?
Oh, yeah. Yeah, I mean, there is a big portion of the investor base that thinks Netflix should just walk away, right? That for loads of reasons. Integration risk for one, the share price has come down more than 30% since this all started. The principal argument that Ted Sarandos has is that it's not just the IP. Warner Brothers Discovery, you know, particularly well, literally the studio and streaming part, they have a very, very mature, built-out distribution business. And Netflix leveraging that to put theatrical releases out into the world, not just IP that originates from Warner Brothers, but IP that originates from Netflix. Like, it gets their stuff out there more. And he really pushed back on this idea that this is a knee-jerk reaction to Netflix has had engagement growth slow down. It was about 2% in the second half of last year. And so beyond that, it's just mechanics, right? It's mechanics, and like, I wish we got a little bit more into the debt part of this. Maybe Ted's not the right person on the C-suite bench to discuss that with, but you know, to them, they've just been unwaveringly confident that this is the right approach.
Hey, Ed, elsewhere in your world that I'd love to ask you about, there was this FT story about NVIDIA and OpenAI nearing an agreement for $30 billion worth of investment. That is NVIDIA investing that into OpenAI. How should we interpret that? Because there was much fanfare around this idea that the letter of intent to invest $100 billion maybe was just that, a letter of intent and not necessarily an agreement.
Yeah, they're essentially two separate transactions. I mean, Shireen Ghaffari and I had reported, I think 3 weeks ago, that NVIDIA had got to $20 billion in participation of what is a standalone funding round from OpenAI. So now, you know, reports, I mean, we're kind of hearing this as well, it could go up to $30 billion as part of a wider $100 billion round. That is completely separate from the announcement that was made between OpenAI and NVIDIA about NVIDIA over time in phases, tranches, and based on various operational milestones, putting $100 billion into OpenAI, which NVIDIA has subsequently said was not firm. It was not a firm commitment. It was basically a letter of intent. So that seems to be the mechanism now. Yes, NVIDIA is going to participate in this massive funding round as a one-off at scale, big chunk of it. But that sort of long, multi-year, $100 billion staggered investment tied to various goals, that doesn't seem to be proceeding forward anymore.
Ed, just finally, because we're going to get NVIDIA earnings next week, what's at stake given some of the jitters around large cap tech in recent weeks?
Yeah, everything. You know, like right now, I don't know where the NASDAQ 100 is. Forgive me, I don't have my terminal in front of me, but we're either on track for the 4 straight weeks of losses on the NASDAQ 100, or we're not, depending on where we close. I think it was basically, we're up 0.2%. So we'll see where we end of the day. The capital expenditures numbers were everything. All of that capital expenditure largely is going to go to NVIDIA, right? Because they own so much of the content of the server. They would need to project confidence that they are seeing real spending demand from the hyperscalers plus Meta to give everyone that confidence in the market. That's a pretty succinct summary of what all the sell-side notes say, at least.
Ed, thank you so much. As always, we very much so look forward to Bloomberg Tech today at 11 a.m., which Ed leads, and we'll see that very shortly in a couple hours' time. Coming up here on this show, though, the ETF race to zero, maybe over as fees start to tick up. We're going to have more on that reversal. That's coming up next on your ETF Friday.
fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business.